let's start the taxation of other entities. So in other entities, we have AOP, BOI, firms, then business trust, charitable trust, political parties. These are some of the other areas. So for sure, 100% there will be questions on these areas also. So we'll have to finish all these assessments as well. For taxation of AOP, BOI, and of course remaining you have your assessment procedure anyway. Apart from that, you have this then and then capital gain PGP done, then IFOS also done, then TDS and little bit of course international taxation. TDS, TCS also very important. Cool. So let's see taxation of AOP and BOI. So it's in point number J. So what do you mean by association of person? It means any person given under 2 clause 31. That is called as a association of person. BOI on the other hand is body of individuals. They are obviously only individuals who are coming together to earn some profit. So here if you see the definition, AOP, association of person means two or more persons joining for a common purpose or a common action, not as any partnership or LLP, with an object to produce income or profits or gains. If Mr. Karthik, Malik and Company and Artist Private Limited join together to carry on construction activity otherwise than as a partnership firm, such an association will be recognized as an association of person. BOI, it denotes the status of persons like executors and trustees who receive the income jointly and who are assessable in a manner as beneficiaries individually. So, if I am a businessman and the businessman dies and he gives the property to 4 of his children, 3 of his children, the children continue to carry on the business without forming the business or without continuing the business of business entity. They will not continue the firm, but they will do it as individually. So that then all of them would be considered to be as body of individuals. Whereas AOP can be one company and one individual, one company and one firm, whatever it is, association of person. Then AOP versus BOI, AOP can be any person, can be a member in any person, that is company, LLP, firm, etc. can be a member in an AOP. However, only individuals can be members in a BOI. There is a common will and desire among the members to voluntarily join an AOP. In case of a BOI, such common will and desire are lacking and it is formed only by operation of law. So an AOP can be constituted by individuals or non-individuals, whereas in BOI generally they will not come together to do any business like that. It will predominantly be through transmission, where somebody dies, then you will get the business. Anyway, so for our taxation purposes, what all are the sections that we need to keep in mind? Very simple. First of all, the meaning of 2 clause 31 AOP BOI, which we have just discussed. Co-ownership is not included in this. Group of persons coming together to do some business or earn profit is what it is. Main thing is according to law, just like partnership firm everywhere, here certain things are disallowed. They are not allowed as per the taxation rules. What is not allowed? Bricks, that is bonus, remuneration, interest, commission, salary. These things are not allowed beyond a certain point. We'll have to see. Is there a certain point? No certain point, we'll see. So bonus, remuneration, interest, commission, salary is disallowed. Since it is disallowed, it will be taxed in the hands of the AOP. And what happens to the tax in the hands of the members, we will see that later. Then member share, that member share is given in 67 capital A. So the moment you disallow under here 40BA, then it will go to the member. Member share will be under 67 capital A. Taxation will be in the normal rates or taxation will be in the rates as per 167B. Normal rates or rates as per 167B. Rebate on the other hand will be under section 86 read with section 110. There is some rebate also, yes. There are two rates, one is normal rates, one is 167B rates. We will see all those things in the discussion. So first and foremost, 231 we already discussed. First we have to read which one, guys? 40BA, disallowance. 40BA disallowance. Let's see. So if you check, any payment by of interest, salary, bonus, commission, remuneration paid by an AOP or BOI to any of its members shall be disallowed. An AOP, BOI to any of its members shall be disallowed. So salary or other remuneration paid to a member is not deductible even if it is a case of actual services rendered by him. Further, interest on capital, loan, borrowings is also non-deductible. Why? Because ultimately it is given to whom? It is, I need to tax the AOP some way. So I'll disallow here, tax them, and then later allow it in the hands of the members. That is the reason why. So if you see, members give a loan and the loan is now given to whom? When members give a loan to the AOP and the AOP is paying interest, that is disallowed. Rent paid by AOP on the other hand, that will be allowed. Why? Because they are paying rent from their own pockets, right? From the AOP's pocket. On the other hand, there are certain things, if you see here, where member who received interest from AOP or BI also pays interest to the AOP or BI during the year, only excess interest is allowed. So these are some peculiar cases. I have made examples, becomes very easy. So first and foremost, in this AOP BOI, let's say Nandini is the AOP BOI member, right? And Onion is also, okay, the AOP BOI name is Nandini and Onion is a member. Right. So first and foremost, point number A. So first is 14,000 interest is given on loan on capital. First of all, on capital is getting. Apart from that, Onion member is giving 10,000 rupees interest on his drawings. And again, B 16,000 interest on his drawings. And of course, there is a loan. There is a loan on which, on capital, whatever it is, which Onion has deposited, 14,000 firm is, AOP is paying. So the question here is, can I set off 14,000 against 10,000? Two different scenarios we will take. Scenario A 10,000, scenario B 16,000. One scenario first. 10,000 is what I am giving. 14,000 was I am supposed to get. Now tell me. Can I set off? Scenario A, scenario B. Scenario A is what? Member is paying 10,000 to AOP and AOP is paying 14,000 to Onion. Ideally speaking, what is disallowed? Payment made by AOP is disallowed. So my question to you is 14,000 disallowed and 10,000 is treated as income, or 14 minus 10, 4,000 is disallowed? So they said explanation 1 to 40BA says 14K minus 10K, 4K only is disallowed. So I told you disallowance is possible, but there are some cases where it is allowed. This is some of those cases which is allowed. Right, so 14K minus 10K, 4K is allowed. Next, Onion is a member, 16,000 rupees interest on drawings. In this case, tell me, is it possible to set off and only 2,000 rupees can I show? Is it taxable in the hands of AOP? Because what is the income for AOP? 16,000. What is the expense? 14,000. So will I disallow 14,000 and also take income 16,000 and 30,000 should I pay? No. So they are saying 40BA, if you see that 40 BA disallowance is nil, 2000 rupees alone is taxable in the hands of AOP/BOI. Clear? That's the first benefit given. First benefit given, same thing is given here. Where the member received, cases where interest is allowed. Second one. One more example, guys. AOP BOI, name Nandini. Onion is a member who is getting interest on loan or capital. Ambi is a member who is giving 12,000 interest on drawings. Can this be set off? Should it be set off against a member or overall set off for members? A member? Yes. So you see, amount paid by AOP to amount received by AOP to the firm. Words also is given, the member is given, same person is given. So when I say same, also and also and the is given, which means it means the same person. Hence, AOP or BOI disallowance under section 40 BA is how much? Full 20,000 rupees. And income chargeable to AOP as tax is how much? 12,000 rupees. So AOP BOI disallowance under 40 BA 20,000. Income chargeable to AOP as tax 12,000. So whatever I am getting money 20,000, whatever I am giving 12,000. Got it? So now all nice names. AOP name is Rara, right? HUF is Chandramukhi, and Mr. Motte Boss is the Karta of what? Of the HUF, and mind you, he is representing the HUF in a representative capacity. That's all. Who is the member of the AOP? Chandramukhi is the member of the AOP. But guys, HUF Chandramukhi cannot go as the AOP. They should be represented by somebody. Who is representing it? Mr. Motte Boss. So Motte Boss is the Karta representing the AOP. Very, very simple. So first and foremost, point number A, Rara is giving interest on capital to Chandramukhi. And AOP B, it's also giving 15,000 interest on loan to Chandramukhi. Fair enough, right? So point number 1, interest on capital 10,000 to HUF Chandramukhi. B, interest on loan also given. C, interest paid on loan 8,000 rupees given by Motte Boss in individual capacity. Motte Boss has also given loan in an individual capacity. To that, AOP pays interest of 8,000 rupees. Then also point number D is what? Motte Boss also gives interest to AOP 3,000 rupees on loan given by AOP or BOI to him in individual capacity. Very, very simple. HUF Chandramukhi has two things here. One is they have given capital, they have given interest, they have given loan, sorry. So Rara is making two payments to HUF Chandramukhi. One is interest on capital, second payment is interest on loan. Mr. Motte Boss has given a loan also, has taken a loan also. For whatever he has given a loan, he is getting an interest of 8,000 rupees. For whatever loan he has taken, Rara is, what do you say, getting interest. I mean, he has obviously taken a loan. So Motte Boss is paying Rara 3,000 rupees interest. All these items are there. So figures I'll tell you. Payment to Chandramukhi. Ultimately, I made to Motte Boss only in his representative capacity. 10,000 interest on capital, 15,000 interest on loan. Next is payout from Rara to Motte Boss for the loan given by Motte Boss is 8,000. Receipt by Rara for loan which is taken from Motte Boss is 3,000 rupees. question to you is, what is disallowed, what is allowed? Is it like set off here? Okay, one by one we'll go. What about 10,000 rupees? Interest on capital 10,000, disallowed. Interest on loan, this 15,000, disallowed. So yes, 10,000, 15,000, disallowed. What about 8,000? AOP RARA is giving 8,000 interest to Motte boss, not in the representative capacity but in the individual capacity. Allowed under 36, section 36. Then receipt of 3,000 will be taxable in the hands of AOP BOI. This is actually told in explanation 2. If you read explanation 2, you will not come from tomorrow. That's why I made this example. This example only is so tricky, but the thing is, explanation 2 is more trickier. Very simple. So in this entire example, 10,000 rupees disallowed, 15,000 rupees disallowed. Then the amount that I am receiving, 3,000 rupees, taxable. Amount which I am paying, 8,000 rupees. What do you think? It is allowed. Taxable in the hands of AOP BOI. Explanation 2. Then one more. AOP BOI, Loki and Company. Mr. Vikram is the member of the AOP. Mr. Vikram is a member of the AOP, mind you, in individual capacity. Mr. Vikram is the member in an individual capacity. Mr. Vikram is also a Karta of HF, which is Delhi. Delhi is the HF, separate. And he, in this particular example, Motte boss was only representing HF in representative capacity, but the member of the AOP was HF. In this case, the member of the AOP is not HF, is the individual. He also happens to be the Karta of a HF Delhi. Now, same stuff. AOP is giving interest on capital to Vikram in individual capacity 10,000. AOP is giving interest on loan, which is given in individual capacity 8,000. But is a member. And AOP BOI is giving interest at 20,000 to Vikram, but as a Karta. Instead of giving to the HUF, they are giving it to him because they had taken a loan from the HUF. And fourth one, HUF Delhi has given a loan of 2 lakh rupees at 10% per annum. So based on that, this 20,000 rupees interest is being paid to Vikram. So ultimately, AOP BOI, Loki and Company, ultimately what is happening? Interest on capital 10,000, disallowed. Interest on loan 8,000, disallowed. This interest paid 20,000 to Vikram as a Karta. Yeah, as a representative. No, but in this example, when I pay 10,000 and 15,000, who will I give it to? I will not give it to HF, I will give it to Motte boss only. But I will give it to Motte boss only, no? In what capacity will I give? Representative capacity. Since it is going out, who is the member? Basically, you should understand interest paid to member is disallowed. So here I told you, 10,000 and 8,000 interest is paid to Vikram as a member only, right? I told you is a member in individual capacity. So this 10,000 disallowed or allowed? Disallowed. This 8,000 disallowed or allowed? Disallowed, because it is interest paid to a member. Who is the member? I don't care. Interest paid to member. In the previous case, even I gave this to 15,000, 10,000, I gave it to Mr. Motte boss, who is a member. But then, member in what capacity? Representative capacity. HUF is the member. So ultimately, it's like HUF has given the loan. Here, HUF has not given the loan. Vikram has given the loan. So 10,000, 8,000 allowed, disallowed? Disallowed. What about this 20,000 which is given to Vikram but in the representative capacity? Which means the HUF has given a loan. I am giving interest to Mr. Vikram, but not in the individual capacity, but in a representative capacity. Who is the member? Individual or HUF? Individual. So this 20,000 will be allowed under 36(1)(3). This is explanation 3 to BA. Explanation 3 to 40 BA. Ultimately, you should understand interest, remuneration, etc. is disallowed only if it is paid to member. If HUF is the member, paid to Karta in a representative capacity will be disallowed. If individual is the member, paid to him in the individual capacity will be disallowed. Simple. Karthik was the Karta. Karthik was the Karta. He also started working in the individual capacity in the firm. So they gave him 20,000 rupees salary in the individual capacity. Allowed, disallowed. Karthik was the Karta. Who is the member? HF. But is working in the individual capacity. 20,000 they are giving salary. What do you think? Allowed, disallowed? This issue went to, see in explanation 2 disallowance, explanation 3 disallowance is there. This went to Supreme Court, Rashik Lal and Company. Explanation 2. Explanation 2, what does it say, guys? It can be paid to these people. But what can be paid? Interest only. Salary is not covered. So explanation 2 does not cover salary. So even if I pay to Karthik in an individual capacity also, it is disallowed. Rashik Lal and Company case law. In explanation 2, explanation 3, what is covered? Interest. Explanation 2 does not cover salary. I told you, interest paid to any member of the HUF, whether in individual capacity, if he is a member, or is a member in a representative capacity. Interest paid is allowed, disallowed? Disallowed. But if you receive in the individual capacity, if HUF is the member, but you are receiving in individual capacity, allowed. If you are a member, but you are receiving money in representative capacity, allowed. But this is only for interest. In salary, HUF was the Karta. But you are receiving in what capacity? Individual capacity. That is allowed or disallowed? Disallowed. Ideally speaking, you may say it's allowed, but it is not, as I told you. It is disallowed. Why? Explanation 2 does not cover salary. Where? No, this chart is for everyone. This chart is for bonus, remuneration, interest, commission, salary. Exceptions are given in explanation 2 and 3. In some cases it's allowed, some cases disallowed. Explanation is given in explanation 2 and 3. And explanation 2 and 3 does not cover salary. Show you it. Section 40 BA AOP. So what are any payment by of interest, salary, bonus, commission, remuneration by whatever name called, disallowed. because section 40 is about disallowances, that is disallowed. However, interest is paid by a AOP, the amount of interest to be disallowed will be excess, which means excess set off is allowed. Explanation 2 and 3 you see. Where individual is a member of association for the benefit of somebody else, that is the first case. Who was Chandramukhi? HUF was the member, you are a individual. So then interest paid by association to individual in individual capacity shall not be taken into account for this purpose, means shall not be taken into account for disallowance, which means it will be allowed. What is allowed? Interest only. Salary given to a person, even though you are in a even you have given it to you in an individual capacity, even though your HF is the member, it is still disallowed. Got it? So now the rates, tax rates. See, if I know what your rates are, what is your share, 25%, 25%, 25%, 50, 50, if I know your share, when none of the members have taxable income excluding the share of income from AOP. This share of income that company, the AOP is already paying, and now that income is being given to you, right? Other income, right? Because your disallowances anyway they'll pay. Normal income, you see, AOP, what rate should AOP pay? When none of the members have taxable income excluding the share of income from AOP. So AOP is distributing income to A, B, C, D. Anything that they pay, bricks payment is disallowed, which means AOP only has to pay tax. And for them, this will be the share of income of AOP BOI. And these people do not have any other income except this AOP income. These people will not be taxed anyway, but AOP will be taxed at what rate? Normal rate applicable to individual. Normal rate applicable to individual. This is when the shares are determinate and they are known. Shares are determinate and they are known. Where any member has taxable income excluding the share of income from AOP. Excluding the share of income from AOP means they have additional income. Apart from the income from AOP, they have additional income. Since they have additional income, anyway, which will not be taxed. What will not be taxed? Share of income from AOP will not be taxed. Correct? So, let's say others have 20, 20, 30, 30, 40 lakhs like that. This additional income, in case it was not charged to AOP, it would have been charged in their hands only. Let's say you already have 30, 30, 40, 50 lakhs of income. I would have charged it anyway to you. At what rate would you have paid? Highest rate, 30%. Now, since I am not adding it to you, but everything combined, who is taking? AOP. So, what rate should I claim? So, the lawmaker says AOP is taxable at MMR, 42.744%. 42.744% MMR. This income, no, this income should be less than the basic exemption limit. Does not have taxable income means what? Yeah, less than basic exemption limit. where any member is taxable at a rate higher than the maximum marginal rate. For example, foreign company. Foreign company, one of them is a member. One foreign company is a member. One foreign company member. So, in that case, the income of the AOP to the extent of the share of such member is taxable at such higher rate and balance is taxable at MMR. Foreign company 40%. Plus charge, cess, all those things, 45, 47%. These fellows 42.744. Correct? So, what will I do? Foreign company, that rate. Other people, MMR. Now, where you claim that I don't even know my share, just to escape all these things, that's why 167B was added. Because people were telling, no, I don't know what my share is. It's indeterminate. I said, okay, no problem. Then entire income of AOP BOI, MMR. Big deal. Earlier only this one was there. People are very smart. Shares are known. Sir, I don't know share. I have to do calculation. It was done a long time back. I don't know. I'm not sure what is exactly is my share. Okay, no confusion. Everyone has to pay. AOP has to pay how much? 42.744%. Where any member is chargeable to tax at a rate higher, then also that's a deadly point. Sir, there are 5 people. One is a foreign company, sir. What is his share? Don't know. What is your share? Don't know. No problem. Everybody will pay MMR or higher rate? Higher rate. Entire income AOP BOI, higher rate. So, as far as taxation is concerned, guys, AOP slash BOI, members share. AOP BOI if it is taxed in the individual rates. Second one, AOP BOI is charged at MMR. Third one, AOP BOI is charged at higher than the MMR, that is foreign taxation rate. Fourth one, AOP BOI is not taxed only. AOP BOI is not taxed because it doesn't have any income, whatever it is. Member will be taxed at normal rates. Now, if AOP BOI, this is for the member share of income, member share. If AOP BOI is not taxed at all because of some reason, exemption they have claimed, whatever it is, and that money share I am getting, I will have to pay tax at what rate? Normal rates. Second, they are charging at MMR, means I am charging the tax for AOP BOI at MMR or more than MMR. For me, what's the tax? Obviously, no tax under section 86. No tax under section 86. Now, this is the beauty. AOP BOI is charged at individual rates and then they'll give the money to me. Should I also pay tax? Yes, taxation is there at 67 capital A procedure I have to follow. Taxation under section 67 capital A, that procedure I have to follow. What is the procedure? We will see quickly. So, I have to follow 67 capital A procedure. This is the procedure, guys. Method of computing a member share in the income of AOP or BOI is as follows. Total income of the AOP BOI I should collect less interest, salary, bonus, commission, etc. subtract then this is the balance will be apportionable to the members. Why I should subtract all these things? Because these things who will pay? AOP will pay. Yes or no? AOP will pay. Balance to be apportionable among the members. And then share of income of the member, each member. Then add salary, bonus, commission, etc. in respect of this each member. This will be his total share. Less interest paid on capital borrowed by him for the purpose of investment in the AOP BO. This is my total share, of which I already got interest. This interest anyway the tax would have been paid for whom? Tax would have been paid by AOP BO anyway. So ultimately what will I get is net assessable income. So on this I will include this in the income. So you see, for example, here Mr. Nikhil's share from AOP is 3 lakh and his own income is 2 lakh 50. As Nikhil's share is known, AOP is taxed at normal rates applicable to an individual. Mr. Nikhil's total income will also including this AOP share will be 5 lakh 50. Tax payable is whatever, 23,400. Now, what is the average rate of tax that I paid, guys? 23,400 divided by 5 lakh 50, 0.0425%. 0.0425%. This is the average rate of tax that I paid. Right? How much? Yeah, 4%, no? 4.25. Yeah, this mistake, 4.25%. 4.25% is my average rate of tax. So you tell me one thing here, do you think it's logical? AOP BI also normally it pays. From that total income of AOP BOI, I will subtract the bricks and then I will divide it among the members. Then I'll add back the bricks pertaining to that person. And then I will subtract the capital interest on capital already paid, because that for that anyway the AOP has paid tax. So for me, I am also on that, that's my income which will be included in my total income, and I am paying tax under 67A procedure, which is the case in 1, 2, 3, 4 where there is double taxation. 1, definitely there is double taxation here. What do I do? Sorry? Don't ascertain the share. What do I do? So guys, here there is a rebate. Under section 86, read with 110. Rebate. What is the rebate? Rebate is average rate of tax they will compute, and that percentage there will be a rebate. See this example. 23,400 divided by 5 lakh 50 is 4.25%. What is the share of income of AOP? 3 lakh. It's like telling on that 3 lakh I paid an average rate of tax of 4.25%. Basically, this plus this put together I paid tax, I agree. But this overall is 4.25%. That is nothing but 4.25% of this and 4.25% of this, basically. That's how I paid. 4.25% represented by these two items. Now they are trying to tell very simple, you aggregate everything, pay tax, and that based on the average rate of tax, remove that portion already paid. Logical. So it is 4.25% of 3 lakhs, which is 12,764. So from the tax that I have paid 23,400, I have to remove 12,764, and balance only is taxable 10,636. Sorry? No, nothing like that. So some example, AOP, total income of the member, This is other than AOP share. Unfortunately, the AOP rate is determined by how much each individual member is earning. So, if Mr. X is not earning anything, Mr. Y is not getting anything, what is the total income other than AOP share? Nothing. Third one, XYZ Limited is earning 20,000 rupees. What did I tell you? You will pay normal rates only if the other members do not have any income beyond the basic exemption limit. Company will have basic exemption limit? No. So here there is no concept of basic exemption limit for company. So what is the AOP taxed at what rate? Yes, AOP is taxed at MMR. Since AOP is taxed at MMR, how much will the individuals be taxed? Nil. Right? So member share exempt. Member share is exempt. AOP will be taxed at MMR, member share exempt. No need to pay tax for member, no tension. He will be exempt. Right. Then, this is clear, guys? Second one, second example. Total income other than AOP. First one, Mr. X, Mr. Y, Mr. Z. Nil, nil, 30,000. Now, not Mr. Z, let me change, sorry. XYZ company I'll make, XYZ company. What is the rate of AOP taxation? Why normal rate? Does anybody have taxable income? No. So, correct. AOP taxed at normal rate. If AOP is taxed at normal rate, member share taxed at members' hands. But will I get rebate? Yes. Rebate is allowed. Simple. Rebate is allowed. Third, association of person formed by company A, company B, and one foreign company. Total income other than everything is nil. What will you do? Sorry? Member share is known. Normal rate. See this, see this, see this. Here is a point where any member is taxable at a rate higher than MMR. Have they told they have taxable income, no tax, nothing? Their only dialogue is what? Where any member is taxable at a rate higher than maximum marginal rate, chapter close. Did they say you should have income? No. These are the hidden points. Did they say you should have income? No. They just said what? Where any member is taxable at a rate higher than MMR. I don't have to see this column only. I should see here. Company, foreign company. Which is the company which has, what do you say, higher tax rate? Foreign company. Sorry? Surcharge, cess, all that put together. So, in this case, will case 1 come here? Your, what is case 1? Which says that you should, if you do not have any total income, no, that case will not come because it's a foreign company. That's why point 3, deadly. So, answer, AOP is taxed at, for company A and B, MMR, for foreign company more than the MMR, that specific rate. Individuals, no tax. Individuals, will you get tax? No tax. Very simple. Individual will not get any tax. So that is this concept of what? AOP. Apart from that, some miscellaneous points are there, quickly we'll go through. So in the exam, these are the areas which they can ask you. Dissolution or discontinuance of AOP. Where any business or profession carried out on AOP has been discontinued or dissolved, assessing officer will make an assessment of the total income of such AOP as if no such discontinuance or dissolution had taken place. In such a case, all provisions of the Act, including provisions related to levy of penalty, shall apply to such assessment. So, as if nothing has happened, you will check. Every person who was a member of the AOP at the time of such discontinuance or dissolution, including the legal representative of the deceased member, shall be jointly and severally liable. So, every person who was a member of the AOP at that time will be jointly and severally liable here also. Liability of the legal rep shall be restricted to the value of the estate inherited from the deceased member. So yes, thankfully, whatever it is limited to only whatever is the value of the deceased, value of the estate inherited from the member. Everything else cannot be taxed, only that value. If discontinuance or dissolution takes place after any proceedings, and the proceedings can be continued from a stage at which the proceedings stood at the time of discontinuance or dissolution. So, if basically assessment proceedings are going on and the company goes for the AOP goes for dissolution, so proceedings can continue at a stage at the time of discontinuance, yes. So, your assessment proceeding going on, and from middle somewhere they are going to dissolve. So, till then you can obviously go for the, what do you say, proceedings. That's about it. Then if you see, let's check some, if there are any case studies. Come to the case studies. Good morning. So let's begin. So in the previous session we did other things. Now today we will start off with a new concept, business trust. 100% question will come from business trust, charitable trust, political trust, all put together. These are all assessment of other entities. We started off with AOP BOI. We'll do business trust, charitable trust, then political trust, then firms. All these are important. Firm is also important for November 24 because in May, the next year, they have changed the limits of remuneration, right? So that is why it is of utmost importance to do that as well. So business trust, you can reduce the AC if it's okay. I made it 22. Oh, super. Reduce will include, yeah. Okay. So let's begin, guys. Business trust, investment trust, securitization, that's fine, but we'll just do the business trust concept. So what is the concept? Once you understand the concept of business trust, other things will be very, very simple. So a guy from Singapore, he wrote a concept paper that we need to have something called as, real estate investment trust, and also infrastructure investment trust is what he gave an idea. And one of the largest realtors, or basically the people who are investing in this real estate, one of the largest in the world is Blackstone, right? So generally, how do mutual funds? So the Singapore guy who wrote down his concept paper was very simple. He's like, mutual funds. How do mutual funds work? Basically, you will invest in a mutual fund, and mutual fund, there will be a fund manager who will put that money into various companies, and then he will earn money for himself also and for the fund as well. But what will you get as an investor in the fund? You will get something called units. You will get units. So on similar lines, this guy also wanted to start something. So let's say for example, there is a mall, let's say Rajini Mall, you have a mall, and share capital is, let's say, 10 crore. Now you want to buy a mall. How will you buy? Basically, you will have to take a loan. So you take a loan of, let's say, around 290 crore, share capital 10 crore, loan 290 crore, and then you will, that money goes into the bank account, and eventually you will buy a mall, 300 crore. Very simple. But the concept of business trust is such that, so these guys, what he created was very, very interesting. So rather than, same way like mutual fund and same way like this company, rather than all these things, how will it be if this, I create an entity called Real Estate Investment Trust. I'll create an entity called Real Estate Investment Trust, and what will I do in that entity? I will invite people to invest in that. So every middle class people, all of us, what is our dream? To own one home, one car, one home. Generally, that's been the norm since forever. So the thing is here, how about owning many homes, not just one? So, but not the entire home, but some units in the home. So that was the concept of this REIT. So REIT is at the center, and the units are being, the money is being invested from various sources, and in return, what will you get? You will get units of business trust. So Real Estate Investment Trust is a business trust, whereby that will be at the center. Full concept I'll tell you, I'm just giving you overall. So when you enter, when you put in the money, I will give you units in return. Now with that money that I have, what will I do? I would probably buy the mall itself, or I would buy 100% shares of the company which owns the mall, right? I will buy the shares from the owner of the company. So owner of the company obviously will be owner of the mall will be obviously some company, and that company also will have a promoter who will have majority stake. I will buy that majority stake, or I could buy the mall itself, no problem. If I buy the other company which owns the mall, then what will I do? Of course, I will ensure that the malls are running properly, and what is the main income of the mall? Revenue, the rental and etc. So that eventually will be given back to the investors. Or if I am actually owning the mall itself, the asset, then of course the rental income will directly come to me. So this was the structure. This is a basic overview, but we have to go more in depth. So this is the full structure of Real Estate Investment Trust. I'll give you time to write it down because it's very, very important. And guys, there has been amendment in 2023 and 2024. We will not discuss what is 2024 amendment, but amendment here, amendment in charitable trust, amendment in partnership firm. That's why these things we cannot skip. And of course, appeals and revision, quickly we'll finish it off. Then little bit of international taxation, and there have been amendments in TDS. The next couple of days, this is what the idea is, to finish all these things so that the smaller items can be handled easily, no problem. Predominantly all the major stuff is over. We did yesterday liquidation, buyback also. So those small things will actually not take time. These are the heavy duty stuff, and of course we have actually finished the major heavy duty areas already, but these are also very much important, and this will also consume time. It's not going to be like quick, whereas the other topics, of course, yes. Anyway, so now the business trust, I'll explain the structure. I have numbered it. It becomes very easy for you. After I finish it, you can write down, no problem. So first and foremost, guys, point number 1, from the investors, I will take funds. Who will take business trust? Business trust. That is called Real Estate Investment Trust. And in return, what will they give? Units. That's very clear. In return, they will give units. Point number 3, this business trust will directly invest in the land and building. What? They will invest in Rajini Mall directly. I am buying the mall, right? What will I get from Rajini Mall? Rental income. So that rental income will be an income for the business trust. Till you are clear? First root of source of income is what? Direct rental income from the mall. So till here it's clear, right? Yes. 4 done. Next, with that rental income that I get, I will share the rental income with the investors. So as you can see, Real Estate Investment Trust is just a conduit. Conduit means it is just a place in the middle. It's like a channel. That's all. Ultimately, it's like a special purpose vehicle, so to speak, SPV, where I am just there, and through me everything is happening. That's it. So I am not taking any money. Maybe a little bit extra I am making, that's fine, but Ultimately, I am just like an intermediary between investors and the mall in this example, right? So this REIT is what? A special purpose vehicle, so to speak. But anyway, this this also is called a special purpose vehicle, but actually there will be one more special purpose vehicle. Ultimately, business trust is like an intermediary, right? So now this is done, 5 done. Next, point number 6. There is one more company, DLF Limited Builders. DLF Builders will be there, in which there will be an owner and all those things. Now DLF Limited has 100% shares in a real estate company of their own called DLF Realty. Now DLF Realty, what do? They all invest in land and building, and they do real estate business. You know that. Now, as I told you, rather than buying the mall directly, I am going to buy. Next is what? Point number 6. Shares of DLF Limited are being bought by this real estate investment trust. It could be 100%, 60%, 70% full shares. And in exchange for the shares, what is the REIT giving the DLF Limited? Units. Units in where? Of units of REIT. So I am buying the shares. Since I am buying the shares, these people are parting with the shares. They need to get some consideration. What consideration they'll get? Units of REIT. Very simple. So this is point number 7. Then apart from that, that is one part. Apart from that, guys, they will also give loan to this DLF Realty Limited. They can also give, they have a lot of money, they have money from these investors. So one route of thing is what? They'll directly invest in the mall. Second route of income is they will invest in shares of DLF and get the, give the units in exchange for shares, exchange of asset. And then on the other hand, they will also give loan, point number 8, also give loan to what? The special purpose vehicle, which is DLF. There will be a special purpose vehicle and then DLF Realty. So you can either have multiple companies in between, or you can directly invest in DLF Realty. That is up to the business trust. They'll plan it accordingly. Through multiple companies they can do, or directly they will invest. That's their choice. For having given the loan in DLF Realty has to pay something. What is that? Interest. So interest will be paid to REIT. So what is the third source of income? Interest. First source of income, rental income. Second source of income is the interest. What is and this interest also will be given back to the investors. What is the third source of income? Obviously, since I have invested in the shares of DLF, I will also be getting dividend. DLF will have many such companies which is into real estate. So I will also get what, guys? Dividend from where? DLF Realty. So what are the 3 sources of income? And that dividend also I will pass it on to the investor. What are the 3 major sources of revenue? First is, I'll just mark it here. First is the rental income. Second is the interest portion. Third is the dividend. And everything they will be sending it to the investors. Very, very simple. Did you understand the full structure? Now, what is this chapter all about? Taxation of business trust and taxation in the hands of the investors. That's all. So if you understand how first of all is business trust taxed. We saw AOP, BOI. If AOP is paying money, the members will not pay. If members are paying, AOP will not pay. There is only one case where both will pay, for which rebate is given. We saw that. Similarly here, if business trust is paying, will investors pay? If investors are paying, will business trust pay? Is there a scene where both are paying? Will there be a rebate? Same. The concept is the same. Same with partnership firm also. The partnership firm is paying, will the partners pay? So ultimately these other entities are very easy, but of course important. Charitable trust is slightly different. So this is the idea, guys. So very simple. There are 12 items here, and ultimately these are the things. So if you could just copy this structure, if you understand now, then the entire chapter becomes a breeze. So I'll just, and if you write it down, it will actually help you understand the entire structure. So I'll just make it full screen for you. The entire concept of business trust. Are you able to see? So there are 12 items. I am numbered it also for you, becomes very easy. Online people, good morning. Once you understand the structure, guys, it becomes very simple. Anything you didn't understand, let me know. The screen is not cut off, right? It's coming properly. Left side, okay. So once you write and then understand, you will understand the structure of business trust, then we can go one by one quickly. Yes, tell me. Generally, yes, it can be. It's actually a trust. But what does an SPV do ultimately? Yeah, so here it is investing. So if you see, it's investing in the Rajni Mall, it's investing in DLF. So ultimately, an SPV is what? It's just a intermediary. So you can call REIT as intermediary. It can invest in other SPVs like that. And it's the structure is open, but ultimate reality is what? REIT is at the center. One mall they can buy, many malls they can buy, many homes they can buy, and they can buy shares in many companies, and they can give loan also. Ultimately, the overall structure is it can give loan, it can directly invest, and it can invest in shares of other companies. That's it. Whether it is through various SPVs, all that, not really. Yeah, sure, I'll do it right now. So you see, business trust is at the. Are you done writing? Yeah. So quickly, I'll just revise again, very quickly. So very simple, guys. There are business trust is at the center. So business trust is only looking at what? It's a special purpose vehicle. It could be, or it can be anything. Just basically an SPV does the same thing. It is an intermediary and it will take money from one person, invest in other things. So think of it more like a mutual fund. Mutual fund house which has a what do you say, portfolio management services, and it has a fund manager sort of a thing. So business trust will take money from investors and issue fund units. Now that money, what all can they do? Point number one, they can directly invest in malls, homes, etc., for which they'll get rental income, which they'll pass it on to investors. Second, they can invest in companies which are into real estate, in shares of the companies. Because they have invested in shares of the company, they will get, what do you say, dividend from that. They will get dividend because this company would have invested in the other real estate company. So from there, everywhere they'll get dividend. Third important thing is they can directly give loans to various companies, real estate companies. While giving loans to real estate companies to build homes, they are getting interest. So what are the three sources of income? One is the interest, one is the rental income, third one is the dividend. And all that they will ultimately give to whom? Investors. So in this chapter, we need to discuss what is the taxation of the business trust and what is the taxation of the investors. Actually, investors are getting everything: rental income, interest, dividend. So that is what it is. And one amendment came in Finance Act 23, which is very important, which we will discuss. Yeah, real estate. If it wants infrastructure, it's called InvIT, Infrastructure Investment Trust, which will invest into infrastructure companies. Yes, treatment is the same. So yes, in order to increase investment, SEBI has created InvIT and real estate. It's an investment vehicle, see, SPV, created for making investments in real estate properties, and InvIT is an investment vehicle for making investment in infrastructure properties. Yes. Taxability in the hands of business trust and investors. Let's see. Taxability in the hands of business trust and investors, guys. 115 UA. The special taxation regime under 115 UA of the Act inter alia provides a pass-through status to business trust. Means what? Basically, I am just a special purpose vehicle. Money will come through me, go to the other person. For me, no tax. So, general rule, business trust will not pay any tax in respect of interest income, dividend income received by the business trust from a special purpose vehicle in case of both REIT and InvIT. So, what did I tell? Business trust is a pass-through vehicle and it can receive from other SPV. In this example, DLF Realty is an SPV created for that because the REIT wants to invest in that realty, in the DLF Realty Limited. So, there could be many SPVs. You can go through many SPVs. That how the structure is formed, we don't care. We should understand the ultimate objective: three types of income: rental income, dividend income, interest income. Chapter close, right? So, provides a pass-through status to business trust in respect of interest income, dividend income. One thing is not there here. What is there? Rental income. Rental income, this is interest income, dividend income for REIT and InvIT. under 1023 FC. So interest and dividend is exempt for business trust under 1023 FC, and rental income is under 1023 FCA. That's all. So what are the exemptions for business trust? Interest income and dividend, interest income, dividend income. How will I get interest income? Interest on loan. How will I get dividend income? Investing in the shares of other companies. So for this, it's exempt under 1023 FC. Rental income. How will I get rental income? Directly buying that particular mall, as I told you. Rental income is under 1023 FCA. In other words, these incomes are exempt in the hands of the trust. Under section 115 UA, these are taxable in the hands of the unit holders. That's all, very simple. All the three incomes, since they are passing it on to the investors, for investors it is taxable, for business trust it is not taxable, which is the exemption section 1023 FC, FCA. Right. One by one, dividend income. When dividend income received by the business trust from the SPV is distributed by the business trust to the unit holders, what will happen? Here, where dividend income received by the business trust from the SPV is distributed by the business trust to the unit holders. Now, SPV has exercised the option under 115 BA. What is that 115 BA? Special tax rates for companies. So, this SPV, that is in this chart, this SPV, DLF Realty Limited is an SPV in my example. This SPV has asked for special rates of tax. Companies 115 BA special rate of tax is lesser rate or higher rate? Lesser rate. So this company is paying less. When dividend income received by the business trust from SPV is distributed by the business trust to the unit holders, taxability in the hands of the business trust, guys, exempt. That we have already seen. Business trust exempt. Taxability in the hands of unit holders, taxable. Obviously, it is taxable. However, the business trust is liable to deduct tax on such income under section 194 LBA. Now, money is coming to whom in this structure? You see, money is coming to business trust, and business trust is now giving it to the investors. Rental income, interest, dividend, 5, 10 and 12. So, should they deduct TDS? Yes. 10% in case of resident unit holders, 10% in case of non-resident foreign company holders. Right. So, 10% they have to deduct TDS. This is when the SPV has exercised the option under 115 BA. So, very simple, guys. The company is paying less tax, yes or no? The company, in my example, DLF Realty Limited is paying less tax. Since they are paying less tax, I am giving no benefit to the unit holders. Right. So, basically, who will pay? Business trust though is a pass-through vehicle. Business trust, no tax. But since 115 BA, SPV has exercised the option where they have taken less, they have paid less. So, there is no benefit to the investors also. Investors also have to pay the same thing. Now, the concept of fractional real estate has come. Let's say you want to own a villa in Goa. Can you afford 2 crore, 3 crore villa? I want 4 villas. Just in dreams, we can afford villas. Like 4 villas, 5 villas I want. But guys, shockingly, you can actually own 5 villas. It's a concept of fractional real estate. Means what? Each villa is 1 crore. What is better? Me asking you to pay 1 crore or me asking you to pay 10 lakhs? 10 lakhs. So, I will divide that villa into 10 people. I'm not even joking. There's another company doing this already. So, one villa is divided into 10 shares. That's all. So, one villa is owned by a company. I will create a special company only for the villa. Right? So, how many shares will be there in that? 10 shares. Each share value will be 10 lakh rupees. That's all. So, you can buy 1 share in that company for which you will get part of the villa. How part of the villa? Because you are spending 10. Basically, there will only be 10 owners per villa. And the owners do not own the villa directly. They own shares which will own the villa. Beautiful. And now in 365 days divided by 10, you will get to stay in that villa for 36 days. It's already happening as we speak. It's called fractional real estate. So going forward, that taxation also will come. But I'm saying this is similar to REIT only. That they are also doing the same thing. They are opening a company and investing in real estate. So you will own shares in that company and you will get 36.5 days or 36 days. You can spend any time in that villa. You can choose to live there. You can choose to give it to your friends. You can give it as an Airbnb. You can directly earn rental income also from that. 36 days allotted to you. That's the concept. Holiday home, instead of owning and crying that I own and maintaining nothing, they'll only do everything. So basically, you will also have to pay some maintenance. If no maintenance is there also, from whatever they will actually on 365 days, actually the plan is around 60 days, 65 days, they will rent it out. And from that only they'll do the maintenance. One day I can charge 5,000. In Goa, 10,000 also I can, if it's a huge villa, 10,000 I can charge. So 6-7 lakh they'll earn like that only, which will take care of the maintenance. Remaining 300 days, 30 days per person they'll give you. You can do whatever you want in that. Amazing, right? So those new concepts of taxation are coming. Now you need to represent the company, you need to represent the shareholder. For shareholder, it's like capital gain or IFOS. He's owning the shares, capital gain, no IFOS. He's owning the shares there. Only if he sells the shares, otherwise no, nothing. Think about it, nothing, no tax impact only. But whereas the company, of course, they are earning some money and all that. What I am saying is here also is the same. Here instead of that, SPV again, special purpose vehicle, DLF Realty, which is investing in various companies, and I have what? Shares in that company. So in this case, this is, I'm only talking about dividend income. I invest in shares of that company, company is giving me dividend. And if SPV has exercised the option under 115 BAA, they have paid less tax. Fair enough. So what will be taxable in the hands of the business trust? Exempt. Unit holders taxable. Why? Obviously, because you have paid. I mean, the company has paid less. So will I get TDS also in this? Yes, 194 LBA. Now, what if the SPV has not exercised the option under 115 BA? Which means they will pay normal rates 30%. If they pay normal rates 30%, the issue is closed. Dividend is taxable or exempt in the hands of shareholders. Exempt. Business trust also exempt. Unit holders also exempt. So whether business trust always exempt. Unit holders, whether it's exempt or not, depends purely on whether the SPV has opted for 115 BA. So see the next point. And dividend income received by business trust SPV distributed by the business trust to the unit holders. SPV has not exercised option under 115 BA. Once again, taxable in the hands of the business trust, exempt. Taxable in the hands of the unit holders also exempt under 1023 FD. We saw 1023 FC, FCA, that is for unit the business trust, and for unit holders it is 1023 FD. Yes. Which one? Tomorrow they can change, no? As of now it's 10. Tomorrow Nirmala madam will change. Resident 20%. She'll change. And the non-resident can be made less. So rates are always separately for resident and non-residents. Very simple, guys. So resident 10%, non-resident also 10%. SPV has not opted for, has opted for. Very, very simple. This chart you can follow. When SPV has not opted for 115 BA, dividend is exempt under 1023 FC for the trust and for exempt for FD and the unit holders. Here it is exempt, here it is taxable under 115 UA. No need to remember the section numbers and all, you can just say taxable. I will get to know, no, because I will, when I'm investing, when the REIT is investing, they will exactly know what all companies they are investing in, and of course I need to know, understand their taxability structure also. Everything they will take it on record. It will be a proper contract. Yeah, so they will know. So ultimately, if they have opted for it and they are opting and filing it at a lesser rate, then you will have to pay tax. This company wise. So one company will get 10%, 1% from one company, whatever money you are getting taxable, one company not taxable. You will get the this thing, no, report. You will get the report of investment when you do a PMS or whatever. You will get a report. In that they will say exempt. In there they will say taxable, like that. So they will get the entire structure. So for me, honestly speaking, investors don't care. So you would have seen how much you will see, because you are all chartered accountants and aspiring CAs, you will see. But how many investors do you know will even check their PMS statement? Hey, how much money it made? 50 lakh I invested, 57 lakhs has become, wow, awesome. There's a capital gain in the next 2 months. Then they'll go brag, 50 lakhs has become 57 lakhs in 2 months. And the share market fall, gone. Right? So it's that's like that. And then capital gain calculation also they would have given. Oh, this much capital gain I have to pay. That's it. They don't even care about the calculation part. That's what I'm saying. So it's immaterial actually. So they don't care unless you are hardcore investors. Then your doubt is cleared. Yeah. Cool. So that's what it is. So each company wise I will get details, guys. It's not just real estate businesses will invest in various companies. No, everything I will get to know. From this company has opted for 145 or no tax, like that. Excuse me. So next, interest income. When interest income received by business trust from SPV is distributed by business trust to the unit holders. What is taxability in the hands of business trust? Again, guys, interest income I am getting. Interest income exempt under section 1023 FC. But interest income unit holders definitely taxable. Was interest I am getting. If you see, very simple, the company who is paying the interest will get a deduction in income tax in 36, and it is passing through business trust. You have to tax it somewhere. Where will you tax? In the hands of the unit holders. Very simple. Tax of the unit holders will tax. Then TDS again, 194 LBA. 10% resident, 5% non-resident. Tomorrow they can change. So very simple. Third one, what type of income? Rental income. Rental income from letting out of real estate owned by business trust being a REIT. Tell me, same stuff, guys. Rental income in the hands of business trust, exempt. In the hands of unit holders, taxable. Why? When I am paying rent, I will claim it as an expense under 36, the company which is paying rent, and ultimately it has to go somewhere. I have to tax it somewhere. Where will it be taxed? Business trust pass through. Finally, it will be taxed in the hands of the share. So shareholders, or rather unit holders. Unit holders are getting 3 types of income. Interest income, always taxable. Then this one, rental income, always taxable. Dividend income depends on the SPV. If they pay normal rates, no problem. If they pay lesser rates of tax, then that I will not give you benefit there also, and here also, no. So here what they will do? They will say, nothing doing, boss. What will you do? Pay tax. What are some special types of income that you will see? What will be some other type of income, guys? What if that Rajini mall that I was telling, no, what if I sell off that mall? Possible or not? Can I sell that mall? Rajini mall, guys, which I was talking about, can I sell that mall or not? Can I sell it off? Yes, definitely I can sell that mall. Okay. See if I've written it somewhere here, otherwise we'll discuss. Yeah. Generally, when you try to open it slowly, more sound will come. That is the dangerous part. Should not try to open slowly at all. Dangerous. Should be spot death, no ICU. Accident spot. Right. That's what it is. I thought sound is coming from outside. Yeah. What are you even eating? What are you eating? Chocolate. Bun. Okay. But bun you can finish it fast compared to the amount of time it took to open that cover. Right? Yes. Eat it, man. No problem. Right. I thought the water was dripping from some other side. That was a sound, slow sound. Right? Yes. Okay. Yes. So, other type of income that we have is what, guys? Disposal of asset by business trust. I'll sell them all only. Then in that case, guys, the building is owned by whom? Business trust or unit holders? Business trust. They are selling the assets. So, capital gain will be in whose hands? Business trust. Why will it be in the hands of the unit holders? Am I giving anything in return to unit holders? No. So, taxability in the hands of the business trust as follows. Taxed under 112A or 112. They own shares also. Business trust owns shares in the company. They will dispose it off. Yes, in that case, it is taxable in whose hands? Business trust. STCG 111A. So, this is sale of shares, sale of other like mall, building, anything. Now, this business trust is investing in something else, not real estate. It is investing in futures and options, assume. Then it's investing in some other high risky investments. This is not allowed, but if you do, you only tell me. I should punish them. How will I punish them? Maximum marginal rate, deadly. Taxability in the hands of business trust, taxable at MMR 42.744%. No mercy. So, basically you cannot invest in other things. It is not a viable option. 42% tax you have to pay. So, they are not saying don't invest. They are saying if you invest 42.74 MMR. Taxability in the hands of other unit holders, exempt. So, what are the two incomes which are derived only in the hands of the business trust? One is capital gain, one is other income. That's all. Yeah. Yeah, if they sell their stake, units if they are selling, capital gain, normal capital gain. It's like any other investment. When you sell mutual fund units, don't you have to pay capital gain? Yes, same. It's like, think of it as units of mutual fund. That's it. There is no other difference. Now, Nirmala madam, very smart. All these things were there, right? Now, I told you here in this example, who has given the loan? REIT has given the loan for which they are getting interest. But for this loan, who has given the money? Investors. Investors has given money. What were REIT doing? They were paying back the interest here. See guys, when the SPV is paying the interest, they'll just pay the interest or they'll pay the principal amount also, repayment. Principal amount, repayment. Here I have taken the interest, but SPV when they repay the principal, that principal also has to be transferred to investors because REIT is just a pass-through vehicle. Are you understanding? So, I am giving you a loan, you give it to DLF. DLF is paying you interest you are passing on to me, I am taxing it. DLF is paying back the loan, and that loan repayment also you are passing it to me. Of course, because I have given the loan indirectly by investing in the units. Now, Nirmala madam could not take the fact that interest is getting taxed, but what about principal repayment? Have you ever heard of taxation on principal repayment? No. Nirmala madam also hadn't heard. So, she inserted in Finance Act 23. So, Finance Act 23 major amendment was what? Taxation on principal repayment. So, instead of 3 types of income, it became 4 types of income. For whom? Investors of business trust. One is rental income, and interest, Third one is dividend. Fourth one, principal repayment, deadly. That was a major amendment in Finance Act 23. Principal repayment, that is the fourth point. So I think it's not there, so I will write down, don't worry. I will make you write some examples. You stick to the examples, more than sufficient. This is applicable from our November exam actually. So that's why I am saying definitely it will come. Why? I mean, high chances of coming for sure, because these are all amendments. Taxation of repayments other than income to unit holder. Other than income. They said other than income. What is income? Interest, dividend, rental. Apart from that, what is the other income? Principal repayment. That's it told in the memorandum. That principal repayment are not being taxed, and I am very restless, so I will tax. Right? Yes. So in case of distributions made by business trust to the unit holders which are shown as repayment of debt or capital reduction, same will be taxed in the hands of the unit holders. She created a new section in IFOS 56 to 12, right, and said yes, it is called specified sum, excess payments. Any specified sum received by unit holder from a business trust during the previous year with respect to unit held by him at any time during the previous year. So some formula she gave, it's very easy, we will discuss it, don't worry. So what is this? First one, she said ultimately specified sum is what? A minus B minus C, which will be deemed to be 0 if sum of B and C is greater than A, obviously. We will discuss. So A is what? Aggregate of the sum distributed by the business trust with respect to such unit during the previous year or during other earlier previous years to such unit holder which holds such unit on the date of distribution, or any other unit linked at any time prior to the date of distribution which is not in the nature of income, not chargeable to tax. Means what they are telling? Income other than FCA, dividend, interest, then it is not chargeable to tax. Amount at which unit was issued by the business trust. See, amount charged to tax under this clause in any earlier previous year. So very simple guys, don't worry, we will discuss that here. Mr. Narendra, these examples you can write down, but I will explain, then I will give you time. These examples are amendments, there is nothing else. Over, this is only business trust, over, chapter over. This is the final one. I will give you time, don't worry. So hear me out. Units of business trust 220 rupees, okay, and year number 1 to 10 they distributed 200 rupees per unit overall as debt repayment. Okay, so basically units of business trust, what is the rate? 220 rupees, and the thing is they have distributed 200 rupees per unit overall as debt repayment. So in the so many years put together they have distributed this 200 rupees per unit overall. Now first and foremost, what is the cost of acquisition for the unit holder? I invested 220, I got back 200. I invested 220, I got back 200. Right? I invested 220, I got back 200. Is there anything extra that I got? No. When will I tax under 56 to 12? Only when I get anything extra. But very smart, Nirmala madam, I have invested 220. How much you got back? 200. So what is the actual cost of acquisition? So what she did was, because tomorrow when you are selling the asset, we are selling the units tomorrow, what will be deemed to be cost of acquisition? 220 or 20 rupees? 220 or 20 rupees. What is the unit of business trust? How much did I purchase it for? 220. How much repayment I got over the years? 200. Distributed as debt repayment. How much debt repayment I got back? Basically I invested 220, of which I am getting income and all that, that's fine. Income I am getting, dividend I am taxing that and closing it. But debt repayment also I got 200 rupees back. What is the effective cost? Nirmala madam changed section 48 and she said cost of acquisition will be, you should reduce the amount you got as repayment. So instead of 220, she made it of the cost as 20 rupees readily. So tomorrow when you are selling, will you pay higher capital gain or lower capital gain? Higher. So first change is what? From cost of acquisition, 200 will be reduced. Amended section 48. You see here, that is what is given. Computation of cost of acquisition. As discussed in capital gains chapter, we didn't discuss because I want to do this. The cost of acquisition of units of business trust shall be reduced by any sum received by unit holder from business trust, not in the nature of interest or dividend, that is a return on investment, that will not be deducted, not chargeable to tax under 56(2)(12) and not chargeable to tax under 115 UA. So you will not reduce, you will reduce these items. First one, not in the nature of interest or dividend. Not in the nature of interest or dividend or 23 FCA, rental income. So my question to you is, what is not in the interest of dividend or interest of rental income or interest of this thing? It is debt repayment. Debt repayment. So debt repayment is not chargeable to tax in any other section. Instead of that, what am I doing? Reducing from, instead of taxing, what am I doing? Reducing from the cost of acquisition, readily. So the first change is I am reducing from the cost of acquisition. So 220 minus 200 I am doing. So tomorrow when I am selling it at 1000, earlier I would have taken cost of acquisition 220, now 20. Capital gain I have to pay. Next change is 56(2)(12). 56(2)(12) she said, very simple. Point number A you see now. Aggregate of the sum distributed by business trust which is not in the nature of any income, which means point number A should be debt repayment. What is debt repayment? 200. Point number B is what? Issue price of the unit. What is that? 220. Point number C, if you have already paid tax on 56(2)(12) before, have I paid tax in this example? No, so 0. A minus B minus C. Is there any extra benefit I am making? No. If point number A was, 230 and point number B was 220, then extra I am making. If principal repayment was 230 and investment is 200, then okay, 30 rupees is 56(2)(12). But here am I making anything extra? No. One part is already reduced from the cost of acquisition. Am I making anything extra? No. So what will be 56(2)(12)? Nil. What will be 56(2)(12) IFOS taxation? Nil. But what is the other implication? 200 rupees will be reduced from 220 rupees in the cost of acquisition. Is this clear? We will do more examples. Write down. We will do more examples. One by one, slowly. We will take scenarios where it is more. Then we will take scenarios where 56(2)(12) is actually paid in the last year. 3-4 examples and we are done. This is the main change. Other things, no change in business trust. Main change is this only. Which one? So tomorrow when you are selling it at 1000 rupees, which one? From where? Correct. Reimbursement of what? Yeah, but she is taxing it by reducing the COI. It's not fair. Nowhere I said it's fair. Is it fair? No. I invested it, I am getting it back. So she is telling, okay, you are getting it back in other return. Interest you are getting, dividend you are getting, that I will not tax. That anyway you are paying tax. Here also you pay. So she is actually telling, you know what, actually you invested only 20 rupees. Yes, she is taxing the investment, as simple as that. You call it fair, unfair, she knows that is the future. Real estate investment trust is booming like crazy. So this is a additional source of income indirectly. How? By reducing the cost of acquisition. She is taxing the investment, no doubt about it. Yeah, then slightly they are putting all these things, but still people are investing, but the returns are crazy. That's why. So even if you pay your taxes, if you are getting good income, see, the real estate sector is booming, and middle class mindset is very simple. We want to own homes. This is one more area where CAs can practice consulting in real estate. So for that you need to have RERA knowledge, which ICA has helped a lot by removing in the syllabus. Correct? Yeah. So RERA should be there, knowledge should be there. That's why lawyers etc. are coming and sweeping it under our feet. All people are practicing in RERA is, most of them are lawyers. So they are quitting their practice and getting into RERA. So it's a niche area, and of course RERA is one part, and real estate investment. So it's you may say I'll tax all these things, but if I tell you can get to own 10 homes indirectly, why will you say no? You can walk into a mall and say I own this mall, one share, but I own this. Yes. So they are playing on the minds of the people, even though they tax it. So your 100%, is it fair? I'm taxing the investment actually. Correct. So, but the thing is, in other cases, will you get like that? In other, like for example, mutual fund units and all that, that is purely the return that you are seeing, that capital appreciation. But here they are saying that eventually you will get back that 200 rupees through loan repayment. So if you think from our point of view, as he said, it's fair also. Like I invested 220, I got back 200. Ultimate cost is how much? 20. Then the 20 rupees you are getting interest also, dividend also, but that you tax, rental income also you tax, you pay tax, what you are getting. But you have that whatever money you got back, again you can invest somewhere else, right? So that's why from the cost I am reducing. So this was the part which was missed out till 2023, imagine. So that's why. Both points of view, man. One point of view says it is unfair. One point of view, it is fair. Ultimately, we need to see. But this concept is very new. It's not, nowhere I have seen like this where they will reduce from the cost of acquisition, that to the investment portion which is repaid. People were repaying in other ways, now it's not possible. Are we done? Next example. Let's say in year 11, extra 30 rupees was given back, which was other than interest, dividend or rental. They are not talking only about loan repayment, they are just saying other payment. So if you pay in any other, by any other name, that is called other payment. It can be loan repayment, it can be capital reduction also. Capital reduction also. You invested 200, I am giving you back as loan repayment or capital reduction, your choice. So tell me guys. So already, what is the cost of acquisition? 220. How much return I got? 200 I already got. 30 rupees I am getting. 230 is subtracted. I invested 220, I am getting back 230. What is my cost of acquisition? Nil. Tomorrow when I sell the units, what is the COA? Nil. You will do indexation on nil? No. That's what I am saying. There is no point. So basically, entire amount will be taxable later. IFOS. IFOS is what? Point number A. Other income that you have received. 200 plus 30, 230. B, cost of acquisition. What is the actual cost of units? 220. C, have you ever been charged under 56,212 before? No. So the specified income is what? 230 minus 220, 10. This 10 rupees is extra. That will be charged under what? IFOS. It's like I bought a asset for 1 lakh. It is in the block. Now the entire block was sold for 1,10,000. That's the only asset in the block. So that 10,000 extra was capital gain, if you remember, and the WDV becomes 0. Here cost becomes 0. Extra 10 rupees charged as IFOS, not capital gain. From this angle, if you see, okay, it's fair, you may think, right? Yes. So 56 to 12, how much? 10. year length 30 rupees. So basically this what is I've already deducted, I've already paid tax on that year, IFOS 10 rupees. And whenever I'm going to sell it, cost of acquisition will be nil, which will indirectly be taxed as capital gain. Let's say year number 12, they will give extra 20 rupees. What will be the cost of acquisition? Obviously, last year only it was nil, continue to be nil. 56,212, how much will it be? What is the overall amount that I have received? 200 plus 20 plus 30, 250 minus 220 is the investment, minus I have already paid tax on 10. So this year I will pay tax on 20. Simply that formula looks very fancy. Nothing is there. This only, very simple. That is the main change for November 24. Which one? Yeah. Same. Period of holding is the same. Yeah. Correct. This business trust, why it is important is when I am selling the units of business trust, if it is listed or unlisted in Finance Act 24, the period of holding has changed and the rates have changed. So they can ask you a question on business trust and then say the units have now been sold by the SSE, calculate capital gain. Capital gain, same whatever we have discussed now, no change. I am saying in Finance Act 24 they have changed. Period of holding for business trust, what is it now? 36 months. So that has been split into listed and unlisted, completely different. Rates also have changed. So that's why I am saying business trust, the capital gain calculation they can ask, it's like any other units only, but you have to calculate it at 36 months. That's all. So amount of repayments up to amount at which such unit was issued, not taxable under 56,212. Implication for capital gains, acquisition cost of such units to be reduced by such distributions will lead to higher capital gain if the unit is sold later. Above the issuance price, then the same thing. Then any income distributed by the business trust to unit holder shall be deemed to be the same nature and proportion. One more thing, like if I am getting interest from the business trust, what is my income? Like the real estate investment trust is getting rental income. Rental income according to them is what? It's PGBP or is it house property? PGBP. Then if I am getting dividend, IFOS. So whatever the nature is there for business trust, same nature I will also get, is what I am saying. Any income distributed by the business to unit holder shall be deemed to be the same nature and proportion in the hands of unit holder as it has received by the business trust. Same thing. Business trust is mandatorily required to furnish return of income under 139(4)(e). Same logic, investment trust. Investment trust means any fund established or incorporated in India in the form of a trust or a company. It has been granted a certificate of registration as an alternative investment fund, category 1 or category 2 by SEBI. So, same guys, unit holder will invest in investment fund, which is an AIF, alternate investment fund, and it will distribute the income. And this investment fund will be category 1 or category 2. Category 1 is venture capital fund, infrastructure fund, category 2 is equity fund, debt fund. Now tell me, what will be the taxability in the hands of the investment fund? Concept is the same, taxability varies because I am distributing the income to the unit holder. An investment fund will be a company. It is not a pass-through thing, it will be a company. So they will invest and the returns only they will give and they will make money. It is not some charitable organization. So what is income from PGBP in the hands of investment fund? Obviously, company 30% and 25%, firm LLP 30%, others MMR. Now since I am getting the money, making business properly, I will obviously give some return to the unit holders. I have already paid tax. Unit holders exempt or taxable? Exempt. Any other income will come to the unit holders. Here, income from PGBP exempt. Why exempt? Because investment fund is paying tax. That's why in my hand it's exempt. This is not a pass-through vehicle like business trust. Concept is the same. They'll invest in me, I'll invest in investment companies, and I'll invest in other things. REIT and InvIT concept is the same. That is infrastructure investment trust. That is same. This is investment fund. Any other income, now interesting, any other income for the investment fund is exempt. Are they supposed to do any other thing? No. But if they get any other income, like some extra interest income from any investment that they have made, other than that, or rental income they are getting. Rental income, who's getting? Investment fund. They have some extra space, they have rented it out, some rental income they are making. What is their main source of income? Investment. So even if they invest in any other thing and get money, that's PGBP. But if they invest, if they give their space out for rent and they are getting some rental income, that will be exempt in the hands of investment fund. If it's exempt in their hand, where will it be taxable? Unit holders. Taxable. TDS will be there again, 10%. Non-resident foreign company, rates in force. Rates in force means which rate? 9%. Now, in case the investment fund makes losses, one will be business loss, other one will be other losses, other than business loss. Business loss if they make carry forward or set off by the fund as per the provisions of carry forward and set off. How many years? How many years? 8 years. Next, other losses. Other losses accumulated as on 31/3/19 shall be deemed to be the loss of the unit holders as on that day. Such loss can be carried forward and set off by the unit holders as per the provisions of the Act. In 31/3/19 afterwards they changed it. So now what is the current position? Losses after 31/3/19 to be losses of unit holders provided Units were held by such unit holders at least for 12 months. So they changed that in 2019, saying if you are already holding the units, it will be still your loss. But if you held it for less than 12 months, that losses will be ignored and not passed on to the unit holders, because that was a transitional provision. And losses so deemed in the hands of unit holders shall not be available to the fund for carry forward and set off. So whatever it is lost in the hands of the unit holders, you will not be able to get it. So loss after 31/3/2019, let's say you buy it in 2023. As on 31/3/2019, did you hold it for more than 12 months? No. So what will you do? Yes. Losses after to be losses of unit holders, provided units were held by such unit holders for at least 12 months. If units were held for less than 12 months, such losses shall be ignored and not at all passed on to the unit holders. So they again changed in 4 years ago, but anyway. So here you see, guys, finally here, unit holder invests in the investment fund. Income is distributed to unit holder. PGBP exempt. Why? Because this company pays. Other income taxable. TDS is deducted. All income other than income from PGBP exempt in the hands of investment fund. Rates for PGBP 30%, other at MMR. Other income exempt. That's the only change. Other income is exempt in the hands of the investment fund. For the unit holder, it is taxable. So you see examples. Fidelity, there is no change in investment fund as such, so it's continuing. The only change is in business trust for the year Finance Act 23. Fidelity Investment Fund provided the following particulars of income generated. PGBP 10 lakhs. Other income, income from other sources and capital gain 4 lakh. There are 10 unit holders in the fund for the given previous year. In this case, income from PGBP 10 lakhs shall be taxable in the hands of the fund and will be exempt in the hands of the unit holders. 4 lakh shall be exempt in the hands of the fund and will be taxable in the hands of the unit holders. 4 lakh by 10, 40,000 in the hands of each unit holder. Fidelity Investment Fund provided the following particulars of income or loss for the financial year 24-25. Fund has 10 unit holders. PGBP loss 10 lakh. Income from other sources 19 lakh. Capital losses 6 lakh. So they should consider the loss from PGBP before considering exemption under 1023 FBA. Hence, income from other sources after setting off of business loss 19 minus 10, 9 lakhs, that will be taxed in the hands of the unit holders. 9 lakh by 10, 90,000 rupees is taxable in the hands of each unit holder. Very simple. Assuming all 10 holders were investors as on 31/3/2023, capital loss of 6 lakh shall be passed on to the unit holders for carry forward and set off. If you held it for more than 12 months, carry forward. Otherwise, no carry forward. Lapse. So, what is the loss to be transferred to each unit holder? 6 lakh by 10, 60,000 rupees. That can be used by that fellow carry forward normal, like in the individual unit holder as per the set off and carry forward of losses concept. Third example. Fidelity Investment Fund provided the following particulars of income or loss for the financial year 24-25. Fund has 10 unit holders. PGBP 10 lakh. Capital losses 5 lakh and income from other sources 2 lakh. In this case, PGBP shall be taxable in the hands of the fund and exempt in the hands of the unit holders. Why? Obviously, because they have made profit. However, income from other sources of 2 lakh, that will be exempt for investment fund and taxable in the hands of unit holders. 5 lakh by 10, 50,000. For capital losses, sorry, income from other sources anyway taxable. Income from other sources taxable. 2 lakh by 10, 20,000. What about capital losses? Capital losses of 5 lakh shall be passed on to the unit holders for carry forward and set off, assuming they have held investment in the fund for at least 12 months. 5 lakh by 10, 50,000 per unit holder. This we'll see later. There's nothing much in this. So what is securitization trust, guys? They are special purpose entities set up to undertake securitization activities. What do you mean by securitization? Investment in securities, or what is it? Securitization. Yes, buying the NPS, as simple as that. They are buying the NPS. Basically, they'll buy the receivables, loan receivables. So these companies are again SPVs, they buy financial assets such as loan receivables. And then they are transformed into securities. Exactly whatever happened in 2008 in USA, subprime mortgage crisis. But there was totally unregulated. So what they did was, just the gist of the story to understand this concept. So there, all of us are homeless people. Homeless people went to the Federal Bank of USA and said, we want loan. Now they wanted more and more loan if they give. Of course, the credit facility, if I extend, they felt that of course they will prosper. So banks started giving loans left, right, center to all homeless people without even any credit, nothing, right, with nothing, because they wanted to create that boom in the industry. So sometimes I feel USA, I don't know how it's a developed country. I find them damn stupid. Whichever, wherever war is there, they'll have to interfere. And if you see the president candidates, like such a big country, the president candidates are both are dumb. Either dumb or foolish or arrogant or whatever it is. That's very surprising, right? The thing is, anyway. So I find them very, very stupid in more, and even if you see many of those videos where there are some basic questions of the people, they don't know. So 60-70% of them are like fools. They just, follow the herd, which is how it is actually, unfortunately. But anyway, 2008, this is what they did. So they went, all banks had giving left, right, center, and they created huge receivables in billions of dollars. Now, other investment banks like Lehman Brothers, Goldman Sachs, they came and said, I will buy these receivables from you. So they bought these receivables and the underlying asset became the receivable. Based on the underlying asset, which is a receivable, they created something called as, your securities. They created security receipts. They are called as your collateralized debt obligations. They created that receipt saying that underlying asset is huge and it is increasing and day by day because many people are taking the loan. You buy the receipt. It's just an underlying asset. If I buy a scrip which is based on gold, if the gold value increases, the scrip value also increases. Here, if the receivable value increases, scrip value also increases. Like that, Lehman Brothers, so many people created these things. Correct? There's a movie called The Big Short. Whenever you get the time, watch it. Brilliant. It explains the true story, what happened during the 2008 subprime mortgage crisis. There are only very few people who understood that this is going to burst. The bubble is going to burst very soon. And they took a reverse position. They took insurance against these stocks because they knew it will tank. Those people became billionaires later. But these guys, everyone joined the herd saying that, oh, this is the best thing ever. And you can definitely do this. Now what happened? Suddenly each one by one, all the homeowners started to default. So the underlying asset only when it reduces, what happens to the scrip value? It was wiped out. And Lehman Brothers filed for bankruptcy. It went bankrupt also. So many companies filed for bankruptcy. Deadly, the greatest loss, and that had a ripple effect across the world. There was only one country standing tall, to be honest, and that is India. Because that time we had Manmohan Singh as the Prime Minister, of course, who was an economist himself. And in India, we'll never get loan even if we have all the credit in the world. Right? Anyway, we'll not get. So, a CA loan, if you think about CA student loan, how much they'll make you run. So, India is not for the middle. If you want to get a loan, they will, have to go from pillar to post. Now it is slightly reduced, but yes, that's how it is. So, in India, very, very strict credit norms, thankfully, because of RBI and SEBI, all these people. So, now, that's why now Indians also like, okay, this is good, but let us regulate it fully and do a proper securitization trust. We will not give on underlying asset which are not, stable. We will regulate it. So, they have created this concept, similar concept called securitization trust, but it's 100% regulated. And you cannot just open SPV on whatever you feel like. So, there will be certain norms which you need to follow. So, this is securitization trust. Special purpose vehicle set up to, so these are like Lehman Brothers. They are going to buy the underlying asset. They will buy loan receivable, credit card balances. That's the reason why wherever you go to a mall, an SBI fellow will come. Sir, do you want loan? Why? Because they can actually sell it to others. That's the reason actually. Because they want to sell it to other securitization trusts. That's the reason they want you to give a loan. And any concert, anything, now they have made a new thing now. Any concert, anything that comes, you buy a specific card, you will get a pre-sale offer. 3 days before that, pre-sale. And it is like crazy. You will get the card within 1 day. Now it's become, and of course you have if you have your credit rating agencies, with one click of a button, I can know your credit score. So if your credit score is good, you'll immediately get a card. But why don't people ask for, do you want debit card? Why they say credit card? Because they can sell that to other companies. But it is backed by what? Your credit report, and even the limits, etc. will be purely based on your credit report. So in India, a lot of restrictions are there. And every time re-KYC, because to avoid fake thing from happening, you have to do video KYC. All that in other countries, it was not there all these years. So that's why securitization trusts are safe to an extent in India. Yes, more than NPI, I would say they would take over the loan receivable. They would take over the credit card balances. Hire purchase debtors, where you have to pay the hire purchase, that also I will take over. Lease receivables, everything, and they are transformed into security. Underlying asset will be these things. But I will sell the scripts based on those assets. So yes, in that case, of course, there will be an owner of financial asset who is the originator. What is the owner of financial? SBI, who has given credit card. They are the owner of the receivables. They will sell the receivable to the securitization trust, which is a special purpose entity. And based on the strength of that, and this is not some random company, it should be a company with a very good a past history, turnover, and only then they can convert into a securitization trust, should be backed by proper credibility. And they will now issue securities to investors, exactly subprime mortgage crisis, but in this case, underlying asset will be strong. And very simple, guys, all income exempt for me. I am just a pass-through vehicle. And all income is taxable to the investor. That's all. No change, no, simple, very simple. So if you see, all income exempt in the hands of securitization trust. Here, all income taxable under section 115 TCA. The securitization trust shall be liable to deduct tax under 194 LBC. See the rate. Resident, individual or HF, 25%, deadly rate. Resident or other person, 30%. Basically, they know that 25% I will collect it off. That is like almost like the average rate of tax. I don't want any risk. I will collect everything. Resident, individual HF, other companies, company and all, directly 30% I will collect. There also, if you see, there is a protection mechanism. Because if tomorrow, if you are showing loss, I don't care, please pay 30% immediately. Non-resident, rates in force. Very simple. 25, that's it. Very, very simple. So securitization trust is a special purpose vehicle. That's about it. So this is all the other entities. So in other entities, as I told you, we have, we have AOP, BOI, firm, then business trust, investment trust, securitization trust, charitable organizations, political trust, AOP, BOI, business trust, this one done. We'll do political trust now. Firm and charitable organization, today we'll finish it off. Then we have that other portion of assessment procedure, also we need to see all that. Charitable trust also, of course, that is also, basically charitable trust is a separate subchapter sort of a thing, but these are all the other entities. Very simple. Investment fund, securitization trust. Very simple, guys, but as I told you, in amendments are there in that Finance Act 23 that you need to keep in mind. So last time they couldn't ask so much, so definitely, and it specifically made applicable properly to from November exam actually. From now it is applicable. So anytime they can ask. Simple. Concept, if you understand, other things very, very simple. Political party is also very, very important because something has changed in that. Let's finish political trust. So, in political trust, political parties, there will be income from house property if they own something, there will be income from capital gains, there will be income from other sources, there also will be certain voluntary contributions which they are making, which they are getting rather. So, what is this political party all about? It is defined in section 13A. So, they may get income from house property, capital gain, other sources, etc. Everything is exempt. Nirmala madam, will she tax herself? No. So, what is it? Exemption. There is crazy exemption for this political trust. Fully exempt. What? House property, capital gain, other sources, income from a voluntary contribution, but subject to certain conditions. Political party must be registered under an act called the Representation of the People's Act 1951. It has to maintain books of accounts as would enable the AO to deduce the income. So, it should maintain books of accounts always. A record of voluntary contribution in excess of 20,000 including name and address. Disclosure of voluntary contribution has to be taken. Donation exceeding 2,000 rupees shall be received only by account pay check or account pay bank draft or ECS. So, no cash payments above 2,000 rupees. This is some of the points you have to remember. 20,000, more than 20,000 voluntary contribution, you should record the name and address, which means beyond 20,000, there can never be anonymous voluntary contribution. Beyond 20,000, there can never be anonymous voluntary contribution. Donation exceeding 2,000 rupees can never be made in cash. Accounts of political party shall be audited by chartered accountant and have to furnish return of income under 139 4B mandatorily on or before the 30th September. Now, Mukesh Ambani, basically companies, for example, what happened was in Companies Act, section 182, minimum, those companies which are there in minimum existence for 3 years or other than government companies can do political, can invest in or rather donate to political parties. So, in 1956 to 2013, it was 5%. In 2013 to 2017, it was 7.5%. So, basically in 2013, when the Companies Act 2013 came, that 5% was increased to 7.5%. But in 2017, deadly thing happened by Arun Jaitley. In the Finance Act 2017 only, he deleted that 7.5% and he said any amount can be contributed. Any amount. Now, I am telling you more than 20,000, should you charge to tax or should you collect the data or not? Yes. But now, first of all, I removed that 7.5%. And now I am telling up to 20,000, anyway, you have to give the details, more than 20,000 not needed. But think about the scenario, guys, more than 7.5%, any amount. And he also told it should only be in no cash seen, only bank. Yes. 7.5% of average profit, 7.5% of average net profits. So, you should take the net profits, not even average, 7.5% of that net profit that you take, 7.5% of profits. So, this and CSR, both were average profits that you had to calculate. There was some calculation that you leave, but ultimately 7.5% of profits. That 7.5% of profits only was removed in 2017. and a very, very deadly amendment came in 2017, which is actually relevant for us now. That's why I am talking about all these things. What he told was, he said, I will introduce a new concept called electoral bonds. In that electoral bond, I can go to any bank. Let's say I can go to SBI during lunch break. Then what? Wait for them to finish lunch and then give. Always lunch break. So if you see there, when I give them what? There's a joke, the Swiggy guy went to deliver food. They sent him back saying lunch break. Yes. So if you see, right. So the thing is, when they went there, Ambani can give 40,000 crore. I'm just saying 40,000 crore. If it's more than 20,000 rupees, you have to disclose. No, Ambani can, I'm just saying 40,000 crore he can donate if he wants to. And SBI will give electoral bonds. It's like a demand draft. You go and give money, demand draft, they'll pay, no? So they'll give you electoral bonds worth 40,000 crore. You can, Ambani can distribute it to any political party at his will. No questions asked. Ambani in his books need not disclose. Political party need not disclose. Deadly. I just told now more than 20,000 you have to disclose. That is not applicable to electoral bond. It's not applicable to electoral bond. So, do you think anybody opposed this plan? No. All political parties wanted money. So, this was unanimously passed. Correct? If you see, you should, when after your exams, you go through that 2017 budget speech. Very interesting. So, when he actually told no cash donation will be taken after demonetization, everybody started tapping the, those benches there. Because they didn't understand the implications of what he was trying to tell. And of course, when you want to convince the people, you should hire a lawyer. Superbly, they'll convince. So, this is what happened. Now, the thing is, it was crazy, guys. I can donate anything. So, basically, this 20,000 is a farce. This will exclude what? Electoral bonds. I can go and donate whatever I want. No questions will be asked. Right? So, Prashant Bhushan of the Association of Democratic Reforms put up public interest litigation against this electoral bond, saying it is unconstitutional. And it is only, this year, beginning. That's why it's relevant, I'm saying. The Supreme Court of India struck this down as unconstitutional. They said, how can you are saying it is not available in right to information also. So, you have excluded everywhere. So, no, then they demanded SBI and all the banks to disclose. So, then the entire skeletons came out of the closet, where they came to know how many companies have given what all, how much money. And it is so happened that in whichever government they have given, they have immediately in 1 or 2 months, they have got a deal. So, I mean, that's a nexus. So, everything came out in the open, right? So, Prashant Bhushan was linked to this, what do you say, to AAP, and then eventually the CM also was arrested, put to jail in some other case. So, that's how it happens. Politics is played like that only. It's tit for tat, right? So, when Chidambaram was the Home Minister, Amit Shah went to jail, and Amit Shah became Home Minister, Chidambaram went to jail, correct? Uno reverse card. Yes, that's how it works. It's a tit for tat, quid pro quo. So, yes, anyway, leaving all that, but ultimately what I am saying is, important amendment for November 24, anything in electoral bond, what do you think? It is not there. So, electoral bond, yes, basically now Reliance, Mukesh Ambani can go to SBI, bought whatever it, and he can do whatever he wants now. And this entire electoral bond scheme is what? Unconstitutional. In 2024 judgment. So, basically, yes. Association for Democratic Reforms and another versus Union of India 2024. This is the important part for our exam. That is now applicable only from May. November also it was not applicable. From May exam it's applicable. Right? Sorry, for this May 25 and November 24, both applicable, guys. For May 2024, it was still there. It came in the early part of 24. So, for May 24 exam, what is applicable only till October 23, right? So, this case law was decided only in 24. So, for the first time ever, if they ask you any question on electoral bond, what will you write in the exam? It is decided that it is unconstitutional. So, Honorable Supreme Court has struck down the amendment. So, if you see, maintenance of record of voluntary contribution is not necessary if the donation are received by electoral bonds. This part only was deleted. It may be noted that the Honorable Supreme Court has struck down the amendment done by Finance Act 17 in section 13AB, which exempts political parties from maintaining records of voluntary contribution above 20,000 rupees received through electoral bonds as unconstitutional. This is the main amendment. Now they are electoral bond, the entire concept of exempting the political thing, that is unconstitutional. So today what I am saying is, if you are receiving anything above 20,000, whether through electronic bonds or otherwise, it has to be disclosed. That's the change. It has to be disclosed. No more exemption from disclosure. Bonds you can buy. Anybody can buy bonds. But the thing is, now they have removed that concept of bonds. Bonds you can buy, but what they have told is, let's stop that process of electoral bonds. Now they are not issuing. But I'm saying, even if you issue, whatever you buy now, you have to disclose. But in the exam, what will you write? You can just say that exemption is removed. What was the exemption? If you are investing more than 20,000, you cannot disclose. Need not disclose. Now you have to disclose. Till now it was you need not disclose. Now you have to disclose. And anyway, as we speak today, that concept is removed. You cannot even purchase electoral bond. Nobody will buy now. Why will they buy? Yeah, it's scrapped, because it's scrapped in that only. They said that is 100% unconstitutional. It is absurd for you to have electoral bonds like that. That is the main change in this from November exam. It was not applicable for May 24 also, because the case law came only in May, in 24. Remember which month? February, no? Yeah, February. So yes. So first time ever applicable in November exam. Correct. February, right. February 24 it was decided. So that's the main change here, guys. So you can directly give it to a political party. 13B. So for funding political parties, will I directly pay BJP, then Congress, like that, or will I pay to their trusts which they have? I can pay to the trusts also. So electoral bond paid to the political parties or to the trust, everything is not allowed now. To disclose beyond 20,000. So instead of having political parties, they can run it as trusts. Those are called electoral trust under 13B. Electoral trust. So what is electoral trust, guys? The company funds it to the electoral trust. Electoral trust is by the Election Commission, and it will be exempt. The income from electoral trust, that is just donations from others, that will be exempt if 95% of the donation is made to the political party. So the company will fund the electoral trust, and that will be exempt if 95% of the donation is given to whom? The political party. It will fund the political, and that funding to the political party, in political party hands also it is exempt. So if I receive 1000 crore, 950 crore minimum should go to the political party. Only then for you also it is exempt, for political party also it is exempt. So if you see the conditions, any electoral trusts are trusts constituted for funding political parties in an organized manner. A voluntary contribution received by an electoral trust shall be exempt under 13B, provided the following conditions are satisfied. The trust shall distribute a minimum of 95% of the total donation received along with the surplus. The political party receiving the donation should be registered under the Representation of People Act. The electoral trust shall function according to the rules. If you fail to distribute 95% of voluntary contribution, entire income shall be subject to tax. No mercy. Entire amount will be subject to tax. Electoral trust we'll give an example for that. So, electoral trust can accept contributions only by account pay check, account pay demand draft, TCS or any other electronic mode. The electoral trust may receive voluntary contributions from an individual who is a citizen of India, company which is registered in India, firm, HUF, AOP, BOI, resident in India, and receive from anything. It shall not accept any contribution with the PAN of the contributor who is a resident and the passport number in the case of a citizen of India who is not a resident. So, you have to give the PAN when you are contributing, and if you are a NRI, you should give the passport. Who is a citizen of India but not a resident, non-resident Indian. So, I will come to this part. Now, you see the main this main thing in electoral trust now is this point. So, I will give an example for that. Year 1, 1000 crore they are giving to political electoral trust. Electoral trust should minimum transfer how much? 95%. So, they have, let's say, transferred 960 crore. No tension. Is it exempt for political party? Yes. Exempt for electoral trust? Yes. Next year, fresh 2000 crore is made. Correct? Fresh 2000 crore is made. Then, what is the balance left here? 40 crore. Next year, fresh 2000 crore is made. How much should be transferred? 2000 into 95% or 2000 plus balance 40 into 95%? 2000 plus balance 40. So, next year 2000 plus balance 40 crore, 2040 into 95% should be transferred. That is the gist of that story. You see, trust shall distribute a minimum of 95% of the total donations, that is along with the surplus brought forward from earlier years, right. So, 2000 plus 40, 2040. plus into 95%, that will come up to 1938 crores. Year number 3, they received fresh 500 crores. How much will it be now? 500 plus, what is the balance? One not two. 40 plus, how did you get 102? 2040 minus, how did you get it? 2040 minus 1938. Yes, the balance. Simple. How much? 102. So, 500 plus 102, 602 into 95%. This is the calculation. In the MCQ here and there, they can ask you. That's all. So, you need to transfer that. It is not just the current year surplus, but also previous year's balance. Not the current year surplus, but also what? Previous year's balance. Both I should take it into account. Only then it will come. Very simple. Where an electoral trust fails to distribute minimum of, okay, that's done. Now, electoral trust must not receive donation from foreign entity or an individual which is not a resident of India. This is governed by Foreign Contribution Regulation Act. That's why they have given here, you see, foreign source as per FCRA. FCRA anyway includes this. So, foreign source as per FCRA, there should not be any money from abroad coming into India for political contribution. That would amount to selling of your country. to others, which, I mean, it's not allowed. There have been obviously instances of proof where CIA and KGB, USA and Russia both have been interfering in the politics of our country for a long time. So all that is not allowed. One electoral trust cannot invest in another electoral trust. That is also not allowed. Government company cannot donate to electoral trust. Then imagine all the government companies will donate to which are ruling party, right? So that is not allowed. Government company not. So these things not covered. Foreign source as per FCRA can be not just foreign company, can be anybody. Can a foreign trade union invest in the Indian political party? No. Or what about any foreign university or foreign trust, for example, Melinda and Bill Gates Foundation, can they transfer? No. Yes. So all these things you cannot. Basically, everything is covered FCRA. However, guys, you will get a best part of the story is all here. I am telling it is not allowed, but it is still allowed. Yes, two sections, AT-GGB and AT-GGC. Any contribution made to a political party or electoral trust other than by cash under one AT-GGB for Indian companies, AT-GGC for any SSE except local authority. B for BJP, C for Congress. Right. GGB for Indian companies, GGC for other companies, Congress like Italy and all those other countries will be there, no? Yeah, those countries, for that it will be, yes, other SSE. All crooks anyway, yes. So, or any SSE except local authority and every artificial juridical person. Yeah, from Italy and all money cannot come, guys, just kidding. Is there no here, foreign, so at least as per law it cannot come, yes. For any SSE except local authority and every other artificial juridical person, wholly or partly funded by the government. The electoral trust for the purpose of managing its affairs. So then they can ask you, I am getting so much money here, I also need to employ, so what do you say, have employees, trustees, etc. I need to run the show. From the money that I am receiving, how much can I spend? You say 95% I have to donate to political party. Okay, 5% can I spend? If I am receiving 1000 crore, can I spend 50 crore towards salary? So you see, 5% you can spend, maximum how much? 5 lakhs in the first year and 3 lakhs in the subsequent years. 3 lakh in the subsequent years. 80% off, we'll see somewhere, star will be there. Star minimum purchase 50,000. Yeah, it will quash all our hopes. It says what? 5% of total contribution, 1000 crore contribution, 5% 50 crore. Maximum how much? 3 lakh per annum, which means bare minimum. Now we are doing the calculation now. There is one change in this calculation. What change? 2000 plus 40 crore minus expenses, 3 lakh that we have to do, right? So if you see here, total contribution received in any financial year along with the surplus as reduced by the amount spent on managing the affairs shall be the actual distributable contribution for the financial year. Audit is needed. So electoral trust received a voluntary contribution of 1 CR. It distributed 97 lakhs to a political party by the end of previous year 21-22. Since more than 95% of the aggregate was distributed, total contribution of 1 crore shall be exempt. Suppose in the next previous year, electoral trust received 2 crore, and we have already seen 200 lakhs plus 3 lakh surplus. Entire thing should be distributed minus the expenses, of course. Expenses they have not taken minus the expenses. So that's all regarding political trust. But one change, as I told you guys, is if at all they ask any question on electoral bond, earlier rule not allowed. This now it is allowed. New regime, what? New regime, none of those sections are available. You see, only these things are available for you. Deduction for employment of new employees, CCH, that is deduction as part of Agnivir scheme. That's it, nothing else. So in the new regime, that is what you have to claim. So kindly note, in the new regime, if they ask you one hidden adjustment they can give, the son is earning 45,000 rupees, which will be clubbed in the hands of the father. He is not earning because of any skill, etc., but is that thing 45,000 is transferred to him, should be clubbed. The father is opting for the new regime. What is the amount to be clubbed? Or let's keep it simple. Let's make it how much? 11,500. 11,500 is being clubbed. What is the amount clubbed? 11,500 or 11,500 minus 1,500? 11,500 minus 1,500 is the exemption, if you remember. Yeah, but guys, that exemption is not applicable for new regime, right? I told you that time also. If you check one of the videos, you will see that. That is one hidden adjustment they can give, should be allowed. Not allowed. Allowances for income of minor upon clubbing, not allowed. Okay, couple of other points. So come to W1, guys. I'm trying to do all the other important areas also quickly, so that then we'll take a break and then move on to assessment procedure, charitable. So you've always been seeing, no, this 115 BA and all that. In that I've given that in chapter W1. As quickly we'll brush through. Especially this one is new, 115 BAB. We have to give in to the demands of the industry. It was 30% and then kept on increasing. So we have to keep on changing that, no choice. So that 400 crore we have seen 25%, but certain companies satisfying conditions, you have 115 BA, which is 25% anyway, but certain companies existing or new, 115 BA, Now we saw that in business trust companies, the SPV opting for 115 BAA 22%, so that dividend is also taxed in the hands of the unit holders. But now after given into the demands of the industry, crazy. New companies engaged in manufacturing activities, 15% tax. One of the least rates in the entire world. Right? So basically, the taxation regime is more for the business people rather than the middle class. Right? That's true. Because the business will make a lot of money, so everyone would want to get into business. That's the reason. Foreign company, normal, 40% plus surcharge and all that. New domestic companies. It is what? Business of manufacture or production of any article or thing, and research in relation to distribution of the article. So, business will be anything excluding this. So, exclusions, if you remember, other things are fine. Means all businesses can take this, guys. And that business should be registered when? That is most interesting. On or after 1/10/2019 and before 31/3/24. So it's like, it's not that forever. On or after 1/10/19, but before 31st March 24. Which means after COVID, COVID season. 1/10/19 means what? Almost few months, 4-5 months, COVID came. So there till 31st March 24, till now, 31st March 24, all the companies set up and registered. So they can ask you tricks here. It was set up in March 24. Commence production in April 25 or April 24. Allowed or not? Set up shop when? March 24. Commence production or business May 24. Allowed or not? No. Why? Set up and registered and commence production. Exclusions, if you remember, you can say that for all companies you will get this. Computer software in any form in India, development of computer software not allowed. So they are going to export it, make a lot of money, so nothing. Mining not allowed. Conversion of marble blocks or similar items into slabs, your marble companies. Bottling of gas into cylinders. Printing of books or production of cinematograph movies and books, etc. not allowed. Other businesses. So just remember this: computer software, mining, marble, gas into cylinder, printing, cinematography, movies. These things 15% not allowed. Normal rates. Other cases, anything that you manufacture, not in the service industry, anything you manufacture will be coming under. You can opt for this 15% provided you have started your business after 1/10/19, commenced it also before 31st March 24. Rate will be this much. Concessional rate of 15% plus surcharge 10%, cess 4%. So effective rate, see, surcharge is irrespective of the income, mind you. Effective rate of tax will be 17.16%. That's all. Income from such manufacturing activity. Taxes on special income like LTCG, etc. Yes, special rates. Whatever special rates given as per law, plus 10% plus 4%. Tax on other income, 22%. Same rate, 22% will go. Not 15 but 22. So guys, only on PGBP, it's called eligible domestic company. PGBP how much? 15%. So if they give you a question on this 115 BAB, they give you multiple incomes. They'll ask you to compute tax. These rates are important. Income from manufacturing activity alone 15%. Special incomes, normal rates, special rates as given in the law. Other income like IFOS 22%, not 15%. and no other expenditure is allowed in computing such income. Only one thing, STCG on non-depreciable asset. STCG on non-depreciable asset, there is a change here. Normal rate, normal rule, what will it be? STCG 30%. Here it is not 15%, it is 22%. 22% plus 10% surcharge. 22% plus 10% plus 4% cess. There is no restriction on claiming any deduction in this regard. So these are the important areas. You should understand that the business activity alone is 15%. Everything else is 22 actually, not even 25, 22. Here they have given 22, right? This certain existing company, this rate they have given 22. So it is 22 clearly given. 15, 22, 10, 10. Yeah, then other thing. Summary of tax rates and one. This is important chart. If they ask you any question on this, be ready with the answer for this thing. 15% income derived from manufacturing activity, only that 15%. Short term capital gain on transfer, generally it would have been, should have been normal rate 15, but here 22. LTCG 10%, other things 20%, short term capital gain on depreciable assets, 15. Guys, this is which one? Non-depreciable asset. Land. Depreciable asset 15. Why 15? Because it's there in the block anyway, right? Any other income 22. Then there are some other conditions which we need to know. Can it be a hived off company or brand new company? Brand new. Should it use new plant and machinery or old plant and machinery? If you remember old plant machinery, new plant and machinery, two things we saw. One is additional depreciation. One more? Sir, PGP was 5 months ago. Which is the other one? New plant and machinery, two places we saw. One was additional depreciation. One more, 35 AD. In 35 AD, can I have new plant and machinery which is also old from abroad? Yes. Is it something like that here? We'll see. Should not employ used plant and machinery except to the extent of 20% of total, similar to 35 AD. Plant and machinery will not be considered as used if it is used outside India and the following conditions are satisfied. Was never used in India, imported in India, no deduction has been granted. So guys, this 115 BAB, 115 BAB asset is similar to 35 AD asset, similar to 35 AD. Hidden points. There is only plant and machinery. An old building was used for hotel before, now it is used in the new business. Possible? No. Any building previously used as a hotel or convention center in which 80 ID has already been claimed cannot be used now. And I will not get any deduction. The income of the domestic company shall be computed without availing the following deduction. Means guys, for this company, additional depreciation not allowed. Additional other things are fine. Site restoration, 33 AB, T development not allowed. 35 AD not allowed. See. Yeah, similar to new regime. Yes, you're right. New regime. AT, JJA and ATM they can claim. JJA and ATM you can claim. ATM is what? Dividend. So, similar to new regime. So, definitely you will get questions on 115 BAB. Why? Yes. Please study this and go. We'll see that. They have given some extensions, but nevertheless, it's almost gone. Which one? That's not, they can do it anytime, no problem. Yeah, as long as you have started the business on time. There is no sunset like that. As of now, nothing. Now, can I carry forward, guys? Now, in this carry forward benefit, what can I carry forward? You see, we'll finish this and then you can take a break. Carry forward of any, only we'll finish this section. Carry forward of any loss or depreciation. Any loss or depreciation or allowance of unabsorbed additional depreciation which is attributable to any restricted deductions specified above shall be deemed to have been given full effect and no further deduction shall be allowed for any subsequent year. So, carry forward of any loss or depreciation, it is deemed to have been already allowed, because first of all, if you see, additional depreciation anyway is not allowed. So, because of that additional depreciation which I am claiming, I am getting unabsorbed additional depreciation or loss. So, can I carry forward unabsorbed depreciation? No. Why? Because additional depreciation is not allowed, and they are very clear here. Any loss or depreciation or allowance of unabsorbed additional depreciation is attributable to any restricted deductions. What are the restricted deductions? These things, 35 AD, 35, all these things, 35 AD asset, and of course, additional depreciation alone is all anyway removed. These are the restrictions. So, anything linked to this will also be not allowed, obviously. Yeah, it's only allowance of what? Additional. MAT provisions won't apply. Now, his question, is it forever? I started my business in 2023. Is it, I have opted for this. Can I come back to normal scheme? 1 year this, 1 year that. Very clear, one deadly dialogue. Once exercised, cannot be withdrawn. Tomorrow, when you get benefit of 35 AD and all that, I want to go there. No. So, you should be very, very careful while opting for it. That's why they are saying, you want less thing now, you predict the future and take this. And if at all this will end up becoming you're paying more, then you will have to pay, no choice, because I'm giving you a benefit now. So, you have to take a stand there. Company fails to satisfy the conditions, option exercise would be invalid in respect of previous year and subsequent years. Accordingly, other provisions of Act shall apply as if the option had not been exercised only for the previous year and subsequent year. So, once you fail to satisfy, withdrawn, gone. You will make a this thing. What do you say? You don't satisfy the condition. If where the company exercise under 115 BAB has been rendered invalid due to breach of conditions. What are the breach of conditions? Previously used for any purpose you are using, previously used hotel you are using, it is used other than the business of manufacture or production of a thing, and that's why they are giving an option, because they know in second option you will anyway 100% fail on your own, you will do. So, she said you can switch over and exercise the option under 115 BAA, which is 22%. Now, one more deadly point. What is the one deadly point? It should be once exercised, cannot be withdrawn. But if you are found to be in breach, you can switch over and that's it. That there ends the matter. And you see, you will switch over and exercise the other option, 115 BAA they are saying, not the normal provisions. Now, one more deadly point. I started my business in 2022. Just before 2024, can I opt for this? I was following normal provisions. What did I say? If you can, once you opt for this, you cannot switch. My other question is, you are following other provisions first. Before 31st March, you opt for this. Is it like that? The section name only is what? New domestic manufacturing companies, which have been set up on or between this time. My question is, in 2022, I set up. I tried normally first, didn't work. In 2023, I opted for this and I want to continue forever. Possible? Will it be called new then? Yes, that most important thing in this section actually is point number 9. If it does not opt for this section in the first year, ineligible to opt anytime. That is why the section says new business. You should opt it when? First year. So, computation of reasonable profits in certain case by AO, anti-abuse clause. So, this company is closely associated with some other company to which the section applies. Basically, what they are doing is, the company which is taking 15% is passing on all the benefits through another company, sister concern. Then what is the point of this section? I open 5 such companies and all of them supply to me only. I would have had to procure it elsewhere because of higher taxes. This company will give me a dirt cheap rate because of lower taxes. Possible? That's why this section is there. Assessing officer, owing to the close connection and you are making more than ordinary profits, he will make like a best judgment assessment of profit which is reasonably deemed to have been derived therefrom, deadly. And he will tax it at what? Excess profits he will tax at normal rate 30%. That is plus all the cess etc. 34.32%. Amount of excess profit which is deemed to be the income of the company, and such income will be taxable at 30%. So, you are showing more than, basically what I am trying to tell is the other company has to derive profits. No, you are showing more profits. You are, I will open 5 companies and everybody will supply to one company. Now, this company's profits is distributed here. So, they are selling it at a higher rate. So, basically profits would have been 5 crore and for here it will be 500 crore. Here I will make it 400 crore and every company will show 40 crore like that suddenly. So, AO feels that just because you are showing less tax, getting less tax rate, you are shifting the other company's profits here. Because now you can also charge an exorbitant rate and collect money from them. So, this company will increase their expenses and this company will increase their income. This company will increase the expenses and pay tax rate at 30%. This company will increase their income and pay tax at 15%. Excess. Hence, I will, all the excess portion of the income that you have made, I will charge at what rate? 34.32%, deadly. If you have amalgamation, other things will apply. Yes, other part we will see after the break. Let's take a break and we'll continue. This is the most important, BAB, other things are fine. Okay, so next part of the story is income of certain companies, domestic companies. So, quickly some changes etc. we will see. First, definitely whatever is important for the exam is this one, new domestic manufacturing companies, BAB. Then coming to next is your B A, which is certain domestic companies. So this domestic company shall engage in any business including trading, manufacturing, service. So here extra thing is what? Service is also included. An eligible domestic company shall at its option be taxable at a concessional rate of 22% plus surcharge at 10%. Levy of surcharge at 10% shall be irrespective of the amount of its total income. Thus, effective rate of tax will be 25.168%. This is income from manufacturing or the service thing that they are discussing. So again guys, if you see here, income derived from manufacturing 15%. In the other case, it was how much? That was 15%. This is 22% here. Short-term capital gain 15, long-term capital gain 10, normal 20. These are normal rates. Other income 22. So only in that BAB, it was slightly different. In BAB, what was it? 15%, and then other things were, and short-term capital gain on depreciable asset was 15%. Then short-term capital gain on non-depreciable asset 20. So those rates you have to remember. Actually, it's memory game, nothing else. Conditions to avail, similar provisions are there here. No change, almost same. Company may claim deduction under 50, 80 JJA and ATM also. So 50, 115 BA and BAB, ATM is also allowed here. Depreciation, where depreciation allowance has been given, has not been given full effect, corresponding adjustments etc. to the block of assets should be made, same thing. It has not been given, here also you can give. Carry forward of any loss or depreciation, same. Any loss or depreciation out of unabsorbed additional expenditure, depreciation, which is attributable to any restricted deduction, is deemed to have been fully given and no further deduction is allowed. So for example, out of the total unabsorbed depreciation brought forward to the relevant previous year, 2 crore pertains to additional depreciation. This amount of 2 crore shall be ignored and will not be allowed to carry forward if the SEC opts for 115 BA. However, if the relevant previous year 2019, then only for the first year this amount shall be adjusted to the WDV of the block of assets on 1/4/2019. That is irrelevant now because that when the section began. Provisions of MAT will not apply, MAT credit will lapse. Here you are saying it's not a new manufacturing company, you can opt for 115 BA. Here you can opt for 115 BA. But once you opt for it, cannot be withdrawn. Once you opt for it, you cannot be withdrawn for sure. And then, if the company fails to satisfy the conditions mentioned above, options exercised would be invalid in respect of the previous year and subsequent years. Accordingly, other provisions of the Act shall apply as if the option had not been exercised for that previous year and subsequent years. This option must be exercised by the SSE in Form 10IC and all these things there. If a person having a unit in IFSC, deduction will be allowed subject to the conditions under ATLA. So this is very simple. You just can opt for it if you want to, and any company can go for it. What is an eligible domestic company? Any business including trading, manufacturing, service. They have made it so easy now. Normal companies, if you are going for 30%, if it's at 400 crore, 25%, and you can still opt for 115 BA, and new manufacturing company can opt for 115 BAB. So they have made it very, very easy for the manufacturing companies. And now 115 BAB is for manufacturing, BA is for both service also, trading also. That's an additional thing. Then we'll see the differences between all three, then you'll understand better. Next, one more round. It is only BA. Certain manufacturing companies. Was there a date given for BAB? Yes. What date? 1/10/19 to 31st March 24. Is there a date given to BA also? Yes. This registration should happen after 1/3/2016. There is no end date. 1/3/2016. So old company is not allowed. 2016, 8-9-year-old company is allowed. Business of manufacture or production of a thing, same research. This is similar to, condition is similar to BAB. Tax rate 25%, but guys, plus surcharge of 7%. Surcharge is not directly 10% here. Surcharge if the only taxable income is 1 to 10 crore. And 12% of the taxable income exceeds 10 crore. Other provisions same. But one interesting thing. Can you claim ATM? ATM cannot be claimed. For BA, ATM cannot be claimed. Those minute differences you need to remember, that's all. It's predominantly a memory game, unfortunately. What is the concept here? It's memory only, no? On this it's applicable, not applicable. Differences you should see are memory. Nothing, no concept actually here. Not like business trust to understand where all it will go, nothing like that. It's just memory. Carry forward. Any loss or depreciation or allowance, same. So this is the same point. Same point. Again, once exercised cannot be withdrawn. Once exercised cannot be withdrawn. Yes. Alarm for 12, no? Okay, no. Yes. Let's say exercise option under 115 BA, then option under 115 BA can be withdrawn. Yes. Now from BA to BA can I go? Yes. The moment I jump from BA, why will I jump? Because BA is how much? 25%. BAA is how much? 22%. So of course I can go to jump from BA to BA. BA on the other hand, BAA will also have service. So is there any benefit for the service industry? BA. BAB and BA only for manufacturing. And of course BA also is manufacturing. Manufacturing companies, good benefits. Now see this chart which has all the differences, it will help you understand. BA, BAA, BAB. BA, eligibility, tax on income of certain domestic manufacturing companies. BAA, tax on income of certain domestic companies. This is new manufacturing domestic companies. BAB is new manufacturing. BAA, manufacturing plus trading plus service. Manufacturing plus trading plus service. Setup and registration, guys. BA any date. New manufacturing company on or after 11019, before that also will write, before 31/3/24. Before 31/3/24. Tax rate, here it is 15, here it is 22, here it is 25. 15, 22, 25. Surcharge, guys, mandatory here 10% because it's a lesser rate, no? Mandatory surcharge. 115 BA, what is the surcharge? 7% net total income, 1 crore 10 crore, 12% if it is more than 10 crore. Effective rate is based on surcharge. Your effective rate is this much, 17.16, 25.168. Can the company be formed from splitting up, etc.? The first case is a no. These two cases, in the sense, sorry, the 115 BAB, new manufacturing company, no. This company, no problem. It can be set up by splitting up and all those things. Second hand plant and machinery, can it be employed? In these two cases, it is not at all applicable. In BAB, only to the extent of 20%. Sorry? Yeah, it can be employed. When I say not applicable, it means it can be employed. Building used as hotel, convention center, etc. Only in that new thing there was an additional condition. Here, no. Just stick to this chart. Exemption from MAT. BAB and BAA have exemption from MAT. Here, no exemption from MAT. You have to follow. Normal company with 25%, you have to follow MAT. Due date to exercise the option, on or before the due date under 139, all the cases. But guys, this one, BAB, when? First return of income. First return of income. And BA also, guys, first return of income. Interesting. Both should be first return of income. Whether company can opt to claim exemption and pay at pre-amended rate and opt for concessional rate after the expiry, etc. No, since option to select has been given before 139(1), you cannot opt for it whenever you feel like doing. That's it. First return of income and then chapter close. Only in the middle point, because this can be done anytime. So here you can opt for exemptions and can pay at a pre-amended rate, and option for concession after the expiry of tax holiday. All that point you leave. It's fine. Whether existing company can migrate. There is no migration in the case of first case, whereas the middle one, that is your BAA, definitely we discussed, you can migrate. Company is opted for BA, can irrevocably opt for BAA, definitely yes. Whereas a new manufacturing company, as I told you, there is no migration concept. What about the existing MAT credit? No question of unutilized MAT credit, as it will not only apply. As per CBDT, as per 150 BA, MAT credit will lapse, and in this case you can carry forward and utilize. Consequences if the option exercised rendered invalid due to breach of conditions. As we told you, if you breach the condition, you can opt for BA. You can opt for this BA. Here also option cannot be availed. The moment you breach, normal provisions will apply. In this case, it will not apply. Next, exit option, is it there? In first case, that is your BA, there is absolutely no exit option. No exit option. Once the option has been exercised for any previous year, it cannot be subsequently withdrawn for the same or any other previous year. So here company can opt out by claiming deductions, reliefs not to be claimed. Once company opts out in this manner, it can never ever avail 115 BA. Once you're out, you're out. Company can here opt out by claiming deduction, relief, etc. not to be claimed. Once company opts out in this manner, it can never ever again opt for 115 BAB. So this is the scene. So go guys, 1 second, just read this 22% and 15%. BAA and BAB. Just quickly go through in 1 minute. Just go through, because I'll tell you for cooperative society what is the change as per Finance Act 23. Go through. Those of who want to stand in the queue, we can stand. CA students will never be disappointed. We are all, because the percentage of you getting the tickets would be like around 7-8%, which is our pass percentage anyway. So if we don't get also, no tension. We are accustomed to it. Others will feel sad. Wonder how it works though. Like it's everybody, if they come on the same time, how does it work? Anyway. Right. So at that, when the clock strikes 12, we'll give a couple of minutes off. If those of you want to do it, do it. All my friends are trying. Your friends are also trying? You're trying. Your friends are trying. So it's like war today. Crazy, man. 3.5 lakh people are interested. Damn. Mostly they will add couple of more shows because, generally that's what they do. If it gets sold out, no, they'll add 1 or 2 shows extra. In India, country like India, they should add like 4 or 5 shows. Otherwise, what happened? Oh, is it? Really? Then I'm sure there'll be more shows. How did you know? Okay. Cool. So guys, these two things now, BA and BAB, important. Come to chapter V. Chapter V. Today OBS is acting funny. Is it there? Chapter V. In that, one important change, guys, which is now applicable from November exam. 115 BAD provides for a tax regime wherein option of the resident cooperative society, it may resort to a flat rate of 22%, subject to the fulfillment of certain conditions. Now, this is the main change. To provide a level playing field between new manufacturing cooperative, so this is for a cooperative society. So, what does a cooperative society do? It is all the like-minded people will come together and they will, for example, if it's a dairy cooperative society, dairy farming, it's not there. Not there. Yeah. So all the people coming together of dairy farming, they'll come together, they'll produce the, they'll from the cows they'll produce the milk and give, and from there they will sell everywhere. Like Amul, Anand Milk Union Limited was a cooperative society. So for them, similar provisions are there. So this table you can take a picture and take 3 minutes. Okay. Anyway, update, if it comes, update, because here I cannot see anything. The OBS is there. This is also acting funny today. Cool, no worries. Okay. So guys, check this out. Existing regime. This is the cooperative society. I hope you took a picture of that. What the change is very importantly, to bring about a level playing field between new manufacturing companies, so new cooperative societies and new manufacturing companies by providing similar concessional regime of 15% to new manufacturing cooperative societies. Okay? New manufacturing cooperative societies, really? You mean the app opened? App opened for him, that's why, yeah. That is new manufacturing cooperative societies as well. Finance Act 23 has inserted a new section, 115 BAE, correct? In the Act, in which concessional tax regime is being provided for the new cooperative societies as well. So, BAD was always there, bad. So, new BAE has been added, right? Yeah, if you 115 bad, so it will become bad BAE, if you know what I mean. Yes. So, right. So, up to 10,000, 10%, 10,001 to 20,000, 20%. This is a normal one, normal regime. Exceeding 20,000, 30%. Yes. This BAD is similar to which section? To companies. Yes, BA. Here? BAB. So, same, absolutely same, no change. So, that is the one important change that you need to remember. So, it is 22% plus 10% surcharge, 15% plus 10% surcharge. Under 115 BI, one more change, where the total income of the SC includes any income which has neither been derived nor is incidental to manufacturing or production activity, which is other income. So, cooperative society has invested some funds in FD, that interest that they are getting, and which no specific rate has been provided in this chapter. It will be taxed at 22% and no deduction will be given. Same anti-abuse provisions are also there, where 30% tax the fellow can do. Here everything is the same, guys. One very interesting thing is you can claim ATC to ATU, deductions and exemptions not permitted. ATC to ATU you cannot claim except one section, ATJJA. What about ATM? ATM is anyway not, it's only for companies, right? Dividend companies, ATM. So that is what it is. Everything else remains the same, no change. That's why we can go fast here. There's nothing here to do. Same. Respect to everything else is the same, guys, no change. So ultimately, one extra thing that we have given is, that's all, that is your 115, this BAD and BAE, that's it. So concessional tax regime, they have given an extra section, 115 BAD and BAE. So 22% and 15%, all the provisions are the same as it applies to these people. Absolutely no change in any way other than that. So this is regarding cooperative societies. So we are done with that. Then the default tax regime, anyway, we have seen that. Come to that 1 second. Yeah. So according to 2(1)(b), amalgamation in relation to companies means, so this is P1, guys, amalgamation and merger. So according to 2(1)(b), amalgamation in relation to company means the merger of one or more companies with another company, or merger of two or more companies to form a new company. Then we have seen this, all the properties of the amalgamating company should become the property of the amalgamated company. All the liabilities of the amalgamating company or company should become the liabilities of the amalgamated company. Ultimately, that's how it should be. Then we have seen shareholders holding not less than 75% in value of the shares should become shareholders of the amalgamated company, other than the shares which they have already held. You have seen this. So if they are cross holding, that you should exclude, remaining you should do the same thing. So a quick revision of whatever we have discussed. Capital gain, there is no capital gain transfer from amalgamating company to amalgamated company. Capital gains for amalgamated company, all assets of the amalgamating company will become the property of the amalgamated company later. Cost of acquisition is equal to cost to the previous owner. Period of holding will include the period of holding of previous owner. Capital gains as per 47(7), when shareholders are allotted with shares of amalgamated company in exchange for shares of amalgamating company, it does not amount to transfer, hence no capital gain. Exemptions, we have already seen those things. Period of holding is includes the period in which you are holding in the previous thing also, which were held in the amalgamating company. So if you had held it from 2018 and then the amalgamation happened in 2020 and you are selling in 2024, shares will be from 2018 itself. Yeah, really? Did it? Came up? Okay. So some important pointers in the amalgamation is what? Expenses incurred for amalgamation allowed over a period of 5 years in equal installment. If you remember 35D, similar to that, the 35DD is there, that is incurred for amalgamation. It is allowed for over a period of 5 years. Then deductions under 35 ABB, 35D and 35E available to the amalgamating company can be availed to the amalgamated company also. Same is the position with respect to deduction under 80IB. The losses and unabsorbed depreciation of the amalgamating company shall be treated as that of the amalgamated company for the previous year in which amalgamation takes place. So benefit of carry forward will be available here. Apart from that, for the demerger also similar provisions, guys. Demerger also similar provisions. transfer of an undertaking by the demerged company to the resultant company, such that all property of the undertaking becomes property of the resulting company, all liabilities of the undertaking becomes liabilities of the resulting company. Same, and ultimately here also we had seen shareholders holding not less than 75% of the shares in value in the demerged company agree to become shareholders of the resultant company, other than those shares already held therein immediately before the demerger. Transfer of undertaking is on a going concern basis. Should be on a going concern basis. Then we have seen this capital gains on demerger always should be proportional, because it is cost of acquisition of shares in the demerged company, and then that is net book value of the assets in transferred in the demerger divided by net worth of demerged company immediately before demerger. So that will remain the same, it will keep on going down. Capital gains for demerged company. Transfer of a capital asset by the demerged company to the resulting company shall not be regarded as a transfer, hence no capital gain shall arise. Mr. Naveen is a shareholder in D Limited holding 1000 shares which were acquired for a consideration of 12 lakhs. D Limited transfer the assets and liabilities of one of the undertakings to R Limited. In consequence of such a demerger, Naveen is issued certain shares in R in lieu of the certain shares held here. You are informed that the book value of assets transferred is 175 lakh. Book value of liabilities transferred is 75 lakh. Paid up share capital is 400 lakhs and general reserve is 100 lakhs as appear in the books immediately before the demerger. So how will I compute the stuff here? To calculate the cost of acquisition to Mr. Naveen, cost of acquisition of original shares held in D Limited is 12 lakhs. Net book value of assets transferred by D Limited, that is how much guys? 175 lakhs is the overall thing, but book value transferred is 75. So net book value transferred, one is assets, book value of asset is 175, liability 75. So 175 minus 75, 100 lakhs. Net worth of D immediately before the demerger, 400 lakhs plus 100 lakhs. 400 plus 100, totally 500 lakhs. Cost of acquisition of shares of R Limited resulting is the same thing, that proportionate, 12 lakhs into 100 by 500. Out of 500, 100 only was demerged, so 12 into 100 by 500. So total cost of acquisition of shares is 12 minus 2.4, 9.6 lakhs. The cost of acquisition of shares held by Naveen, the resulting company is 2 lakh 40 and that of the shares held in D Limited 9 lakh 60,000. Now, any distribution to shareholders of the demerged company, will it be treated as deemed dividend? Did we see anything related to deemed dividend? No, it will not be treated as deemed dividend. Demerged company shall be entitled to claim depreciation under section 32 after demerger. Resulting company can claim depreciation on WDV of the transferred assets of the demerged company. Explanation 2b. Expenses incurred for demerger shall be allowed over a period of 5 years in equal installments as per section 35DD. Deductions under 35 ABB, 35D, 35E, all this will be available to the demerged company also, no problem. The resulting company also will enjoy the benefit of the demerger. These are some of the normal points with respect to the demerger and all those things. So that's about it. So now we will do the assessment procedure, which is appeals and revision. All right, guys. So let's start taxation of firms. This is also very, very important because they have changed the law in Finance Act 24. So if you think about it, after this, there's nothing much except, of course, the important chapter of TDS and charitable trust. We have decently finished. Taxation of firms, guys. Taxation of firms. Very, very important because of the change that they have brought about. So as far as the firms are concerned, you need to understand what is a partnership firm, because partnership firm as per income tax may be different than what you know as Income Tax Act is. There are specific sections 184 to 189 which covers taxation of firms. 40B which has been amended in Finance Act 24, which means the last time ever the 40B disallowances, etc. can come, will be our attempt. November 24. Section 28 talks about the fact that any share of profit received by partner will be exempt, that's fine, but any remuneration, interest, etc. received by the partner is taxable in the hands of the partner as PGBP. That is what we had seen. So, partnership firm 184 to 189, section 40B, amendment, section 28, then share of profit 10 to A and 78(1) carry forward. K1 is the chapter, K. Taxation of firms is K. Then there is one more TDS section added in Finance Act 24 that is irrelevant for our discussion, because what is relevant is there any TDS to be deducted when I am making a payment to the partner? For November 24 attempt, answer is a no. So there is no TDS concept. You can just pay and close it. So there is no concept of TDS. So in PGBP, profit is 20 lakhs, remuneration is 1 lakh, interest is 1 lakh. Example. So this expenses, are they allowed or disallowed in the as per 40B? Assume it is allowed as per 40B. 40 small b is the section which speaks about allowances. In AOP BOI, we saw which one? AOP BOI 40BA, right? 40 small b is for partnership firm. So this 3 lakh and 1 lakh, if it goes to the partner, for partner it is taxable under section 28. That's what I am trying to tell. Net profit before tax 16 lakhs, tax 4.8 lakhs, then the share of profit of 11.2 lakhs. This share of profit here is exempt under 10 to A. So you have to understand that this 3 lakh and 1 lakh, this is allowed as per section 40B, and that is going there to the partner. This is taxable under section 28, whereas profit after tax is allowed. Share of profit is exempt under section 10 to A. Share of profit exempt under 10 to A. Total income 50 lakhs. Less. One more interesting thing is, so I repeat, what is allowed under 40B is taxable to the partner under 28. Share of profit on the other hand will be exempt under 10 to A. So if there is a total income of 50 lakhs, profit linked deduction of 50 lakhs, tax payable by the firm is nil, and the share of profit for partner 1 25 lakhs, partner 2 25 lakhs, is this exempt or taxable? The firm pays nil tax because of profit linked deduction, ATIA, all those things. They have a hotel, profit linked deduction, zero income, and the share of profit now becomes 25 lakh, 25 lakh. They will give it to the partners. Partners receiving 25 lakh share of profit. Is that exempt or is it taxable? Have we ever said that only if the income, if the tax is paid by the firm, then it is exempt under, like, have we told like that, or we have told any profit, net profit after tax is exempt in the hands of the partner? What is the dialogue? Net profit after tax is exempt in the hands of the partner, hence not taxable. So this was a circular in 2014, guys. Even though there is a profit linked deduction under the section, no problem. Total income nil, tax nil. Even though there is a profit linked deduction for P1 and P2, 25 lakhs, it's still exempt under section 10 to A, circular number 8/2014. Done. So the entire partnership law, it depends on the Indian Partnership Act. So let's come to the notes now. Firm shall have the meaning assigned to it in the Indian Partnership Act and shall include Limited Liability Partnership Act as defined in the LLP Act. The term firm used covers both registered and unregistered firms. The scheme of taxation of LLP is dealt in the same lines as that of taxation of firms. Partnership versus LLP. Partnership governed by Partnership Act, LLP governed by LLP Act. Registration optional in partnership firm, LLP mandatory. Partnership firm compliance, there is no annual returns. LLP, it is you have to file the annual returns and all those things. But anyway, but in Indian Partnership Act here it covers both firms and LLP. So when I talk about this, it covers both. And here if you see, number of partners is limited in partnership firm. Can you tell me how many partners are allowed in partnership firm? Foundation, 20. 20 banking, non-bank, that was 2010 law, correct. That was in your textbooks, it will be 11th and 12th textbooks. It is wrong. So that was actually, okay, there is definitely a limit. The limit is as per Companies Act or Partnership Act? Again, gut feeling reverse. It is in Companies Act actually. In Companies Act, there is a section 464. Old 464 before 2013, you are 100% right. 10 for banking, 20 for non-banking. That was deleted and now they said any association should be registered as a company if it crosses 50 people. Right? If you do not register it as a company, if it crosses actually 100 as per the law, but as may be prescribed, they say. Central government today has prescribed 50, which means up to 50, all associations can be any association. The moment it crosses 50, you have to mandatorily register it as a company. If you don't register as a company, then the association will be called as illegal. The association will be called as illegal as per law. Hence, partnership firm is limited to the 50 because partnership need not be registered, right? So it is limited to 50. Limited to 50. Right. Limited, unlimited. Property cannot be held in the firm's name. Here you can hold in the firm's name. And identification number not applicable in partnership firm and all those things. Partner in the firm. Firm cannot be a partner in another firm. LLP can be a partner in another firm. That's all fine. Alternate minimum tax under 115JC, in both the cases it is applicable. What is the residential status of a firm? If the control and management is wholly or partly situated in India, wholly or partly situated, so it will be a resident. If the control and management is wholly situated outside India, then it is only non-resident. Means all the managing partners, everybody should be there outside India. There should only be like a branch office in India. Then it will be called as non-resident partnership firm. Otherwise, this one. So whenever they ask any question on partnership firm, LLP also will come, guys, because both are covered here. Resident, yeah, that's fine. Rate of tax, guys, rate of tax. Tax rate is how much? Charged on its total income at 30%. It is charged on total income at 30%. Long-term capital gain in respect of listed securities, 10% on gains exceeding 1 lakh rupees, and in other cases 20%. Short-term capital gain 15% in case of listed securities, other cases 30%. Surcharge 12%, it shall be applied on total income exceeding 1 crore. Health and education says 4% on aggregate of income tax and surcharge. Losses, set off, carry forward, everything is allowed. Absolutely no problem, everything is allowed. Now the question is, when will you assess as a firm? So tell me, in Indian Partnership Act, do you require a partnership agreement? Yes. Can it be an oral agreement? In Indian Partnership Act, yes, it can be an oral agreement. You can have an agreement. It says it is a partnership is the agreement between persons. Agreement can be oral, but if you want it to be assessed as a partnership firm in Income Tax Act, it should be in writing. If it is not in writing, it will be assessed as AOP. It is not that no tax, it will be assessed as AOP. So a firm which is whose agreement is not in writing will be assessed as AOP, not as a partnership firm. The shares of each partner is specified in such an instrument. In AOP BOI, share can be indeterminate, but in partnership firm, share cannot be indeterminate. So these are some of the normal points that we can observe points. Then along with, in the first assessment year only, I will give a certified copy of the partnership instrument without fail, along with the return of income in respect of the first assessment year, for which the status of firm is claimed. If the return is made after the dissolution of the firm, then it should be certified by all the partners except for minor partners who are partners in the firm immediately before dissolution. So basically, certification shall be done by all the partners except for minor partners. First of all, can minor become partners? No. Here minor partners means what? Minors who are admitted to the benefits of partnership. Minors cannot be partners. Minors can only be admitted to the benefits of partnership. That's it. Next, if the firm is assessed as a firm, it shall continue to be assessed as a firm for subsequent years, as long as there is no change in the constitution of the firm or the profit sharing ratio. Once there is change in the profit sharing ratio, things will vary, keeps on changing. Now, section 40BA, if you quickly see, this talks about your interest and remuneration. All this we'll have to see, but check this out. Bricks, same we saw in AOP BOI. Bonus, remuneration, interest, commission, salary. When will the bricks be disallowed? When will the bricks be disallowed? In case it goes beyond 40B limits. If it goes beyond 40B limits, then the bricks will be disallowed. Guys, compare it with AOP BOI. It will be easier for you. In AOP BOI, when will the bricks be disallowed? Is there any limit or all cases? All cases. Only there are exceptions which were there. Explanation 1, explanation 2. But in partnership firm, bricks will be disallowed only if it is exceeding the limit. That limit is changed in Finance Act 24. That's why that limit they can ask in the exam. The old limit last time ever or exam. November 24. If 184 conditions are not followed, what are 184 conditions? Partnership deed should be in writing, share should be mentioned, certified by all. Partnership deed should be in writing, share should be mentioned, it should be certified by everybody. If section 184 conditions are not followed, then I'll have to go to the provisions given under section 185, which we'll see. And the third one, I'm telling when will bricks be disallowed. First one, whenever there is an excess. Second, if 184 conditions are not followed, means what? Partnership deed is not in writing, share is not mentioned, and it is not certified by everybody. Nobody, only one or two sign, not everybody signs. So then the bricks, 185 says bricks will be disallowed. Third case, 184(5). Now you will appreciate because we have done assessment procedure. If AO invokes best judgment assessment under 144, bricks will be disallowed. So bricks will be disallowed under three scenarios. Excess under 40B, normal case. Then if 184 conditions are not satisfied, it will be disallowed. And if the AO invokes best judgment assessment under 144, it will be disallowed. Understood? This is a combined reading of all the three sections. How will the assessment and liability be done? This chart will help you understand assessment and liability. Assessment and liability, reconstitution, where change in the partners, change in the PSR. Reconstitution will happen under section 157. When there is reconstitution, assessment will happen under section 187. Change in the partners, change in the PSR will be called as reconstitution. 3 partners are there, 1 partner goes out, 1 partner comes in, reconstitution. 2 partners go out, 1 partner comes in, reconstitution. All the partners exit, new partners come in is not reconstitution, that will be succession. Right? So, we should understand whether it is reconstitution, succession or dissolution. 3 partners going out, 3 partners coming in, brand new firm, succession. Or same partners, PSR is changing. So, in between the partners they are saying 25%, now they are changing the PSR. So, change in the partners, change in the PSR, 187 will be taken into account. Succession will be other than 187. For all cases other than 187, I have to go to 188. And the assessment of succession is 170. Dissolution or discontinuance, assessment is done in 189. So, in the exam, when they ask you a question, you need to clearly see first of all, is it reconstitution, succession, dissolution. There, if you goof up, the entire answer is gone. So, if new partners come in, old partners go out, few of the partners, reconstitution. Change in the PSR, reconstitution. Old partners go out, all new people come in, succession. Dissolution or discontinuance, section 189. What about the liability of partners? Liability of partners under 188 capital A is joint and several. It is joint and several. Means what? Each partner is liable individually, each partner is liable together as well. Whereas LLP, it is covered under 167C. You tell me, in LLP, is it joint and several or is it only joint? Yes, in LLP, it can never be individual liability. It is always joint liability. That's the only minor difference. Right? So, please write down this chart, guys. This is an important chart because you need to figure out all these other things are all okay. Okay, this also you write down. When will BRICS be disallowed? Quickly. These are some important charts. That's why, quick. I wouldn't tell you otherwise. When it's kind of important, we need to do it. When will BRICS be disallowed? Excess under 40B, if it is done, 184 conditions are not followed. What is 184 condition? Partnership deed in writing, share mention, not mentioned, for example, and it's not certified by all. So, these minute points they'll ask in the exam. So, that is why we should be little alert. Otherwise, no tension. That minute points is what we need to see. Those questions are being, I will send that to you once it comes, nothing to worry. Next, this you write down, guys. This is the entire assessment and liability chart. Done? Yes. You see, assessment when 184 is not complied with, already discussed. Only the interest disallowed and any of the above are the same shall not be chargeable. So all this will be disallowed. Change in constitution means what? Let's discuss one by one now, because now it says here change in PSR, change in partners or change in PSR. So what are that? We'll see here the law. If one or more partners cease to be partners other than death of the partner, or one or more new partners are admitted, such that some or all partners of the firm before the change continue after the change, then it is called change in constitution. Example, PQR were partners in the firm, PQ change in constitution, PQ move out, change in constitution, PQR in that P moves out, A comes in, it becomes AQR, change in constitution. PQR is there, in that P moves out, Q moves out, A and B come in, ABR, change in constitution, change in constitution. So in this case, all this will be change in constitution, right? All the partners are continuing, but there is a change in the profit sharing ratio, that also, guys. For example, P 20%, Q 20%, R 20%. That got shifted to what? P 30%, Q 60%, R 10%. This is also change in constitution. Change in PSR, change in everything will be called change in constitution. That's what they're trying to tell. What is succession then? Where a firm carrying on a business or profession is succeeded by another firm and it is not a change in constitution, then separate assessment shall be made in accordance with the provisions of 170. Like PQR, all the three partners move out, new partners come in ABC. This is an example of succession. According to section 170, the predecessor firm shall be liable to be assessed in respect of income of previous year in which the succession took place up to the date of the succession. The successor firm shall be liable to tax in respect of the income derived after the date of succession. So one is up to the date of succession, one more is after the date of succession. So in case of death of any of the partners, I will come to the death part. Where there is no, okay, these two we will see. So basically, coming to the death of a partner, guys, what do you think? Death of the partner, will it result in dissolution of the partnership deed or what? What do you think? And how will they be assessed? All that we will check. Joint and several liability of partners. Where any tax, penalty or any other sum is payable by a firm, every partner of the firm during the previous year and the legal rep of the deceased partner shall be jointly and severally liable, including the legal rep of the deceased partner. Will be jointly and severally liable. For the sins of the father or mother, the legal heir should bear the brunt. But the thing is, tell me, can you open up the liability to such an extent that it will be personal liability for the legal heir, or only to the extent of share from the partner? Yes, share for the deceased partner. Liability of the legal representative cannot exceed the value of estate inherited by him. That is very clear. Section 159(6). No need of any section numbers, just follow the charts, more than sufficient, guys. Only charts, nothing else. Just charts. A, B, C are partners in a partnership firm. Mr. D became a partner on 14th August. Became a partner on 14th August. A retired from partnership on 27 September 2021. In this case, partners A, B, C shall be liable till previous year 18-19. Why? Because they retired when? On 14th, Mr. D became partner on 14th August. Mr. A retired from partnership from 27 September. A, B, C shall be liable till previous year 18-19. Partners A, B, C, D shall be liable from previous year 19-20, 20-21, and partner B, C and D shall be liable for previous year 21-22. That is the rule. So, to make you understand more, in a succession 188 capital A, check this out. See, 1-4-24 Messrs PJC were there. On 36-24, P, J were there, C left and K came. Is it reconstitution or succession? Reconstitution. So, I will only file one ITR and only one assessment. Now, in the previous year 24-25, notice will be given to whom? Existing partners or all partners? For the previous year 24-25, all the partners, who all were there? PJCK. So, PJCK under section 188A, it will be given to everybody. It will be given to the firm, obviously, addressed to these four partners. Example number 1. The best thing is here. Guys, on 1st April 24, PJC was there. 2nd April, C retired. Just one day. 2nd April, C retired. Or let's say 1st April only retired. Assessment notice will come to him also or the remaining partners. Just one day. For C, I am asking. On 1st April 2024, C was already a partner. Afternoon, he resigned. From 2nd onwards, he stopped coming. Year ended 31st March 24. For the previous year 24-25, that is 1st April 24 to 31st March 25, notice will be given to whom? C also, 100%. Because in Partnership Act, if C retired on 1-4-24, Partnership Act says until public notice is given. That is on 1st April. But Income Tax Act says full year 24-25. This is as per 188A. And what about the new partner? That's what it says. If you see here, it says every partner during the previous year shall be jointly and severally liable. So, definitely will be liable. Now, in the same example, C retired and later died at the time of assessment. He retired here in this example and he died. His assessment, it was, C's liability was assessed as 1 crore. Is a legal heir liable? Yes. See, legal heir liable, yes. C's legal heir has inherited C's property worth 3 crore, worth 50 lakhs. If he has inherited property worth 3 crore, the legal heir's liability will be 1 crore. Why? The father's liability was 1 crore. If he has inherited property only worth 50 lakhs, then his liability will be 50 lakhs. Legal heir did not inherit anything. Liable, not liable? Not liable. Right? Yeah. C was RCB fan. C died. So C's legal heir got what? Whatever RCB has been getting. Nothing. Right? So that's it. So basically, did he get anything? Nothing. So legal heir also is not liable. This is 159.6. No need of section number, just concepts, that's all. Yeah. They got a Superman. How did they get? Super. But they were in the first 10,000, 20,000. Otherwise, impossible. Good for them. Let them enjoy. So next you see 167C is same as 188A, but there is one exception. In case of, see guys, even here, no, the same example you take, what if it was a LLP? What is your answer? Same example, no change whatsoever. What if it's a limited liability partnership? What about limited liability partnership? Anything changing or no changing? No change. So tell me one thing. If C is also liable, okay, yeah, but it's a LLP. The fraud was committed by P, J, and K. Will C still be liable? If it's a LLP, it's a LLP. I'm asking this section. See here, you only wrote down, no, 188A joint and several. I am talking about this 167C. I am talking, so please see in the question what they have given. Partnership firm, you are 100% right. I am just changing the same example to LLP. I am saying C, P, J and K, they had committed fraud. C had not committed fraud. But is he still liable? Yes. So if we can prove that it was gross mismanagement and fraud committed by other partners and not him, then he can escape. This escapement is not possible in partnership firm. In partnership firm, they have to pay to the, the department and then recover from the partner, erroneous partners rather. See this, read this point, 167C. So please see in the question what they are asking, guys. That is most important. Please read that. When tax due cannot be recovered, every person who was a partner of an LP at any time in the previous year will be jointly and severally liable for the payment of tax due. Or in case partner of LP proves that non-recovery cannot be attributed to any gross negligence, misfeasance, breach of duty on his part, he shall not be liable for payment of taxes of LLP. So he has to prove gross negligence, misfeasance, breach of duty. It was not my negligence, it was somebody else, that is other partners. This saving is not present in the case of a partner of a firm. Very, very clear. For partner of the firm, it is not allowed. So guys, in this case, 1/4/24, 30/10/24. In 1/4/24, PJC was there. On 30/10/24, PJC exited, ABD came. Will there be two assessments or one assessment? Will there be two notices? One notice. Two intimations, 143(1) or one intimation? Is this first of all reconstitution or is it succession? Succession. So guys, in succession, there will be 2 ITRs to be filed and 2 assessments. That's the beauty. One assessment is 1/4/24 to 29/10/24. Other assessment is 30/10/24 to 31/3/25. 2 assessments, 2 intimations, 2 ITRs, everything 2. Now you see, interesting example. 1/4/24, PJC is there. On 36/24, guys, P and J are there. C exits, B comes in. On 30/10/24, P, J and B is there. J exits and A comes in. On 31/3/24, PAB, P exits and D comes in. My question is this reconstitution or succession? At the beginning of the year, different partners. End of the year, different partners. In the end, lastly, what do you think, guys? This issue went to court to understand whether, because the assessment will vary, as I told you, it will come, reconstitution is 187, succession is 188. Reconstitution, 1 assessment order, 1 return. Succession, multiple. What should I do? Reconstitution, succession. So, yes, it is not succession because there is no sudden replacement of all partners. In succession, it is very sudden. 3 people go out, 3 people come in. It is a sudden thing. This is a gradual change throughout the year. So, in case you want to do succession, but you don't want to have those, provisions or problems, what will you do? Keep rotating like this one partner, and in the end you do, so that you can avoid. That's a legal way of doing it. You can avoid succession by doing this. That is ultimately succession only, but it will be in the nature of reconstitution. My question to you is very simple now. If a partner dies, will the firm come to an end? There are 5 partners, 1 partner dies. Is it dissolution? Again, I am asking the same thing. If 1 partner dies, is it reconstitution or is it dissolution? Because if it's reconstitution, 187, dissolution, 189. Change in partners, 5 partners there, 1 partner dies. Change in partners? Or is it dissolution? In Partnership Act, just asking. 1 partner dies, dissolution? Yes. Is it succession though? No. So if the rest of the partners continue, what will happen to the firm? Is it like reconstitution or dissolution? So let's see that same dialogue now. All these are hidden points, guys. You see, very simple. Death of a partner. Partnership deed is silent. And if partnership deed says, firm will continue. Guys, if the partnership deed is silent, deadly, section 42 of Indian Partnership Act says firm is dissolved? Very, very simple. Section 42 of Indian Partnership Act says death of the partner results in dissolution. If you don't want that to happen, you should mention in the partnership deed saying that death of one partner will not result in dissolution. So then what happens? If the partnership firm is dissolved, section 189 of Income Tax Act will apply. Most important thing in exam, if question is silent, consider firm is dissolved. Now, partnership deed says firm will continue. Section 42 of Indian Partnership Act says subject to the contract. Firm is not dissolved. Reconstitution 187 will happen, guys. It is a case law laid down in Shakti Trading Company, Supreme Court judgment. Can it be succession though? It can also be treated as succession under 188 and two assessments can be made, one after death and one before death. Ayya Narappan case law, Supreme Court. So it can be, as per Shakti Trading, it can be reconstitution, or there is a one exception, can be treated as succession. You can write a note in the exam and take whatever you want. So write down this chart, important chart, guys. That's why I have made charts so that normal stuff everyone can study. These are the hidden points which are there in the examination, which will help us understand. In the exam, what do we consider? Dissolved. In case question is silent, only dissolved. We done, guys? Yes, next. Okay, guys, next comes the most important thing, 40B. Why very important? It has been changed in Finance Act 24. So for November 24 exam, the last time ever these limits will come will be the exam, November 24. Bricks. In that, first of all, interest and remuneration. 4 conditions for interest and remuneration. The interest and remuneration should be authorized in the partnership deed in writing. Point number 1. Should be authorized partnership deed in writing. Point number 2, maximum interest is 12% as per Income Tax Act. Admissible amount is restricted to 12% per annum. More than 12% disallowed. Third one, it is only to the period falling after the date of the partnership deed. Anything paid before the date of partnership deed not allowed. You cannot go and say, sir, I started the partnership orally 1 year ago, but the deed we entered now, I don't care. Whatever you did before will not be taken into consideration at all. I will not even consider it. Fourth one, even though the Partnership Act says you can give remuneration, first of all, you cannot give remuneration. Even if you give any remuneration, you can give it to any partner. But as per 40B, it is very, very clearly written, it is only to whom? Working partner. Only to working partner. Interest and remuneration should be partnership deed in writing authorized. Interest maximum 12%. Only the period falling after the date of partnership deed. Remuneration should be given only to the working partner, nobody else. Similar to AOP BOI, we should see that if you remember in AOP BOI, was there netting off allowed? Setting off? Yes. Let's see the same example here. Onion and Nandini. Nandini and Company is the partnership firm, Onion is the partner. This Onion is a little baby onion, yes, yeah. So, Nandini and Company gives interest on loan 5,000 rupees to Onion because Onion would have given the loan. Also, interest on capital is being paid to the tune of 3,000 rupees, whereas Onion is paying Nandini and Company interest on drawings. If this were to be AOP BOI, is there set off? AOP BOI, yes. In a partnership firm, is there set off or not? So, yes, AOP BOI netting off is allowed. In a partnership firm, no netting off is allowed. They can give a similar question and say, what is the answer in partnership firm? What would your answer be if it's a AOP BOI? MCQ 1, I mean both option, each option will have both the adjustments. Anything. Those are the differences, guys. So, guys, what is the answer? 5,000 and 3,000 allowed, subject to 40B. 5,000 and 3,000 because it's an interest on loan, interest on capital, both are allowed, subject to 40B. 7,000 will be my income from PGBP. 7,000 will be income from PGBP. Clear? Yeah, 40B, subject to 40B, that is. What is 40B? 12% interest is allowed. Then remuneration will be as per the interest on loan. Again, any interest you see here, any interest is admissible to the tune of 12% per annum. So, depends on the principal amount, overall 12%. Yes, any interest is covered, not just interest on capital. Yes, now comes the master chart. Very important chart. I'll give you time to copy, but please listen first. Master chart on salary, interest, bonus, commission subject to 40B calculation. For a sleeping partner, the entire concept of bricks for a sleeping partner is disallowed. Working partner to be mentioned in the partnership deed means who is the working partner we should mention in the partnership deed. Only to that fellow it is allowed, sleeping partner disallowed. Remuneration to working partner, if it is not in accordance with the partnership deed, then it is disallowed. As per Indian Partnership Act, section 13, if deed is silent, no remuneration is payable. So if they say remuneration is paid to this, but it is not in accordance with partnership deed, then full amount is disallowed. So this is one area where they will also give importance to Partnership Act. So I have written those provisions here. So no need to read Partnership Act. What if the deed said remuneration is payable, but it will be decided at the end of the year? Allowed, disallowed? He has never told remuneration will be as per 40B limits. He has just told remuneration will be payable, but decided at the end. So AO had disallowed this, but it went to CBDT. CBDT said either give the exact amount, 2 lakh, 3 lakh, 4 lakh. You say you will pay it at the end. No problem. Tell the amount in the partnership deed, or at least give the basis. What basis? It will be 5% of the income of the profit. 2% of the basis you give at least. Blindly, if you say we will see at the end of the year, then full amount disallowed. Full amount means to the tune of 40B basically. 40B limit it's allowed. Up to 40B it's allowed. So here what happened? The AO said up to 40B it didn't even say 40B, they said it will be paid at the end of the year, decided at the end of the year. What will you decide? Then you can't randomly decide whatever it is. So they said it will be allowed if you give the exact amount in the partnership deed or give a basis, otherwise it will be disallowed. But everything is subject to 40B limits, please note that. Write these two. I'll just give you the full structure. One by one you write down this. Then later we'll explain. 1, 2, 3, 4, 5, 6. 6 items are there. You can write it one after the other, I don't care. But these are the important points. First write down these two, please. These are all adjustments will come in this chart only. That much I can tell you. All adjustment in this chart. So a little bit your life will be easy if you just study this and go. Important point, that's right. Then one day before the exam, just study this and go. No need to touch the notes. Done. Down also here. Deed, can they say remuneration is decided at the end of the year? AO disallowed this. Severity circular, exact amount in partnership deed. Basis if it is there, allowed, otherwise disallowed. Right. So next 2 points, guys. Is there any retrospective change, guys? Can I do a retrospective change of the remuneration? Partnership deed as on 1/4/22, no remuneration. 1/4/24, retrospective change. From 1/4/20 to 1/4/24, no, disallowed. Similarly, however, retrospective enhancement is allowed. Retrospective, what do you say? Where basically earlier it was already there 50,000, now I made it 65,000, no problem, because it will be well within the 40B limits. Extra portion anyway I will disallow. Retrospective, where earlier it was not there at all, now I am amending, that entire thing is disallowed. Two other things, write down. Done. Interesting concept, interest on capital. Tell me, interest on capital, is it paid or payable or not payable? I mean, in what sense? So let's see. Interest on capital, generally it is not payable as per section 13 of Indian Partnership Act. But if deed allows, then Income Tax Act also allows up to 12%. So much of the provisions of this applies only if the partnership deed also allows. On the other hand, I'll give you time for this. You can write both together. Interest on loan, rate can be fixed by the deed. If deed is silent, rate is 6% per annum. Income tax allows maximum 12% per annum. Any interest paid without authorization by deed is disallowed even though partners have offered it to tax. Best part. If it is not authorized by the partnership deed, it is disallowed even though the partners have offered it to tax. Imagine. So even if you have paid tax on that, have offered it to tax, I don't care, it is disallowed. So if you disallow, firm has to pay, not the partners. So write it down, guys. Interesting points. Just stick to these adjustments, that's it. No tension. Kerala High Court. People are asking me, did you get Coldplay tickets? I said I got cold tickets, then I'll only play at home. Yeah. But your friends are lucky, man. Good. Lucky in the sense they have worked hard. It's not luck actually. You have to be alert. But it also depends on your internet and many other factors actually. Oh, he's geeky. Did he put a, what do you say, software, what do you call that, the prompt and the entire code? No. I'm sure they would have done, man. I checked on ChatGPT already. You can write a code. I got the code also. I just need to figure out the what to insert. These engineering fellows will do. I'm sure he has done it. Otherwise, not possible. So it will be filled with engineers that day. But the problem in India is 50% will be politicians and all will be sitting. They wouldn't have heard about Coldplay in their life. They'll be sitting in the lounge and all. That's the problem. D.Y. Patil Stadium, that fellow itself is a politician. So he was, the entire area is political area. So you need to give no free passes and all those things. So many crazy. Actually, in Pune also, D.Y. Patil, half the city is owned by him only. Crazy. Yes. So, very simple. Interest paid without authorization by deed is disallowed even though partners have offered it to tax. This is like the master chart. Beyond this, nothing can come. Everything is covered, all iterations, everything possible. We have actually covered most of it, man. We've covered all the areas. Charitable is there, PDS is there, and international tax we'll do a little bit. Decent. In 5 more days, we could have finished it off in a decent way. Next time I'll plan. Because other areas you can do on your own, all the major parts, including the special rates of tax, everything. Novel distributing agencies, yes. Cool. So we'll just take a break and we'll finish the remaining part. Now, after the break, immediately we'll take which one? 40B. That 40B is what has changed, right? That we will take it up immediately after the break. Okay, guys, we'll finish it off. Come on. Done. Right. So this we'll finish the partnership firm part now. Now coming to the main thing. Finance Act 24 as amended. Let's not see the amendment. Let's just see this. Anyways, there in the notes. It's okay. We can come to the notes. Yeah, this one. Page K5. Interest, how much is allowed? 12%. Remuneration, how much is allowed? This much. On the first 3 lakh rupees, first of all, I have to compute something called as book profits. On the first 3 lakh rupees, or in the case of a loss, it is 1,50,000 or 90%, whichever is higher. On the balance, it is 60%. So if I compute the book profit to be 7 lakh rupees, when I compute the book profit, it comes to 7 lakh rupees. On the first 3 lakh rupees, 90%, that is 2,70,000. That is 2,70,000 or 1,50,000, 1,50,000 or 90,000, 90%, whichever is higher. So 1,50,000 or 2,70,000, whichever is higher. Which is higher? 2,70,000. On the balance, 4 lakh, 60%. 2,40,000. 2,70,000 plus 2,40,000, how much? 5,10,000. So if you have paid 7 lakh, how much is allowed? Or let's say this is a book profit, you have paid according to the book profit only. You have paid 7 lakh, assume. If it is 5,10,000 only is allowed. What is the excess? 7 lakh. So 7 lakh minus 5,10,000, that is 1,90,000 will be disallowed. That's how we should look at it. But what do you mean by book profit, guys? Net profit as per P&L account plus remuneration paid or payable to partners if the same has been debited to P&L account. And any current year depreciation and unabsorbed loss of depreciation, if any, to be adjusted if not debited to P&L account. So net profit as per PGBP plus remuneration paid or payable to partners if the same has been debited to P&L account. Any current year depreciation and unabsorbed loss of depreciation, if any, to be adjusted if not debited to P&L account. So first of all, remuneration paid or payable you should add back because I am computing that only, so I should add it back. Any current year depreciation, any unabsorbed loss of depreciation, if any, to be adjusted if not debited to P&L account. So the deductible amount of interest and salary shall be the amount payable as per the partnership deed or amount calculated under section 40B, whichever is less. Disallowance of remuneration to partners shall be made for a firm if the partnership deed does not specify the amount of remuneration payable. This we have already seen. So basically, this is the calculation. Book profit. Net profit as per P&L account, give effect from 28 to 43C, which means same as follow PGBP. And ultimately add remuneration if debited to P&L account. So 28 to 43C, entire thing you have to follow. Net profit as per P&L account and give all the effects of 28 to 43C. 35 AD, 32, additional, everything you give effect. Finally, you will get one item, one figure. Plus remuneration if debited to P&L account, because I am computing the book profit. So I have to add back the remuneration. That is what it is. Now, if you remember, there was one concept called representative capacity, individual capacity and stuff. So regarding that, 3-4 things we have to do, which AOP BOI, what do you think? We had discussed the same thing in AOP BOI. If I give something in representative capacity or in personal capacity. So ultimately, if you are a member of a, AOP in the individual capacity, then whatever is given to you will be not allowed. But if it's given in the representative capacity, it will be allowed. On the other hand, if you are sitting there in the representative capacity, then whatever is given to you in an individual capacity will be disallowed. We just saw it in AOP BOI. Here we will see. That is given in point number 5. Yeah, point number 5. Everything is covered in point number 5. Representative capacity, individual capacity. Example. Mr. Iqbal, because he has one strand of hair. These are also little PJs. Yeah, correct. So he is what? A HUF in the partner of Ball and Company, which is a partnership firm. Mind you, HUF is the partner, guys. HUF is the partner in Ball and Company, and Mr. Iqbal is a Karta. He is a partner, tell me, in individual capacity or representing the HUF. That is very clear. He is only representing the HUF. He is not a partner. He is not a partner in his individual capacity. He is a partner only in the representative capacity. That we have established very clearly. First of all, he has given a personal, in the personal capacity, he has given a loan 10 lakh rupees to Ball and Company. Second, that interest on loan is getting 12,000 rupees. Interest on loan is getting 12,000 rupees. Third, Ball and Company is giving interest at 10,000 rupees on the capital of the firm. So first he is getting what? Interest on loan 12,000. He has given the loan in what capacity? Personal capacity. And third, he is getting interest at 10,000 on the capital of the firm. All the three things he is getting. First and foremost, guys, interest on loan 12,000, allowed or disallowed? He is getting the money as a partner or in personal capacity? Personal. So will 40B come here? No, because he is not taking the money in the as a partner, he is taking in the individual capacity. So check this out. 12,000 rupees. What is this 12,000? This one, interest on loan. This 12,000 rupees will not come under 40B. 3613 will be allowed subject to 48. What is 48? Excessive payment, unreasonable payments. Similarly, that 10,000 rupees interest on capital of the firm, that will be what? Covered under 40B, because that he is getting in the representative capacity. Explanation 1 to 40B. Just copy this, guys, and just stick to this example only. Don't see the notes. It is little confusing, it may get. Just stick to this, very easy. And compare it to your AOP BOI also. Just stick to this. Very simple. Copy it down. 2 minutes it takes. When you write along with, applying your mind, definitely you will be able to. You don't need to study only later. You don't have to study at all. Done. Next point. So there is a HUF in personal capacity only. Karta in personal capacity, he is I'll just change this to make it is actually all these are little Kannada names. So let me just change the names. Mr. A is the Karta, HUF B partnership firm C. Make it simple. So, so Mr. A, Karta in a personal capacity is a partner in the firm C, and the HUFB has also given a loan 10 lakh rupees to the partnership firm. Now, partnership firm is giving interest on capital to Mr. A. Partnership firm is given interest on loan to Mr. A and also taking loan from from HUFB and giving interest also. This interest on loan given by B to HUF, he has to give it to him only. No choice. Now tell me, interest on capital 10,000 rupees. Very simple. What is this? Is it 40B? Yes, there is 40B. Very simple. Then what about interest on capital? Interest on loan given by HUF 15,000? That is given in the representative capacity. No problem. Hence, 3613 will come subject to 48.2. 40B will not come for sure. This is explanation to 40B. Quickly copy this, guys. Very simple. This you can compare it with AOP. In AOP, what was the dialogue? Here only disallowed portion is the excess. Whereas in AOP, full everything is disallowed. And in AOP also similar concept we have seen. So these examples study and go. No, nothing else to study. Done? Next. Third example, guys. If you remember similar example I gave in AOP BOI. HUF is a partner in the partnership firm. Karta is working in the partnership firm getting 10 lakh rupees salary. What do you think? Karta is working in the partnership firm getting 10 lakh salary. HUF is the partner. Allowed, disallowed? So 40B limits is 6 lakh. Will 4 lakh be disallowed because it's getting 10 lakh? 40B applies. 4 lakh is disallowed. Explanation 1 and 2 will cover only interest, same as AOP BOI. This need not write, but generally, basically you can say 40B only covers what? Interest. It will not cover remuneration. One interesting case law, Kishori Lal and Sons. In the partnership deed, you had mentioned 40 lakh as salary. And let's say it's well within the 40B limits, no problem. But he's just a BCom guy, the partner. He was getting 40 lakh rupees salary. The assessing officer invoked 40A2. Remember 40A2? Excessive payments, unreasonable payments of related party. For a partnership firm, is partner related party? Yes. So he said the same guy, same thing, he will be getting 5 lakhs. You are getting 40 lakhs. 35 lakhs he disallowed. Correct or wrong? He disallowed 35 lakhs. Kishori Lal Sons. So guys, partnership deed allowed, terms and conditions allowed, remuneration as a body we allowed, it is 40 lakh, similar employee 5 lakh. AO, this is Great City Manufacturing case law. So AO invoked 40A2, disallowed 5 lakh. What do you think? If remuneration is within 40B, then will 40A2 come? No. If remuneration is within 40B, then 40A2 will not come. So guys, no 40A2. It is well within the limit, no? It's well within the 40B limit. Hence, no 48. Next, section 78, that is carry forward. Can I carry forward the losses? Partner retires. Loss proportionate to him is certain amount. Loss proportionate to him is 1 lakh. When you do the reconstitution, re-accounting, he will get 1 lakh rupees as the loss. Loss proportionate to retiring partner, is there carry forward? No. Death of the partner, but firm is continuing. Loss proportionate to the deceased partner is given, is there carry forward? No. So in retirement and death, there is no carry forward. Retirement and death, no carry forward. Admission and change in PSR. There is admission and there is change in PSR. Can you carry forward the loss? Yes, loss can be fully carried forward, no problem. And one more deadly point, guys, why people don't go for succession is there is no carry forward benefit to successor under 78(2). So there is no point of succession unless it's like a full takeover. In all these three cases, can you claim unabsorbed depreciation? Yes, unabsorbed depreciation can be carried forward. MCQ, they'll ask, they have asked also, copy down this chart quickly. Unabsorbed depreciation 100% allowed. Yes, unabsorbed depreciation allowed. Which one? Unabsorbed, yeah, unabsorbed is allowed. Guys, so that is regarding partnership form. So same thing is given here, everything you can check. That's about it. HF will quickly see, nothing there in that actually. We'll quickly see all the important pointers of HF, hardly anything. L1. So with this, we'll complete all the assessment of other things except charitable. HUF L1. Hindu undivided family, as the name suggests, is governed by all the important pointers, just 2 pages, that's all. It is governed by Hindu law, not applicable to Muslims. Second, it's a separate legal entity, HUF, with a nucleus, ancestral property, and derived income from property is all assessed to tax. 2 schools of thought are there, Dayabhaga school of law and Mitakshara school of law. Dayabhaga school of law is prevalent in West Bengal and Assam. Eldest member of the family is Karta and administers the HUF, and sons do not have the right to any partition. On death of the Karta, eldest member becomes the Karta. Mitakshara school is prevalent in the rest of the country. Co-parceners get the right to share the property and right to partition by birth itself. Are female members allowed in the HF? Yes. Can a female member be a Karta? Yes. A landmark judgment a few years ago. If there's only female member in the family, female member also can become the Karta. HF consists of lineal descendants of a common ancestor and includes their wives and unmarried daughters. Yes, from 99-2005, a daughter of a co-parcener becomes a co-parcener in her own right. Other female members like mother, daughter-in-law continue to be members of HF but do not become co-parceners. Female members will be co-parceners of the families in which they were born. Because daughter-in-law and mother, they will become HF co-parceners in the families in which they were born, not the families which they get into. Sad, but that's how it was at that time, many years ago. I'm talking about hundreds of years ago. The Karta of HF can enter into partnership with others. The other members of the HF do not become partners in the firm. However, the creditors can proceed against the assets of the HF, including those of non-partner co-parceners also. So, just because you become you're a member doesn't mean that I can go against you, is what they thought, but no, you can definitely go against anybody who is there the members. Status of HF is abolished in Kerala. Partition of HF means dividing the properties of HF amongst all its members. Partial partition of HF is not recognized under the Income Tax Act. Either there is full partition or no partition. Only total partition is recognized, after which the HF will cease to exist. If you remember capital gain, partition, on partition if you get something, is it taxable or not? Not taxable. And we discussed one more thing. For the HF, member is a partner. So HF giving something to the member, exempt. Reverse, member giving something to HF, tax. Yes. Partial partition means partition with reference to a few members or certain property or both. Receipts from income of HF to a member of HF is exempt from tax under 10(2). Assessment of HF, section 171, total partition. AO to enquire the claim of partition by giving notice to all members at the time of making the assessment. AO to record findings and complete the enquiry. Date of partition is to be recorded. Total income of the joint family up to the date of the partition is to be assessed as if no partition had taken place. So what should I do? You should inquire about the claim, AO to record the findings, and one thing is to check is date of partition. And total income of the joint family up to the date of partition is to be assessed as if their partition had not taken place. All members to be jointly and severally liable for the assessed income. Why? After partition, whatever you give away, that is all exempt. So only till the date of partition I need to check. Partial partition is not recognized under income tax law. No claim that such partial partition had taken place to be recorded by the AO. Such family to be assessed as if nothing had happened. All members to be jointly and severally liable for the assessed income. So two important case laws, Supreme Court judgment. If a Hindu female inherits property from father or mother and dies without a will, leaving behind no children, such property would devolve on the heirs of the father. If the Hindu female inherits property from husband or father-in-law in the above case, such property will devolve on the heirs of the husband. This was Supreme Court judgment. So Hindu female is inheriting the property from her parents and she dies without any will, leaving behind no children. Then it will go where? On the heirs of the father. Devolve on the heirs of the father. Correct? So her father, their heirs. That is, if she has any brothers, sisters, it will go there, unfortunately. If the Hindu female inherits property from her husband or father-in-law in the above case, then it will devolve on the heirs of the husband. On death of a father without a will, property separated in partition and standing in the name devolves on the son in his individual capacity. Such an asset is not assessed in the case of HF. So it will not go to the HF, it will go to the son. That's what it is. Computation of total income of HF is very simple. Income from transfer of self-acquired property by individual for inadequate consideration is not considered as income. It will be included in the individual income. Why individual income? Because that will be, what do you say, self-acquired property. You have, of all the people, Karta has acquired from his own money. So will it be HUF property or his own property? His own property. Then one more thing, just look out for this dialogue, impartible estate. What do you mean by impartible estate? As the name suggests, that estate or that asset cannot be partitioned. This used to be given by the Britishers for spies. Indians only, we spied against ourselves. So when they actually told anything good, whatever, they used to give them an estate. They said this estate can never be partitioned. This is yours and solely yours. It will go to our legal heirs. Now legal heir also cannot partition it. It's an impartible estate. From the title, it's very clear it cannot be partitioned. Now, if many people are enjoying the fruits of that impartible estate, is it taxable or includable in the hands of the owner of the estate or in the hands of the HUF? Always in the hands of the holder of the estate, whoever it is. It could be the legal heir or whatever. Receipt to a member of HUF from the family income is exempt in the hands of the member. Yeah, that's about it. So that is regarding taxation of HUF. Very, very simple point. Nothing heavy duty in that. Very easy. So guys, in the penalties chapter, 2-3 changes you just make, and I'll tell you whatever changed in Finance Act 22 and 23 or 22 important ones, that only you study and go. See, the thing is very simple, guys. It's very impossible. Penalty is in 7.1. It is impossible for you to remember the penalties. So, right, it is tougher than getting Coldplay tickets, trust me, right? So, there's no point in sitting and only mugging up, but there are some at least amended sections you study and go. Maybe if it comes good, otherwise nothing can be done. So, guys, first of all, if there is any misreporting or underreporting of income, deadly provisions, 200% of the tax on misreported income you have to pay. Misreporting means what? Underreporting means income is 100 lakhs, you are showing 80 lakhs. Misreporting means what? Not showing only. So when they open all the proceedings, income escaping assessment, all that will come now. How much? 200% of the tax, deadly. Underreporting, you are shown less, 50% of the tax on underreported income. This is one part. And how will you compute that? I have made a chart, come down here, show you. There you go. Penalty for underreporting or misreporting income. I told you income tax is such that initially like heavy duty stuff, if you finish, then it's all the chilled out thing. I don't want to start the charitable thing now because I want it continuous, so we'll do it tomorrow. That's why I'm doing the all other things. In deductions also 2-3 important things are there, we'll discuss that. First time assessment, return not filed. Return filed for the first time under section 148. So we have already discussed assessment procedure, so it becomes very easy for us. Return is not filed. Return filed for the first time under section 148. If assessed income is more than the basic exemption limit, then it will be called as what is underreported income. Because assessed income is more than the basic exemption limit, you have not even filed the return, or you have filed after they have ordered you to file under 148, if you remember. Under 148, you have to file the return. What is the underreported income? It is company, firm, local authority. Underreported income is the assessed income. Whatever the income tax authority assesses under 147, that will be your underreported income. Because I need to know on what amount I should charge, right? Yes. On the other hand, for others, it is assessed income minus basic exemption, because you will not get basic exemption anyway. So for that, tax on underreported income will be underreported income plus basic exemption wherever applicable, if need be. Wherever basic exemption is not allowed in certain cases, only then. That we will see later, no problem. So ultimately guys, very simple. What is underreported income? Basically your assessed income. Everything will be called underreported. Return is filed if the assessed income is more than the income determined under 143(1). Then underreported income will be what? Income assessed minus income determined under 143(1). Very simple. What will be the tax on underreported income? That is underreported income plus income under section 143(1), everything. That is tax on income minus the tax determined under 143. The total income minus tax on total income, that is underreported portion and the full reported portion, minus tax on income determined already under 143(1). So balance tax I have to pay. And based on that now, what will happen? On that amount, whatever I told you, no, that amount, on that amount, what will come here? 200% of the tax. Here, sorry, 50% of the tax on underreported income. So scenarios also I have given in the chart. Reassessment case. What is reassessment? Can first 143.3 already done. Can I do 147 of 143.3? Yes. Can I do 147 of 147? Yes. Income on reassessment is greater than income assessed or reassessed just before reassessment. What they are trying to tell is the previous assessment. Income on reassessment under, let's say, 147 is greater than income assessed or reassessed just before such reassessment. Or let's say you are doing a 147 of a 147. New 147 is more than old 147. Then underreported income is reassessed income minus income already assessed before. Already discussed. Tax on underreported income will be overall tax, that is tax on underreported income now plus the income reported in the previous order minus tax on the income assessed in the last order. Very simple. Why I should do like this? Because guys, there will be changes in surcharge, cess maybe. So that's why I have to do exactly like this. Losses claimed are reduced or converted into income. What is that? Losses claimed, reduced or converted into income. So whatever you have claimed the loss now is more than what it was before, and later it was you come to the knowledge that whatever you have done is wrong. So that difference only you should take. Same, that is simple. So see the example here in 7.7. As per section 270 here, returned income is 10 lakhs. Income under section 143(1)(a) is 11 lakhs. Income assessed under 143(3) is 25 lakhs. What is the penalty under section 270A? As per 270 capital A, the person has reported the income as his income assessed is greater than the income determined under section 143(1)(a). Because income assessed is 25, returned income is 10 lakhs. So this will amount to under-reporting. So under-reported income will be what? Income assessed under 143(3) minus 143(1). 25 lakh minus 11 lakh, total 14 lakh. Tax payable on under-reported income is tax on full 25 lakh minus tax on 11 lakh, total 4,36,800. Penalty will be 50% of 4,36,800, 2,18,400. Deadly. Next penalty which has changed. 270A has not changed as such, but it's an important penalty. Yes, 271 AAB. I showed you one MCQ question also where they asked for penalty, right? Yes. Amended by Finance Act 22. Undisclosed income found in the search. And you are searching, you are finding undisclosed income. What is the tax or penalty? Why are they using penalty and not fine? Here, why are they using penalty and not fine? Is there any difference? On the amount, fine is on the fixed amount, no? Okay. Fine. Is it all fine? If I charge fine. So no guys, the difference is fine, penalty. Penalty is always paid to, fine is always paid to the court. Means if I impose fine, it will be to the NCLT, it will be to the High Court, Supreme Court, whatever. ITAT. Penalty is always paid to the internal adjudication mechanism. Penalty is always for the internal adjudication mechanism. Who is the internal adjudication mechanism? CBDT. They will give it to the CBDT. So undisclosed income found in search, 30% of in the following cases. What? SSE during search admits undisclosed income. Specifies the manner in which the income was earned. Pays the tax, interest, everything will pay. Furnishes the return of income also. Then 30%. If it doesn't do anything, if it still denies, if it doesn't pay the tax, 60%. This they had asked in 2 MCQs, I had shown it to you also. This is one more thing which we need to remember. See, one is this one guys, misreporting 200%, underreporting 50%. Next one, this one, 27 AAB, undisclosed income found in search, 30% if we cooperate, 60% no cooperation. 27 AAC, that also was amended in Finance Act 22. Unaccounted income in 68, 69, 69A, 69B, 69C. So this is unaccounted income. No penalty will be levied if it is already levied under 270A. 270A is also unaccounted, no, misreporting. If it's already done there, then okay. But if it is not done there, 10% of unaccounted income under section 115BB. That is separate. Under these sections, 68, 69, unexplained expenditure, unexplained credit, all those things, cash credit, those sections are different. (27) AD1, false entry. If you want to, while computing the income, you want to evade tax liability. So you will make a false entry or you will omit an entry, which was actually relevant for the entire discussion. So one entry of income you will omit, or an entry which has 36,000 of expenses, you will hike it up to 96,000. It is 100% of the amount of such false entry or omitted entry. AO or CITA may also direct that any other person who causes the person in any manner to make a false entry, he also has to pay. Yes. Then trust we will see that. Then TDS, if you have failed to deduct on these items, lottery, betting, online game, etc. TDS is amount equal to tax not deducted or paid. Online gaming, virtual digital asset, all these things you have to pay. How much you have to pay? The TDS, 30% or whatever percentage that they ask. If you don't deduct the TDS, amount equal to tax not deducted or paid, means that 30% will be the penalty, deadly. This because Nirmala madam wants then and there, online gaming, etc. No time wasted. Then and there I need the data. Other things we can leave. And if possible, you can also remember page 7.8, time limits for passing the penalty order for underreporting or misreporting. Where income is increased by the assessing officer in the assessment, AO shall levy penalty up to, if appeal has been filed to Commissioner of Income Tax Appeals, then change it to add JCIT appeals or ITAT. When order is passed by Commissioner of Income Tax Appeals, JCIT appeals, and no appeal is made to ITAT, they will pass within 1 year from the end of the financial year in which order of CIT is received by CIT. When order is passed by ITAT, 6 months. Here it is 1 year, here it is 6 months. When revision application is made in 264, we saw revision application today, then 6 months from the end of the month in which revision order is passed. Where no appeal has been made against assessment order, etc., then end of the financial year in which assessment proceedings are completed, or 6 months from the end of the month in which penalty proceedings are initiated, whichever is later. Let's say assessment is over on 1st October 2024. End of the financial year in which the assessment proceedings are completed, before 31st March 25. Or 6 months from the end of the month in which penalty proceedings are initiated. Penalty is initiated on 1st January 25. 6 months from the end of the month, 31st January 25 plus 6 months, which becomes what? 31st July. So 31st 3/25 or 31st July 25, whichever is later. Which is later? 31st July 25 is later. 31st July 25 is later. If possible, remember, that's all. Guys, one section 276 capital A. They had asked this in the exam also. It has been decriminalized from Finance Act 23. What do you mean by decriminalized? There is no jail time. Till that time it was 6 months to 2 years and fine. Failure by liquidator of the company to intimate appointment of AO or parts with assets without prior intimation to income tax authorities. Basically, if the company is going for liquidation, you have to inform the assessing officer about the entire process. So if you don't do that, 6 months jail time, guys, for the liquidator. There was a lot of fight and a lot of they went and said, what is this nonsense? Why should I go to jail? That's why they removed it from 1st April 23. But before that, it's still there. Old cases old prosecution will still continue. So now onwards, jail time is not there. So 276 C1 you can study and 276 CC. That's all needed. That's all. 2 things. What is that? Let's see. Willful attempt to evade tax, penalty, interest, chargeable or imposable under or under reports his income. Under reporting again. Tax evasion. If it is under reported income is greater than 25 lakhs, 6 months to 7 years and fine. This is called as, whenever law use the word and, it is non-compoundable offense. Non-compoundable offense means what? Yeah, you cannot escape imprisonment, 6 months to 7 years. Otherwise, 3 months to 2 years. So guys, if you do under-reporting, jail guaranteed. Penalty we already saw. Jail also. And guys, the most important thing is what? These are all deadly provisions. The key word is willful. So it should be proven beyond a reasonable doubt that whatever you did was willful. Basically, your criminal intention has to be proved. Criminal intention is called mens rea. That is, your criminal mind has to be proven. Willful failure to furnish return of income within the due date under 139, 1, 142, 11, 148. See, this is normal. This is when they ask you to file the return. 148 is after SCN of SCN, they'll give you this SCN to file the return. That if you don't do, if tax evaded is more than 25 lakhs, same provisions. 6 months to 7 years and fine, otherwise 3 months to 2 years. So both are the same. 276C is for evasion of tax. 276C is for not filing the return. My one question is, you didn't file the return also, evaded tax also. Will it be 14 years? Same offense. I didn't file that return and I didn't I evaded the tax also. Same assessment here, same offense. Yes, only one. That's about it. In chapter 6 deductions, guys, I will not do all this ATC and all those things that you can check, no problem. But we will see one section in that. Which is not added, but yeah, ATCCH. ATCCH, just for your knowledge, it is an amendment which came in Finance Act 23, applicable for November 24 exams. It's called the Contribution to Agnipath Scheme. Any idea what Agnipath Scheme is? What is it? Yes. If you want to join the army, I mean, of course, you have to have the normal other procedure. Apart from that, there's a scheme issued by the government for enrollment, and for which there is a Agniveer corpus which will obviously be there for everybody. So basically here, if you join the army for 2 years or 3 years, then you will be retiring and they will give you all the benefits. Now you can contribute to the Agnipath scheme. Any company or any, the SSC who is individual who is enrolling in the Agnipath scheme and who is actually subscribing to the Agniveer Corpus Fund, for him, he will be getting the deduction. So they are now telling you, please pay the money. You should pay into the corpus of this Agniveer fund, and that along with the interest at the time when you are leaving 2 years later, you will be getting it. You will be getting it. So this is not there. So I'll just tell you the gist of the story. Who is there? An individual enrolled in the Agnipath scheme. What is the eligible expenditure? Any amount paid into his account for the Agniveer corpus fund. Amount of deduction, whole amount of paid or deposited by the individual into the Agniveer corpus, and whole of the amount contributed by the central government to the account of the SSC in the Agniveer corpus fund. Guys, he also will pay, and additionally government also will pay the same amount. If I am paying 1000, government also will pay 1000. Benefit of this section is that only you will get double deduction. I paid 1000. How much deduction I will get? 2000. That's all. This is to assist and help the youth of the country to join the Agniveer scheme. That is the only reason why this deduction has come. This deduction, will it be available if you join the new regime? Old regime anyway available. New regime? Yes. So whether it's new regime or old regime, it will. So just gist of the story, only to individual, whatever amount you deposit, you will be getting whatever you deposit plus whatever government deposits. That's all. One more which they ask in CF final. Guys, one interesting thing, page 10 in my notes, usually one on here, purchase of electric vehicle. If they ask in your exam, what will you do? You purchased electric vehicle this year. On 1/4/23, you purchased, for R is 24/25, no? So 1/4/24 you purchase electric vehicle. What do you think? Will you get deduction? No. This one date you need to just vaguely remember that anything after 1/4/23, no deduction is available for new assets bought under 80 EEB. If I buy a hybrid BMW cycle, which normal cycling and also its hybrid version, which is where electricity is supplied, you would have seen hybrid cycles. Some 2 lakhs it is, 2-3 lakhs BMW. Will it, and assume I bought it before 31/3/23, will it be allowed? Is it vehicle under RTO cycle? CC, is that coming here? You see here. Electric vehicle means a vehicle which is powered exclusively by electric motor. Traction is supplied exclusively by traction battery and such regenerative braking system. This section does not talk anything about Motor Vehicle Act. So no need. Yeah. But maximum 1.5 lakhs. ATG. ATG, one important change has come. Since BJP government is there, FAST has been wiped out. That's the actual reason. I'm not even joking. Right? See, I am not for or against any party. Whatever is the truth, I tell you. All are crooks anyway. All are crooks. So, Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Fund, Rajiv Gandhi Foundation. Before one more Rahul Gandhi Foundation comes, so delete. Rahul Gandhi can be linked to this anyway. PM drought. He will never be. Yes. PM's drought relief fund. Yes. So that is what it is. That lady who died also, CA, and now it has become so political now. Rahul Gandhi has called their parents. Where was he all this time? Suddenly. Crazy. But anyway, because of that, if something happens, good. At least regulation, some regulation. Best part of the story is about overworking, Rahul Gandhi speaking. Right? So, I mean, it's the irony of it. Right? Anyway. PM's National Relief Fund. All this will remain the same, guys. See, in this 100% deduction is there without any limit. But in this 50% deduction is there. So, 50% deduction, these three are deleted from 1st April 24, which means, for our financial year 23, fully deleted. So, in case basically any contribution to Jawaharlal Memorial Fund, Indira Gandhi, Rajiv Gandhi Foundation will not give any deduction. Only doing the important points. And we have already discussed, again I am repeating, 22 and 23. Swachh Bharat Kosh and Clean Ganga Fund. Swachh Bharat Kosh is applicable both for resident or non-resident. Clean Ganga Fund is only for residents. So, if you want to beautify the country and you are living outside somewhere, you found the country dirty, so you ran away. So, at least now you can contribute some money, and if you can take that deduction if you want to, yes. But the thing is, if you have already applied in CSR, this will not apply. We have seen it already. Clean Ganga Fund, resident SSEs only. You clean it so that you can only float after you die. Right? So, resident SSEs only. Right? Clean Ganga Fund. Not in pursuance of CSR expenditure. Not in pursuance of CSR expenditure as per the Companies Act. During COVID, there was no Clean Ganga Fund needed. Everything got cleaned actually. During COVID, Ganga became so clean. In fact, there were dolphins etc. in the river Ganga. Really. Right? So, basically it's the humans. You don't need any fund to do all these things. Remove the humans, done. You should call Thanos. Right? That is what. Yeah. Then, yes, this is also very important, guys. ATIAC, last time ever, can come now. When I say last time ever, because of it's not a sunset sort of a thing, but what I am trying to tell is, you check this now, I'll tell you. Company or LLP, not LOP. So, what is the eligible business? See, it's an eligible startup. What is startup? We have already discussed. Pani Puri shop? No. It is that, it should be a scalable model, all those things. Byju's example we had given. So, innovation, development, same thing. High potential employment generation. Conditions, this company or LLP to be incorporated on or after 1/4/16, but before 1/4/25. 1/4/25, which means in our exam, ours is 1/4/24 to 31st March 25. If it is incorporated before, which means up to 31st March 25, then eligible. So, that's what I meant. It's like a sunset from now after till at least 25, sir. From 1/4/25, still there. 1/4/25, still what I'm saying is 1 or 2 items. After that, they'll forget about this. That's what I'm saying. How much you'll get? And what is what do you say? Startup. Turnover does not exceed 100 crore, we already discussed. Holds a certificate. Quantum of deduction, guys, 100% of the profits and gains from eligible business For 3 out of 10 assessment year, your choice. You can take any 3 out of 10 assessment year. You will not take in the first few years because anyway there will be a loss. So better to make losses 5-6 years, then make profits 3 years and then take full deduction. Deadly. Yeah. Which one? No. No carry forward. So startup should not be splitting up, and here machinery should be new. But again you see 20% can be second hand. Imported second hand shall be read as new, similar to 35 AD, similar to 115 BAB. Yes. Same. Similar to 115 BAB, similar to 35 AD, and this one 80 IAC. Housing projects useless because it's done already. In the sense, I mean, the 5 years is still continuing, but the last date was 31st March 22. Like that. So once it goes off, they will not ask the same question. There's no point. You can just go through these points. But these areas are where, I mean, there are better chances of those questions coming. Yes, this is important, guys. 80, not JJA, sorry. JJAA. 80 JJAA. H19. Who is an eligible SSE? Any SSE carrying on business whose books of accounts are subject to tax under tax audit under section 44 AB. So this is an SSE whose books of accounts are subject to tax audit. Who is subject to tax audit? 1 crore to 10 crore. 1 crore, more than 1 crore, anyway, you will be subject to tax audit. If your cash receipts and cash payments are more than how much? 5%. If it is less than 5%, then it goes up to 10 crore. But so this is not that person. This is a person who goes beyond that, which means big companies. Amount of deduction. This is what, guys, inserted by Arun Jaitley. He wanted you to hire more and more people. If you hire more and more people, on the additional employee cost, you will get 30% deduction. Which means salary additional you are paying 10 crore. On that 30% deduction you will get, which means you will pay, extra 30% you are getting. Which means your tax will be reduced by, the entire income expense will be increased by 30% because you are getting a deduction at the end of the day. Whereas tax savings on that 30% as well. 80 JJA provides 30% of additional employee cost as deduction per year for 3 consecutive years, commencing from the previous year in which the employment is provided. Again, it should be a new business and you should take an audit report of a CA 1 month prior to furnishing the return. Many CAs goofed up, so one case NFRA almost reprimanded him and before that debarred him also for a couple of years. I have put that video on my channel and don't watch it now, study for your exams. Yeah, but I'm just saying. So yeah, because they goofed up, because they had not read the provisions properly. Anyway, what is additional employee cost? Total emoluments, means all payments made to him, employed during the previous year. In case of an existing business, the additional employee cost shall be nil. If there is no increase in the number of employees. So guys, 100 employees were there, 20 I added, but 35 left and went. Is there additional cost? No. And if the payments are made via cash, not allowed. So there should be overall increase in the number of employees. That is point number 1. overall increase only you will get ultimately. Ultimately, it's about increase in the employees. So if there are 100, I added 20, 18 left, only for 2 you will get actually. For the first year of business, emoluments paid to employees employed during the previous year shall be deemed to be the additional employee cost. But anyway, what are the people who are not considered as additional employees if their emoluments is more than 25,000 per month? So this is predominantly the lower middle class, employment of the lower middle class. Up to 25,000 salary, if you appoint them, no problem. So it is not considered as additional employee if you pay more than 25,000 salary. So if there are 100 employees, you add 10 more, but you are paying them 35,000, those 10 will not be counted under 80JJA. Then if he does not participate in recognized provident fund, not to be counted. Which means he has to participate in the RPF. Entire contribution is paid by government under the notified employee pension scheme. So I read this, how, where, etc. I couldn't find anywhere. So when all routes are closed, call up boss. So I called VG sir. I asked, what is this? He also didn't know. Yes, correct. So then he also found out. He asked his connects who are there. Government pays the entire notified employee pension scheme, they will pay for the disabled. So if there are disabled people working, they pay. That is this section actually. Because even in the commentary, it is a new section. No, in the commentary also, they had simply given this word and escaped. They didn't know what is the practical applicability of it. So in Kannan Devan estate in Munnar region, near that area, so they had this, what do you say, near Valparai, sorry. So they had this, what do you say, the employees, if their children are disabled or differently abled, specially abled, they have one own company only for them where they'll manufacture these Starbucks cups. The paper cups which are there are manufactured by those kids there. Completely disabled, but still they're doing it. Amazing. So for all those pension scheme for all those people will be, if you apply to the government, they will pay, government will pay on the behalf of the disabled. So that such employees, are they covered even though they are getting less than 20,000, 25,000? No. Deadly. So if I have 100 employees, employ 20 specially abled people for whom the entire employees pension is being paid by the government, that also will not be counted. Fourth one is the last point, which is important. Is employed for less than 240 days during the previous year, which means he should be employed for 240 days or more. But think about it, he was appointed in 1st January. So for the year 1st April 24 to 31st March 25, he was appointed, or 1st April 23 to 31st March 24, he was appointed on 1st January 24, 3 months, 90 days, not allowed. But you see, where an employee is employed for less than 240 days, 150 days is for apparel, footwear, leather products. Where an employee is employed for less than 150 or 240 in the first year, but continues to remain employed for 150, 140 in the second year, 30% is available in the succeeding year. That's what I'm saying. On 1st January, I joined. I've completed 90 days. In the next year, I still continue to remain employed for how many days? 150 days. 150 days. Continues to remain employed. So 90 days plus remaining. Now the question is, am I an actual new employee that year? No. I was employed last year. But will that still be counted? Yes. That is what it is. Yeah. No, it should be like you cannot reappoint that person. It should be on the rolls. It's not a seasonal business. Leather industry, they don't work for a few months. It's not because it's seasonal. It's because they have to, in the apparel, etc. They have to give some time for the leather or apparel to sort of set. So the thing is, that time they'll be doing other work. That's why they have taken 150 days. Guys, one more change. Page number at 19. This you have to add. It's not there. This is deduction in respect of offshore banking unit and IFSC, ATLA. So any bank can have a OBU, that is offshore banking unit, in a SEZ or a unit of IFSC. Standard Chartered Bank, Barclays Bank can have one branch in a SEZ, that is called as a offshore banking unit. Foreign bank can have an Indian branch in the SEZ. SEZ is not treated as in India. That's why it's called as an offshore banking unit. Because I am now asking you more and more banks to come to India and do it, I am giving them a benefit of what? If they make any income, this is an income based deduction. 100% of income in the first 5 consecutive assessment years you will get. Imagine. That's why Barclays Bank, please come to India, set up shop in SEZ. You will get 5 years, no tension. Don't think about any income, tax free. Then 50% in the next 5 years. Now this has changed from 1/4/23. This is what they can ask you. 100 in the first 5 years, 50 in the next 5 years is shifted to 100 in the first 5 years, then 100 in the next 5 years. That's a big change. Assessment year commencing on or after 1/4/23. Means assessment year 23-24 onwards. Anything before that, different. Anything now, different. There's one more change. Unit in IFSC, same. 100% of such income for 10 out of 15 assessment years. No change in that. In SEZ, 100 plus 50 used to be 100 plus 100 it has become. MCQ questions, 2 more. ATPA, guys, producer company. All CA final. ATPA, producer company. What do you mean by producer company? If I told you that Amul, that is Anand Milk Union Limited, I could have just started a cooperative society. Why do I start a producer company? Because in a cooperative society, nobody will invest more. So it's a brand new type of company called producer company. In a normal company, tell me, can shareholders, do you need any qualification for shareholders? They should have studied till 10th standard, anything like that? No. But in producer company, the beauty is everybody has to have a qualification. If it's a producer company for cows, for milk, it's all the producers or all the shareholders should be what? Farmers, dairy farmers. So there are certain qualifications for you to be a member of the producer company. And these producer companies can start doing business then in their primary produce, and they can get some exemption. So the entire concept of producer company, I mean, just 1 minute off topic, which I have to tell, because this was initiated by one person who we do not know. He's called as the milkman of India, who created the entire milk revolution in India. People don't know about him. That's why I wish to tell him every time I get a chance. His name is Dr. Verghese Kurian. So Verghese Kurian is called as the milkman of India. He was the one who started this entire concept of cooperative society. In a small village in Gujarat, he went and said, I want to, instead of middlemen were charging 10 rupees if it is per liter, middlemen were charging commission of 8 rupees. Farmers were only getting 2 rupees. Dr. Verghese Kurian went to them and said, boss, are you a fool? They are cheating you. So one day he went with the milk tanker and said, you please give the milk to me only. I will give you 7 rupees per liter. What happened next? He was beaten black and blue by the villagers because they said, for me, the intermediaries are God. They will never cheat me. That's India, ignorant India. So he said, boss, no. Okay, you don't trust me. He went to the ICU and all, came after many days. He still came back and he said, don't worry, you don't trust me, right? No problem. I will give you money right now. You think that I'll give you money later. That's why you beat me. No problem. He sold his own land and came. I'm giving you money from my own land. So you please give me the milk now, 100 liters. You please take 8 rupees now only. No questions asked. So like that, slowly youngsters came first, then old fellows came first in the small village in Gujarat. Name spread, went to the next village, next village, next village. So it started off as a normal cooperative society, then became one more cooperative society. Like that, it became a full cluster. And that full cluster only became Amul. Because the village which beat him up was called Anand. So it became Anand Milk Union Limited. And then he approached the government and said, I want it to be called as a producer company, not a cooperative society. So in Companies Act only, they added one more mini act called Producer Companies Act. So that producer company they're talking about. But why is it relevant for taxation? Because I want more and more people to go through open producer companies. 100% of the profit is deduction available from which year to which year. That is also specified, given. Sunset clause, which assessment year or attempt. Next year onwards, they have to pay. Total turnover should be less than 100 crore. Cannot claim deduction in any other provisions because any amount full you are getting anyway. Sorry? Shall be less than 100 crores. Like startup. So if I am a senior citizen and I am depositing some money in the savings account for resident senior citizen is 80 TTB. Other than resident senior citizen, TTA. Amount of deduction 10,000 rupees. Actual interest of 10,000 or actual interest of 10,000, whichever is lower. No need to pay tax. Senior citizen, amount of deduction is 50,000 rupees. And here guys, HF is covered. AOP BOI is not covered. HF only. So 80 TT and TTB, in case in AOP they ask a question. Deposit held by a firm on behalf of a firm or AOP, then you will not be giving it to that partner or member. It's only for the HF and here only for the individual resident senior citizen. Actual interest of 50,000, whichever is lower. Mr. A was an NRI, invested in savings bank account in NRE account. The interest was 48,000. How much is it allowed for him? 48 or 50, whichever is lower. 48? No. I told you is a NRI. NRI, whether it is a senior citizen or not, it comes under 10,000. That is an MCQ question. They'll say 66-year-old Mr. John from an NRI living in USA is investing in NRE. or NRO account, whatever. That whatever you are getting the interest is 48,000 you got. How much? First option 50,000, second option 48,000, third option 10,000. 10,000. That's about it, guys. Apart from that, all that is okay. ATP. Cool. So, what is left is charitable, TDS, and little bit of residential status, international taxation, all that. The next couple of days we will do. So, liquidation is 46(1). On the hands of the company, nothing will be there. 46(2) on the other hand, market value of the asset on the date of distribution less deemed dividend 222C, 46(2). But if it is distribution of cash, then it is 222C. And it is always attributable to the distribution attributable to the accumulated profits only. And subsequently, when I make the sale, what would be the FVOC? That is the cash received or FMV of the asset received. Tomorrow, when I am making the sale after liquidation, that will be cash received or FMV received. Cash received or the FMV of the asset received on liquidation. Less deemed dividend, because I have already paid the dividend tax on this deemed dividend. Less transfer expenses, less cost of acquisition. So, this is in the hands of the shareholder when he is, selling. Check the example here. In the case of Alba Limited, there were 3 shareholders with equal shareholding pattern. The reserves and surplus of Alba Limited was 30 lakhs as on the date of liquidation, which was 23/4/22. On the date of liquidation, assets whose FMV was 24 lakh was distributed along with cash of 12 lakhs to the shareholders. Total distribution is 24 plus 12, 36 lakhs. But the accumulated profit only was to the extent of 30 lakhs. Hence, 30 lakhs is considered as deemed dividend in the hands of the shareholders. For each shareholder, deemed dividend will be to the extent of 10 lakhs. So, FVOC 36 lakh by 3, 12. In that 12, 10 is deemed dividend. So, what is the full value of consideration? 2 lakhs. Minus index cost of acquisition, just assumed 1.5. So, long term capital gain is 0.5. Now, if the asset which is distributed at the time of liquidation was sold by the shareholder for 15 lakhs, capital gains on such transfer shall be calculated as follows. What is the full value of consideration? 15 lakhs. Cost of acquisition will be the FMV of the asset as on the date of distribution. So, what is FMV of the asset? 24 lakh divided by 3. That same 24 lakh here which we have got. Why 24 lakh? How do we get 24 lakh? FMV of the asset. 24 lakh divided by 3, 8 lakhs. What would be the period of holding? Period of holding is the day I get the liquidation happens, which is the date 23rd April 22. 23rd April 22 till the day I sell. That is what it is. So, section 46 is independent of this section. It should be read in isolation. Next, guys, buyback. Buyback. This is again important. Very easy. Why important? Finance Act 24 changes are there. Finance Act 24 changes are there. Buyback means purchase by a company of its own shares in accordance with the provisions of any law for the time being in force. Implications in the hands of the company. Any amount distributed income on buyback of shares from a shareholder shall be charged to tax, and such company shall be liable to pay additional income tax at the rate of 20% of the distributed income. Tax paid shall be the difference between buyback price and issue price. The company shall be liable to additional income tax at 23.296%, including tax surcharge, etc. So, buyback minus issue price. You would have issued it at 50 rupees, buying back at 70 rupees. Right? So 20 rupees into number of shares. That is the income that you have actually distributed. Yes or no? My income, I have paid you 20 rupees more per share. That's on distributed income. So for that, do you have to pay? You have to pay the amount? Yes. It's like your dividend tax, corporate dividend tax. Corporate dividend tax, you are paying from your pocket, but you have to pay tax. Similarly here, I am paying extra. Buyback price will always be more than the issue price. So I issued years ago. I am buying back at a higher rate. That difference will be taxable just like your dividend taxation earlier. 115 QA. Implications in the hands of the shareholders. This is what has been changed in Finance Act 24. Where a company purchases its own shares or other specified securities, the difference between cost of acquisition and value of consideration received by the shareholder of the holder of other specified security shall be deemed to be the capital gains. Guys, but company has it already paid, no? Will you also have to pay? No. But it's deemed to be capital gains though. Whatever you are getting is capital gains. Why? Very simple. You are selling the shares which you had purchased it for 10 rupees and you are getting 20 rupees, 30 rupees, 40 rupees. That's actually capital gain. But by virtue of 1034A, any income arising to an SC being a shareholder on account of buyback of shares is referred on which the company is already paid under 115 QA, that will be exempt. Hence, income received by shareholders on such buyback shall be exempt. PJ Limited issues 10,000 shares at 110, face value minus 50 on 14/7/2017. On 25/6/22, PJ Limited decides to buy back 5,000 of its shares at 500 rupees. So what is it, guys? 500 minus 110, extra amount I am paying, into 5,000 shares, that is 19,50,000 extra. That is taxable in the hands of the company at 23.296%. PJ Limited is liable to pay additional income tax of 4,54,272 under 115 QA. Shareholders exempt. Exempt. Specified securities will include employee stock option, because here it says what? Specified securities. Now it said issue price, no issue price. What is the issue price? Is it at the price at which I paid? Right? So scenarios. Shares issued by company by way of subscription. Then no tension, guys. Face value or whatever I paid for it? Obviously whatever I paid. So can I say issue price will include premium? Yes. The issue price shall be the amount received by the company including securities premium. So ABC Limited issued shares of 10 at a premium of 80 rupees. So what will be the 10 plus 80? So what is the final issue price? 90. I bought the shares for 90. Sum out of amount received returned by the company prior to buyback. If the company had returned 10 rupees before only prior to buyback, issue price shall be reduced by 90 minus 10. No, not dividend. So basically they had distributed before, various like reduction of capital or whatever it is. They have given the money back to you in some form, not dividend, in some other form. Then that has to be reduced. But now company has already paid that additional income tax, no? That time also they had paid, now also they are paying. Will it be allowed to be subtracted from the company's point of view? No. Company has to calculate normally only. For them, no reduction. Yes. Now this part is what is changed. That's what. Shares issued under ESOP or sweat equity scheme. Issue price I don't know what, because I have given it for free. If it is sweat equity. If it is ESOP, then there is an exercise plan. I am giving you like 3 years for the vesting to happen, and then I will exercise. Issue price shall be FMB of the issued shares or amount credited to the share capital account, including security premium account, whichever is less. Whichever is less. Example, ABC Limited issued sweat equity of face value 10 rupees at a premium of 80 rupees. FMB will be 100. In this case, issue price shall be FMB of the shares 100 or amount of share capital including shares premium 90, whichever is less. So that is 90. That will be my issue price. Shares issued in the scheme of amalgamation in lieu of shares of the amalgamating company. Very simple, issue price will be the amount received from the amalgamating company. Maple Limited amalgamated with Thunder Limited. Thunder Limited issued 2 lakh shares to the shareholders of Maple Limited. Maple Limited had issued 50,000 shares of 28 each, amounting to 14 lakh. So I had actually issued 50,000 shares of 28 each to 14 lakh. But now what am I getting in return? 2 lakh shares. So what will be my issue price? 14 lakh rupees, which I had actually collected, divided by the new shares that I am getting, 2 lakh 7 rupees per share. In case of a demerger, very simple, I am getting the amount in case of a demerger for the issue of shares, but that is for the amount. The issue price will be what? Net book value of the assets transferred in demerger divided by net worth of the demerged company before demerger. This is for the resulting company. For the demerged company, very simple, amount received by the demerged company minus amount determined above for the resulting company. Again, example you see, it becomes very easy. ABCD Limited issued 1000 shares of 600, face value 100 during previous year 22-23. D Limited was a resultant company formed after demerger of ABC, now the demerged company. D Limited issued 500 shares to the shareholders of ABC Limited. Total assets transferred during demerger is 100 crore. Net worth of the demerged company prior to demerger was 400 crore. Out of 400 crore net worth, 100 crore is demerged. So obviously, company issue price will be what? What is the overall? How much? 1000 shares I issued at 600 rupees each. That is the overall money. But that is for the entire company. How much is for the demerged part? 100 by 400. So 1,50,000. And what is the issue price? 1,50,000 divided by how many shares I got in the new company? 500. 1,50,000 by 500. 300 rupees per share. The issue price for demerged company will be 6 lakh minus 1,50,000, 4,50,000. That 4,50,000 was for how many shares earlier? 1000 shares. So 450 rupees per share. These are all the issue prices. 2-3 points will do. Whenever they ask issue price, directly if I buy, that's easy. But what if it's amalgamation, subscription, etc.? If shares are issued for acquisition of any asset or settlement of any liability, creditor was there 10 lakhs, for him I paid shares. What is the issue price for him now? Issue price shall be A divided by B, where A is the FMV of the asset or liability or amount credited to the share capital account. B is the number of shares issued by the company. ABC Limited allotted 1000 shares of 90, face value 10 to Ms. Poonam to acquire an asset for the business operations whose FMV was 1 lakh. In this case, issue price will be what? 1 lakh divided by 1 lakh or 90,000, that is 90 into 1000, whichever is less. What is it? 90,000. What is the value of the asset? 1 lakh. What is the allotment that I am giving? 90,000. So I should take only 90,000 as issue price. 90,000 divided by 1000 shares, because 1000 shares is what I am giving, 90 rupees per share. Where bonus shares are issued, guys, issue will be nil. Where shares are issued on conversion of preference shares, bond, debenture stock, deposit certificate. Yes, conversion of debentures into shares. What is the issue price of share that I will take? Amount received by the company in respect of instrument so converted. ABC Limited issued 1000 10% debentures at 200 rupees each in previous year 14-15. ABC Limited converted these debentures into 2000 equity shares in 22-23. In this case, issue price of equity shall be the amount received in relation to the debentures, that is 2 lakh. Issue price 2 lakh by 2000, 100 rupees per share. Demat form we can leave, that's fine. This is okay. Then, yeah, that's about it. So, in the next session, what we'll do is still assessment procedure. There is a small concept that heavy duty stuff full over. Concept of appeals and revision. Quickly, we can go through that. Then penalty and other things are fine. Faceless, you can go through the, I've given you the chart. You can go through that very easy. Main thing is done. 143, 147, all those are deadly items. Appeals and revision also, quickly we will go through that. And then we will do political parties, charitable trust, business trust, TDS, and residential status, international taxation. All that will do. Yes. Okay, buddies, can we begin? Had your lunch, all of you? Cool. So, now income from other sources, IFOS. That's our chapter number D. We'll have to link it with capital gains also a little bit and then move on with the other areas. IFOS, income from other sources. So, basically when you will not get anywhere to tax, the residuary source of income would be, head of income would be this. So, any receipt which fulfills the following criteria should be subject to tax under income from other sources. It must be in the nature of income. It is not a capital receipt, it should be in the nature of income. Such income is not exempt under the Income Tax Act, and such income should not be chargeable under any other head. Anything that you get in your bank account is not income. So, you need to see, if it's a capital receipt, it's not an income. So, you need to see that, only then those things will be there. So, we are reading D1 onwards. So, income from other sources, yes. So, income chargeable under the head would be all these things: dividends, winnings from lottery, crossword puzzles, then issue of shares at premium exceeding the market value, forfeiture of advance received, interest on compensation or enhanced compensation received during the year, sum of money or property received. Important thing is this one, issue of shares at a premium exceeding the market value. This is also popularly called as angel tax, which from Finance Act 2024 has been deleted, which means last time ever, November 24, angel tax. So, sum of money, property received, family pension, and all other income chargeable under the head income tax, under the Income Tax Act, but not falling under any other specific heads of income. So, any salary received by MP, MLA, director sitting fee for attending board meetings, interest on income tax refund, all that, like salary received by MP, MLA, that is not employed by some employer. Central government is not an employer and is not employed by them, is an elected representative, hence income from other sources. Similarly, director sitting fee for attending board meetings, if he is an employee, then he will actually not get sitting fees. If he is a managing director, whole time director, etc., generally there will be no sitting fees if he is fully employed, because he is getting money only for attending meetings and working. But for other professional directors who are not employed in the company, but they will be getting this extra money, for that only it will be covered. Income tax refund is not an income, but interest on income tax refund will be an income. Rent from vacant land, subleasing of house property, agricultural income from land situated outside India. So, if you see agricultural income from land situated in India is exempt or not exempt? Is exempt. Outside India, yes. Part-time tutorship. So, you are employed in some company or you are working already somewhere else, but you are part-time, you are doing some coaching activities, that will come here. Interest on bank deposit, insurance commission, so many other examples we can see. So, income chargeable under that other sources only if not chargeable under other heads of income. Interest on securities, sum collected from employees towards employee welfare schemes, income from letting of machinery, plant or furniture. This employee welfare schemes, if you say provident fund, etc., that is already credited to the P&L account, we have seen in PGBP. So, this will be any other employee welfare scheme if you open, and if you receive any money, that will be taxed here. Income from letting of machinery, plant, furniture, yes. In case you are not into renting business, but you still rent out certain things, yes. Then of course, composite income from letting out machinery, plant, furniture together with the building. Letting out the building with everything. For example, this studio setup I can take for 5 days or 10 days or 15 days for rent. Now, I am not just taking out the building, but also the furniture and other fixtures which are very essential for a class. So, that also will be coming under. So, Tarun's Binary, if I pay something, Tarun's Binary has to take it under this. I mean, assuming it is not charged under, in their PGBP. So, obviously in PGBP, they are into the business of, providing classes. But renting out will be obviously cannot come under that business. It's a additional thing that they are getting. So, that can again be coming under other sources. Income chargeable under the head other sources only if not chargeable under the head profit and gains of business or under salaries. So, we saw this in PGBP and this thing also. What do you say? The salary and PGBP. Keyman insurance policy. I told you for chairman emeritus, Narayan Murthy example we had given. He is neither an employee nor a consultant or whatever under that act, under the provisions. So, any sum received by him will come under this. On the other hand, any compensation or other payment received by any person in connection with the termination of his employment or modifications of the terms and conditions will come under this. For example, he is been asked to leave the company because of some issue. He says, I will leave, but you are terminating my employment. No problem. So, that is anyway gone. But you have also told me that I have to keep my mouth shut because otherwise I will expose you. I don't care, you pay me 5 lakhs, 10 lakhs, whatever you'll ask. That money will come under, that is not perquisite. That's not employment, salary. That is something that is after that you are getting. So, that will be what? That will be this amount. So, all this, if many companies in what do you say, in Kota, Rajasthan, there is a IIT factory, right? Basically, each academy runs based on the professors. Now, one professor from one company is actually, one academy is poached by another academy. So, that time they will pay some extra amount for you to come here, initial joining bonus sort of a thing. That's not your salary, that all come under this, because they are modifying the terms and conditions relating to the employment. They are telling, okay, you told that you will join next year, please join now only, I will give you extra 10 lakh rupees joining bonus. But this is actually before you join only I am giving you, it's not after joining. Before you join you are getting. So, those kind of arrangements, it will come here. On the other hand, if I am poaching from you and your institution has put a case against you because you left, breached the terms, This academy, that also happens. This academy pays the penalty for that. Is it an allowable expenditure? Yes, just an example. Is it allowable? 100% yes. Under 36, 37 only you can claim allowable expenditure because I am paying in the nature of compensation. Yes. So company can claim under 37, no problem. Yeah. A non-compete fee is not there. It is only a termination of the employment. That's all. Because there are specific sections, you see, 56 to 11, 56 to 4, like that. But anyway, for us, the most important thing which is linked to our capital gain will be 56 to 10, gift taxation, which we will be doing. Anyway, so employer who is engaged in the business or profession, if he receives all these things, it will be PGBP. Employer whose name policy has been taken, salaries. Any other person, family member of the employee or chairman emeritus, income from other sources. So, taking the same example where I told you if I hire the room here from Tarun's Brainery, I said it's income from other sources. Could it also be like that for a temporary period they are not using this room, they are letting it out and then again using it back again? If something like that happens, if you see at Supreme Court judgment in Vikram Cotton Mills Limited, temporary suspension of business during that time only. When machinery was used in business was leased out, income from such leasing was chargeable to tax under that PGBP. Since the assets were already used in business. So that logic you can take only during temporary suspension of business. They were leasing it out to earn some extra money because their business was not running. So that will be PGBP. Yes, otherwise it will be IFOS. Yeah, but if I had leased out the entire property without any intention of starting any business, which means if this room was kept only for leasing to other faculty, that's a very good source of income. Everybody would want to come and take in Chennai, right? So because the face-to-face market, if you see, the highest in terms of anything for that matter is in Chennai only for face-to-face market, right? Bangalore, you will just face, that two-face will not come. By the time they get up, actually Bangalore has become such that even next street fellows will take only online class because it's such a horrible place for traffic. It's a wonderful place otherwise because I am a Bangalorean, I can tell that, but traffic is miserable. So they won't even want to step out of the house to take any of these classes, etc., because they would rather spend that time sitting at home and studying. Because one place to other place, now when I see anywhere in Chennai also slowly becoming like Bangalore, I would say. Traffic has become pretty bad. It's slowly reaching there, right? But the thing is, at least you will go in 10 minutes, 15 minutes. There, it takes a long time. So what I am trying to tell is, in case there is no intention only of giving this, using this room for business, but its only intention is to lease out to people from other states who can come and take classes. Then is it IFOS or PGBP? IFOS. Then it will be IFOS. That again depends on your MOA. Have you done a separate line of business? Is it there in your MOA? If you're a company, you have to see that. If that is the case, then of course yes. But if your MOA and your objective is something else, but you are doing this only for that, then it's a different thing. It all depends on the facts of the case and what is the arrangement that you have. Now, one more thing is, you have, these are all, MCQ questions. You have a land and one building there. This entire thing, if you see income from house property, it says land, building and land appurtenant thereto. Building will be their house property plus with or without land. Land alone, if you rent out, that can't be income from house property. So somebody was living in this house, but this was rented out as a garage or a parking space. Now, is it income from house property or other sources? What do you think? So if I rent out only the building, house property. Only the land? Is it house property or other sources is the question here. Yes, so that was one more Punjab and Haryana judgment, Govardhan Das. When land appurtenant means attached. When land attached to building is put to use but not as part of the building. Income from land cannot be assessed under that, income from house property, but taxable under IFOS. So if I rent out both, then fine, but if I rent out only the land portion, it cannot be covered here. In a Supreme Court judgment again, if I collect charges for the amenities separately, so if I am an organization collecting amenities, fees for amenities, etc. So if I am collecting charges for amenities separately, that will be income from other sources. But if I charge rent and everything together, composite, then it is income from house property. It matters because expenses can be claimed in different ways. In house property, different expenses can be claimed, PGEP, different expenses, and now in IFOS, expenses are there, not there. That's what. Interest income, again Supreme Court. Interest income from share application money deposited in bank is eligible for set off against public issue expenses. Both are capital in nature and is not taxable under the head income from other sources. So just because there is income doesn't mean it is income. Share application money is not income. It is just a capital receipt which anyway you have to refund. So that you can set off against share issue expense which is anyway capital in nature again. Hence, it is not income from other sources in any way. Gratuity received by a director who under the relevant contract is not an employee or servant of the company. So if you are an employee, you will get gratuity. Here I am giving you gratuity not as an employee but as a consultant. So what will come? Income from other sources. So these are the basics of IFOS. Now let's move on to the main thing, gift taxation. Correct? Any sum, movable or removable property, 56,210. So if I have where to check the section reference for you guys, money, anything more than 50,000, if you are getting from anybody, taxable. Immovable property, there are two things, without consideration under clause A, inadequate consideration clause B. Without consideration means gift. Inadequate consideration means you are taken some very less amount from it. According to Contract Act, can you sell anything for inadequate consideration? Yes, I don't care. I can sell this laptop for 1 rupee, no problem. Right? That's not an issue. So there was one movie called Bhag Milkha Bhag, which was based on Milkha Singh. I went to Milkha Singh and said, I want to make a story on your life. He said, okay, take my rights. 1 rupee he charged. Is that adequate consideration? Yes. When MS Dhoni sold his story for 67 crores that time, plus share of profit, smart guy, right? So 67 crores plus share of profit. So is it adequate consideration? Yes. When 3 Idiots were made, they went to Chetan Bhagat and asked for the rights. Stupid fellow sold it for 5 lakhs. IIT IIM fellow, damn stupid, 5 lakhs he sold because Amir Khan came and asked him, he gave it for 5 lakhs. That's it. No this thing, no profit share, nothing. And he just asked for one thing, my name should be mentioned in the credits. It came after the end of the movie, somewhere on small thing. He never specified that also, it should come in the beginning, nothing. So after that he woke up and all other movies which were made, 2 states and all that, first only it came. But all other movies put together has made less money than 3 Idiots. So actually we know who's the 4th idiot in that, right? Yes. So that is what it is. So if you see, that is what happened. He only told that I don't know why I did that. Because Amir Khan came and spoke, he gave it off for 5 lakhs. So is that adequate? He actually later sued. All these are cases. He sued that Amir Khan's company and all that. They said what? What is the contract? Name should be there. It's there, no? In the end, last, based on a book of, that whatever, 3 point someone, 5 point someone, that book, based on that book, it's there in the end. He never said it should be prominently displayed, nothing, no condition. So 5 lakh, full and final settlement, lost the case. So if you see, in Contract Act, there is nothing called consideration must be adequate. It just says consideration. But in income tax law, we will charge the inadequate consideration to tax. Correct? Without consideration, inadequate, without and inadequate, both. For others, this is movable property. Now, one by one, guys. So, if I have received, you see, some whole aggregate exceeds 50,000. If I have received 20,000 each from 3 people, should it be taxed? 3 people have given me 20,000 each money. In the year put together, it is going to 50,000 plus. Should I tax that? Should I pay tax on 50,000? If yes, second question is, should it be on 10,000 or should it be on 60,000? Is 50,000 basic exemption limit, right? So you see, aggregate money received is more than 50,000 per annum, then it's fully taxable. So guys, 15, 20, 10,000, 5,000, total 50,000 not taxable. It should be more than 50,000. 15,000, 25,000, 40,000, 5,000, 75,000. Is it fully taxable or exemption limit? Fully taxable. So first of all, aggregate is the word used, and second of all, what? Fully taxable. So it is full, in excess of 50,000, fully taxable, and it is each person you have to add, and then finally you should take that. Moving on, next section here, immovable property. Immovable property. Immovable property without consideration, let's see, without consideration. If the stamp duty value of immovable property exceeds 50,000 rupees, then what is taxable? Entire amount is taxable. Stamp duty value of the property is property value more than 50,000, they are telling. Obviously, every property will cost more than 50,000 rupees, right? Unless you stay in a village. So in Chennai, if I want a pawn shop, pawn shop or cigarette shop also, if I want to own one, obviously, don't you think so? Even a small area would cost so much. In an area like this, right? Obviously, yes, it is high value. That's the thing. On the other hand, if I mix up few things, guys, I get gift of shares from one person, 45,000. Money from somebody, 40,000. Then something else. I will get one more cash from somebody else, 10,000. So 30,000 cash from one person, 10,000 cash from one person, and shares from one person, 40,000. So movable property also aggregate fair value if it exceeds 5,000. So shares from one guy, 40,000. Cash from one guy, 20,000. Cash from one more guy, 10,000. All put together, it's exceeding 50,000. Should I see like money separately, immovable property separately, and others separately, or all mixed? Separate or all mixed? Separate. Because the law, just a sec, just for your knowledge, only this section I want to show you because of the wordings which are there, that's all. If I go to 56.210, we are all discussing 56.210 only, and this is a common thing which is available in all the acts as such. You see here, sum of money separate, this is separate, other things C is separate, and each of these things is separated by a semicolon. So the interpretation of semicolon is obviously that this is separated from this, but still you should read everything continuously. Right? Semicolon is actually the hallmark of a chartered accountant. He wants to stop, CA student wants to stop, but what? He will move on. Correct? That is what. So basically it means that we want to stop, obviously it's done, but the thing is until we clear that CA final exam, we will never stop. So if you see in so many places the semicolon is there, you won't even believe. Every act, every section it has semicolon. We don't, what do you say, understand about the importance of that semicolon, right? So if you see gift shares 45,000, Mrs. A 40,000 cash, whatever. Ultimately, gift is 85,000 both put together. So it's a semicolon everywhere, which means what? Each subsection should be read separately. So cash gift should be more than 50k. Then shares, movable property should be more than 50k, either singly or together. So it is example 1. This is, there is no, it won't apply. It won't apply. Next. Let me talk about movable property. Immobile, no? See, movable property. Any property other than immobile property. So, example, for 40,000 shares I will get from one person, right? 30,000 gold I will get from one person in the same year. One person gives me 40,000 value shares, one more person gives me 30,000 value gold. Is it taxable? 70,000. Assuming it's not exempt, I'm not relative and all those things I'm asking. So will I get? Is it taxable? Yes. Why? Again aggregate. Again aggregate. You will give me an immobile property 40,000, one cigarette shop, correct? One more cigarette shop you will give me 40,000. Overall 80,000. Taxable or not? Not taxable. Why? Yes. So here guys it says such property. Any immobile property, such property. So interesting point to be noted here is, it's there in the notes, don't worry. Here, stamp duty value of each immobile property if it exceeds 50,000. And if you see, they are never telling here aggregate. Is there aggregate? No. So no need to aggregate. It is per property. Got it? Each immobile property. Examples we'll see. So immobile property 48,000, 45,000, it will not apply. Aggregate word is missing. Per property more than 50,000. Per property more than 50,000. So if you see this, example has everything. Movable. Immobile we'll see later. Without consideration. If aggregate fair market value of property exceeds 50,000, then it is fully taxable. Following was received without consideration: 40,000, 15,000, 25,000, total 80,000. Is it received in aggregate of 50,000? Yes. Fully taxable. This is with respect to movable property. That is without consideration. With consideration, that is inadequate consideration, the law says, if aggregate of FME minus consideration exceeds 50,000, then difference is fully taxable. Means what? Jewelry received for 20,000, FMB was 80,000. Inadequate. So I should see FME minus consideration if it exceeds 50,000, then the difference will be taxable. 80,000 minus 20,000, 60,000. So 80 minus 20, jewelry received for 20,000, FMB of jewelry 80,000. So 80 minus 20, 60,000. As is exceeding 50,000, full 60,000 is taxable. Again, it is not a basic exemption limit or something like that. Is this clear? Are we done? So, following was asset without consideration, sculptures and all that. Then the jewelry receipt for 20,000, same thing. So, without consideration, aggregate property more than 50,000. Inadequate consideration, difference should be more than 50,000, then the full amount is taxable. What do you mean by movable property? Anything. Share security, they have given defined. Jewelry, drawings, sculpture, archaeological collection, painting, work of art, bullion. Inclusive definition. Does it include motor car? Motor car transferred for inadequate consideration? No. Yeah. Why motor car? Personal asset. But I mean, that is for capital gain purposes. We are in another head now. IFOS. Claim depreciation. Personal also will be claim depreciation? Generally? No. What do you think? Why? If you are a salaried individual and you are using your car, let's say you give your car for inadequate consideration. Other person, will the difference be taxable? Generally, this section was only to ensure that something that appreciates, if you don't want to pay tax, then you will transfer it to somebody else. Car is an asset which will always depreciate. Recently, I was reading one of the CEOs of some company said, no, that I'll never buy a car because it's a depreciable asset. It always depreciates. So, if you buy a BMW today for 1 crore, 5 days later, it will never be 1 crore for sure. So, there is no point of giving it to others with a hope of the value rising. It will never happen. That's why car is specifically actually not included in the movable property definition. It's not because it's capital gain, capital asset, etc. It's because of this reason only. Next, immovable property. Vintage car on the other hand is another thing that is not used for personal use, that's used for collection. So that can be deemed as what? One of these collections. Correct? It is not an archaeological collection for sure, but it is a valuable collection. Correct? So that will, in one of the cases, a guy who had vintage cars, Mysore Maharaja had vintage cars, so that was deemed to be a piece of art, work of art, because actually now it is a vintage car which will fetch a lot of value. Though the actual value will be 5 lakhs, it will fetch you in crores. That's the thing. So you can change the meaning according to what it is. It's not exactly a motor car. The nature is not a motor car. Many of these vintage cars, you can't even drive it in the open, in the road, right? So that's the reason why they have told that would be deemed to be like a piece of art, work of art, which is just kept in the museum. Hence, for that the nature would change there, right? Immovable property on the other hand, without consideration, inadequate consideration. Without consideration, again guys, it is per property as I told you. If aggregate SDV per property exceeds 50,000, then it is fully taxable. Plot receipt 40,000, building receipt 47,000. Is it taxable? No. As SDV per property must exceed 50,000 rupees. Yes, it is. It should be whatever it is. It's per property. It's not agreement wise, it is property wise. Law cannot provide for all extreme circumstances. And immovable property includes land or building or both. Now this is interesting. This little bit of capital gains will come. Inadequate consideration. 2 conditions must be satisfied. Condition number 1, which is similar to movable property. SDV minus consideration must be more than 50,000. SDV minus consideration must be more than 50,000, and the other dialogue we know. SDV must be greater than 110% of consideration, 50C. So, first of all, aggregate SDV minus consideration per property should exceed 50K, and SDV must be more than 110% of consideration, then difference only is taxable. Example, building was purchased for 4 lakh. SDV of the building was 4,60,000. Condition number 1, is the difference between the two more than 50,000? Yes. Condition number 2, is SDV greater than 110% of consideration? Yes. 4,60,000 is greater than 4,40,000. Both the conditions are satisfied, difference is taxable. 4,60,000 minus 4,60,000 would be the taxable value. As far as employees is concerned, employees, first and foremost, any gift which has in the employer-employee relationship, if I give money like Diwali bonus, etc., fully taxable. If I give any gift in kind, FMV more than 5,000 rupees is fully taxable. So if any gift is given to an employee, if it is more than 5,000, only then it is fully taxable. So this will exclude most of us who will get lunchbox, plate, all this on Diwali, no tension. But like there was a guy in Surat, diamond merchant, who gifted his employees house, gifted his employees 5 lakh rupees car, you would have seen. So those people, employer-employee relationship, what will happen? In kind, fully taxable. Business and profession, wherever there is a nexus, then any amount is taxable. Like I told you, for CA you will give a watch, that full amount is taxable. Other gift is covered here in 56(2)(10). From 1/4/2007, all gifts are covered. Other than this, like if you are getting any other than employee or a businessman, or where there is no nexus, then this section, everything is covered which are there. And it is always taxed in the hands of the recipient or the donee. The person who is donating is called donor, other fellow is called donee. So we have seen this, more than, per property, all that we have already discussed. Difference will be taxable. Yes. So movable property will be share, security, jewelry, drawing, archaeological collection. And one more thing, guys, as per Finance Act 22, you can add in that chart only virtual digital asset, VDA. Gifting of VDA also, that's added. Gifting of VDA in that chart only you can add. Gifting of virtual digital asset also is what? Very much part of the deal. So that will also be movable property. So if the selling price is 50,000, SDV is 80,000. Is SDV more than 110% of selling price? Yes. 55,000 it becomes, is 80,000. 80 minus 55,000, yes. But the difference between the two, is it exceeding? No. So IFOS will not come. Now, there is no 56(2)(10). It's exempt. Gift received by any person will not be taxable. First one, on the occasion of marriage. So in the exam they will confuse your parents' marriage anniversary, children's marriage. No, it is the SSC's marriage, right? So then next question, first marriage, second marriage, third marriage, right? Basically any legal marriage. Any legal marriage. So after the first marriage is annulled, second time you are marrying, whatever it is. So every marriage you can get. So an excited inter student I told, sir, in that case we can plan our marriages to get the gifts, right? So that's wishful thing, and it won't happen. So it's only one, on the occasion of marriage. That's what. So at least here, thankfully, whatever gifts you receive, whatever amount you receive, no problem. Second is from a relative. Common mistakes made by students, they'll say on an occasion of marriage, gift received from relative. Are they single or separate here? Separate. Correct? Gift received from a friend also during marriage, exempt. Correct? No problem. So Nirmala madam is not so cruel. She's like, anyway, you are going into rigorous imprisonment for the rest of your life. So whatever gift you enjoy, no problem. Enjoy the gifts right now. So no questions asked. This is from what? Friend. This is from anybody for that matter. Then from a relative is what? That is not on the occasion of marriage, any time. So if you receive a gift from a relative for your son's anniversary or your son's marriage, what do you think? You are receiving a gift from a relative for your son's marriage. Son's marriage is irrelevant here. The moment you are receiving a gift, that is what? Taxable or not? Not taxable. Yes. From a relative, I am saying, from a relative, not from a non-relative. You are receiving a gift from your relative on your son's marriage. Son's marriage is irrelevant. Since you are receiving a gift from a relative, yes. So please do not read relative and marriage together. So relative definition, everything guys, spouse, individual, lineal ascendant, descendant, parents, everything. Spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, your brother-in-law, sister-in-law, everybody will be relative. Uncle, auntie, brother or sister of either of the parents. Lineal ascendant, lineal descendant. Then including their respective spouses. Anything. Anywhere. Yeah. But ultimately those will not be alive, right? But it will include, yes. It will include everybody. Yes. Thankfully we die. Yeah. So, yes. So that is not included. Everybody is included. That's the beauty. Lineal ascendant, lineal descendant. Everybody is included. Definition of, it's a good question because we are number one in that, right? Yes. Number one in the world, right? Population. So definition of relative for HUF, that is HUF, what is this? This is interesting. For any member of the Hindu undivided family will be a relative of the Hindu undivided family, right? So for the HUF, any member will be relative of the HUF. So if, again, because it says relative, definition of relative of HUF is what? For any HUF, member of HUF will be the relative. So if a member of a Hindu undivided family is giving a property, bringing a property into the Hindu undivided family, gift taxation will apply or not? Member of the Hindu undivided family is gifting something. Guys, gift taxation is always for the donor or donee, recipient. So the relative or rather the member is bringing an asset more than 50,000, inadequate, zero consideration is giving into the HUF. No tax. But in the exam, they'll ask the reverse one. HUF is gifting immovable property to member of HUF. The member of HUF is gifting their immovable, it's not partition. Partition is exempt. HUF is gifting one of its immovable properties through a gift deed to one of the members. What do you think? Taxable, not taxable? Not tax. Why? Is vice versa relationship. For example, okay, you are saying vice versa is a relationship. Let me take something else. Okay, is your, in this example, in company, in Companies Act, your father-in-law, mother-in-law is not a relative. Yes or no? Your spouse's side, nobody is a relative. Only your children and their spouses are relative. So your father-in-law is not a relative as per Companies Act. But from your father-in-law's point of view, are you a relative? Yes. So reverse relationships will not work like that. Correct? So, Only while talking we can say you are my relative, I am your relative. But as per law, no. Your father-in-law is a relative, not a relative as per Companies Act. But from his point of view, you are a son-in-law, daughter-in-law, it will be relative. So, for a HUF, member is a relative. But for a member, HUF is not a relative. That was asked in MCQ. And this is not partition of HUF where capital gain is exempt. Right? So, these are the some hidden points. What is exempt, guys? Member of HUF, gifting immovable property to HUF is exempt. Reverse case, HUF gifting immovable property to member of HUF is taxable, assuming it is not partition. Yeah. That's a good question. After the Reliance wedding, Ambani wedding, it's a good question. Where does it start and end? So basically it is obviously very simple. Marriage here, it's not even the ceremony. It is the entire occasion. So basically it is when? Till the registration of marriage is done. So if the Ambani couple still haven't registered their marriage, they're still not married, legally speaking. Right? So wherever, even if you want to go abroad, etc., if they ask you, how do you prove that you are married? You can't show your wedding pictures or anything. Correct? It actually has to be the marriage registration certificate. As simple as that. That is the actual proof of marriage. So they'll say no, registered marriage. That actually means that you have to go to the sub-registrar office and prove that it is that you are married. But the beauty is they will ask proof of wedding picture only to give you that certificate. That is the other part, but yeah, that's what it is. So basically the entire occasion can be 5 days, 10 days, 15 days, whatever it is. So that is what it is. You need a separate act for Ambani's children to make it like 1 year or 5 years, whatever. Yes. That's one more question. Is it engagement ceremony or only marriage? Those are all actual questions. Whatever you asked was a question. Engagement ceremony they'll give. Correct? No. Let's say in Hindi they call it roka. So in one of the things I remember vaguely that asked engagement ceremony. No. It is only occasion of marriage. Engagement, after engagement can break also, no? Because as I told you, wedding here is the final registration. Divorce is an annulment of marriage, which where there is a legal, annulment, cancellation of the marriage. So engagement can never be called as marriage. Yeah. Right. So actually most of our parents are not legally married, if you think about it now, because they don't have the marriage registration certificate. Those old cases are grandfathered, but if you actually strictly take your parents, they'll never have any registration certificate. My parents definitely don't have, I had asked. So thing is, some of your parents may have, may not have. But the thing is, yes, that's how it is. As of now, if you want to be called as a married couple, it has to be registration for sure. Right. Then other things you see, under a will or by way of inheritance. This is your what? Will. Where there is a will, you write my name on it, people say no. It is not where there is a will, there is a way. Right. So under a will of by way of inheritance. So basically in a will, you may not be related to that person, guys, in a will. You may get anything, right? So yes, like recently this guy, Narayan Murthy's grandson got, he was just born, he's on 3-4 months. He got 4,000 crore worth of shares already, right? He doesn't have to work 70 hours, no problem, right? Yes. So under a will or by way of inheritance, will or by way of inheritance. Then, what is this? In contemplation of death of the payer, means on the deathbed, then isn't that will? So actually, yes, in contemplation of death of the payer is, there are laws which will allow you, when you are about to die, in contemplation of your death, it's not a will as such, but there with witness obviously and a solicitor, you can write something like a will, though it's not a will, where you can say that this property will be belong to you after my death, in contemplation of death. When the end is near, you can call it. It's not a will, because will requires another process. The will is not there. In contemplation of death, you can do all these things. Recently, I lost a friend. In the sense he was an acquaintance, he became a friend, and then we lost touch for a few years, and recently I got to know he passed away. He apparently had a heart ailment for a long time, and imagine he knew that he would die in the next 2-3 months. He just knew it. So that time only I was talking to his sister. So he had already made arrangements, not through a will, but in contemplation of death, he had written down along with the presence of a witness saying that my sister should get this property, that property, whatever he has. He's a chartered accountant. Jayant is his name, poor guy. He's a very nice guy actually. He cleared and he was working in Mumbai for a long time. But yes, so I was just thinking of this point when that happened actually. Yes, in contemplation of death, no will. Just that I know I am going to die in the next 1 or 2 months because the heart condition was pretty bad. So yes, he was not able to apparently walk also. So yes, so that's the reason why in contemplation of death, I could write down the stuff in a different format. So that is this. So basically everything is covered: will, inheritance, or contemplation of death. Sorry? Then if it's a relative, no problem, no? Relative, no problem, right? Contemplation of death is, they would have clearly mentioned that when I die, the transfer will happen only after the death. Otherwise, it will be normal gift to the relative you can do. Then any money from a local authority, from any fund, foundation, university, other educational institution, from trust, charitable institution, all these things. Any money that you receive would be, like for example, you are getting a scholarship from a trust. So all those will not be income from other sources. Next. And see, normal if you get without partition of HUF, taxable. But what if you get as distribution upon partition? Distribution of capital asset on partition, then no problem. Then see these guys which you would have seen in capital gain. Transfer of a capital asset by holding company to wholly owned subsidiary. There we saw it is not a transfer. It may not be a transfer. It's a transfer but specifically excluded. I would say like that. It's a transfer but specifically excluded under 47. But my question is, the recipient also should they pay? I got a 1,000 crore asset free, subsidiary company. Should they pay tax on 1,000? No. So there it was the giver point of view. Here it's the receiver point of view. Right? Yes. Wholly owned, 100%. Indian subsidiary. Remember the condition, same thing. Subsidiary company should be a Indian company. 100% should have been held. Transfer of capital asset by a wholly owned subsidiary to Indian holding company. Same thing. Correct? This was Hamleys to Reliance. We had discussed the same example. This could be Indian or outside India, I don't care. To Indian holding company. Any transaction in a scheme of amalgamation. This is not amalgamation. This is normal transfer. Amalgamation, remember, all the assets and liabilities of the holding company should go to the subsidiary company. Other company should be an Indian company. 75% of the value of shares, or 75% of the people who are holding 75% value of shares should be shareholders of the resulting company. All that we had seen, that also. So recipient, will it be taxed? No. Demerger, business reorganization, all these things. Same, just to clarify, there also any transaction not regarded as transfer in relation to receipt of shares by a company, all these things. Then you have basically if you have any funding, any fund, original fund, say you are moving to another fund, you had one fund by a fund manager, then you are relocating to one more fund, that's called resulting fund. All these cases, basically no problem, you are just moving your funds around. Then transfer of capital asset by India Infrastructure Finance Company, IFCL, to an institution established for financing the infrastructure and development, IDFC, correct, Infrastructure Development Finance Corporation. So this money from other companies which were part of the infrastructure finance company were moved to this company, all the assets. So that's why they inserted that recipient also, no problem. If I create a trust and transfer my asset to that trust, any income derived from that trust till I am alive, will it be clubbed or not? It will be clubbed. That's there. It will be clubbed in your hands. Will it be taxed in his hands? No. Clarify that, you see here. An individual by a trust created or established solely for the benefit of a relative of such individual. But here it's for the relative only. So one more doubt generally they say, is there any ceiling limit here? 50,000, 1 lakh, 1.5 lakhs or no ceiling? No ceiling. Only for these people. Absolutely no ceiling limit. VDA is added. Immovable property means land or building or both. Yeah? Yeah. Court appointed thing, right? So first of all, is it your income? Is it your income? Yes or no? It is an income. Is it an income? Yes. So the other person has to, whoever is receiving it has to pay. But there have been couple of cases where it has been held, one by the High Court. Good that you asked. I recently gave an opinion on one of the persons. This is like the spouse is in America. She is now living with her son. The husband is in India. Husband was, obviously never earning anything much in his entire life, whereas the wife was earning very well in USA. Husband is settled in Bangalore. So, wife transferred 1.5 crore alimony. So, the opinion was, and he was very a normal guy, he only earned some 20-30,000. Suddenly 1.5 crore, if it gets credited to your account, it's obviously a red flag, right? So, that we have to justify whether alimony is taxable or not. So, there are various court judgments which says that alimony is not taxable because it is not in the nature of income, it's a capital receipt, not taxable. No. No, it's not a business, no? Are they in business of divorce? Just asking, right? Yeah. No, nothing. They cannot claim, that's the, what do you say? That's karma. What goes around comes around. So you need to pay for it. When you say pay for whatever you did, that's what you have to do. That's all. So it's a good question, but ultimately you cannot claim expense because you're not in the business of divorcing people, right? So there is no, it is not an expense as such, but yeah, that money is gone, cash outflow, right? So this guy actually had come to me and said, should I pay tax? I said no, it's a capital receipt, not taxable. So it will be open for scrutiny for sure. 30,000 rupees every month and suddenly 1.5 crores, right? So opinion had to be ready. So there are actually many judgments on alimony which says that it is not taxable. It's a capital receipt, not taxable. But you may claim it to be income, but it is not. One of my other friends underwent a divorce 3-4 years ago. We had to come to Chennai only so many times. Family court is here. So we had to come there. So that eventually the lady demanded almost 1 crore. The final settlement was 5 lakhs. That's a different case. 5 lakh was settlement. Because he's not earning so much, guys. He's not a CA, he's just a BCom guy. But yeah, he's not earning so much. So 1 crore was exorbitant amount claimed. So eventually it was 5 lakh. So that amount again, obviously he cannot show anything that went from his pocket. So these cases are very interesting, even from the taxation point of view. Alimony, there are 2 ways to it, but you can stick to the thing that because of the judgments, not Supreme Court is not there, High Court judgments are there. So it is a capital receipt which is not taxable because it's not income in any way. One way you can say it's an income, right? On the other way, it is not an income. These issues will work also in USA because they have something called prenuptial agreement. Before marriage only you will enter into an agreement. But if anything happens, then you will have to pay me so much, all those things, right? So these are all the things. Next, moving on here, one more interesting case. Naresh On 1/1/2019, cost of acquisition 10 lakh, land and building. Entered into an agreement to sell, not sale, with Vishal on 1/1/2020. Amount was 40 lakh. SDV was 58 lakh. We discussed this first in the morning. On 1/1/2020 itself, he had received an advance of 5 lakh rupees. He had paid an advance of 5 lakh through an account payee check. Remaining 35 lakh he paid on 30/6/2020, the day of the registration. While SDV as on that day was 70 lakh. This is not any possession, it's only simple thing. Agreement to sell and registration. Which SDV should I take? Morning we discussed. Agreement to sell. Which one? 58 or 70? 58 lakhs. Vishal sold it to Nehal on 31/12/2020 for 100 lakhs. For 100 lakhs. Now, agreement was 10 lakhs. Cost of acquisition, was 10 lakhs. Selling price was 40, guys. Selling price was 40. My question to you, first one is, what is the FVOC for Naresh? 58 or 70? 58. Everyone agrees on that? 58. Morning we discussed, if you pay an advance, any amount in account pay check, I can claim the SDV as on the agreement to sell date, right? Yes, only if advance is paid. Only if advance is paid. Any amount is paid, but through what? Account payee check. Cash and all not allowed. That was the reason why I am allowing it to happen. Now we are discussing, you will be wondering, why is this fellow discussing capital gain here? Because the recipient is there now, Vishal. He is receiving 58 lakh worth property at 40 lakh. Difference between the two, is it more than 50k? Yes. Is it 110? Is it more than 110% of the consideration? Yes. Is SDV, what is immovable property inadequate consideration? Dialogue. One is, difference between the two should be more than 50k. And SDV must be more than 110% of the consideration. What is consideration? 40 lakhs. What is 110% of consideration? 44 lakhs. Is 58 lakh more than 44 lakh? Yes. The question is, will 56/210 come for Vishal? Yes. Naresh is taking the FPOC at 58 lakhs. Vishal has to pay 58 minus 40, 18 lakhs, double taxation. Naresh, he got 40, but is paying on 58. Vishal, he paid 40, but is paying on 58, 18 extra. Tomorrow, when Vishal is selling the property to Nehal, his cost will be 40 or 58? 58, because he paid already on that 18. Right? My next question is, Naresh is selling it as a capital asset. Vishal is accepting it as stock in trade. Will your answer change? This is CA final question. First one was inter question. Same, no change only. So everything is the same. Naresh is selling it as capital asset. Vishal is receiving it as stock in trade. Will gift taxation come? Naresh, no tension. Vishal. Okay, so will that be PGBP? So you are meaning to say that 56/210 will not come? Business. So, I mean, basically gift. So, what I am asking is, we had seen that 43 CA, land and building or both. So, will 43 CA come or 56/210 comes? 43 CA. Okay. Then reverse case I will take. Naresh is selling it as stock. This fellow is receiving it as capital asset. Then Naresh is giving it as stock in trade. I am receiving it as capital asset. 56 to 10 you are saying. Okay, then last one is obviously both are stock in trade. That fellow also stock in trade, you also stock in trade. So, yes guys, recipient, you are right. If recipient is receiving it as capital asset, if recipient is receiving it as capital asset, 56 to 10 will come. Correct? So, Naresh can be anything, I don't care. Recipient should receive it as capital asset. 56 to 10 will come in both the cases, 1 and 4. You will see that it will be taxed, of course. So, you see the calculation. So, point number A, both capital asset, capital asset. Case 1. Naresh will take the FPOC as what? 58 lakh. Period of holding 1/1/2019 to 29/6/20. Mind you, period of holding is always till registration. Only the amount you will take from advance payment, SDV. Just because SDV you are taking it in the middle of the year, when is SDV taking? Your SDV you are taking when? On 1/1/20 doesn't mean period of holding will change to 1/1/20. Period of holding is always from the date of acquisition till the date of registration. Legally, when will the ownership transfer? Date of registration. So 58 minus 10, 48. IFOS on the other hand, for Vishal, because both are capital asset, Vishal 58 minus 40. When he is selling it to Nehal, 100 minus 58. Second case, both are stock in trade, 43 CA. So, for Naresh, what will be the PGBP? 58 minus 10. 58 minus 10, not 40 minus 10. Right? So, full amount will be PGBP. What about Vishal? 56 to 10 will not apply, because 56 to 10 says property means a capital asset. 56 clearly says property means capital asset. Are you receiving it as capital asset? No. So, this fellow will take it as what? 100 minus 58 or 40? 40. Why? That is my cost. I am receiving it as what? As stock in trade. So, both stock in trade cases, same thing. So, ultimately, this will boil down to this, guys. 56 to 10 will apply if the recipient is receiving it as what? Capital asset. Recipient, that's the gist of the story. Recipient is receiving it as capital asset. See, normal, you already know IFOS, you already know everything, but the fast track is to ensure that the other points are known, that's all. In fact, you know the entire Income Tax Act, it's not to worry. To some extent, whether you studied or not, in at least inter you would have studied. So, basic concepts you will know something, but it should be this is what we'll have to look at for that extra 15-20 marks. Yes, point number 4 again in the discussion. FMB. 3. FMB of jewelry and other movable assets such as archaeological drawings, etc., other than shares and securities, is the price at which it would fetch. FMB of shares and securities are again under 11 UA. Movable asset is purchased from a registered dealer, invoice value will be the FMB. And interesting to know, 50,000 is not in the nature of basic exemption limit. It's not like LTCG, up to 1 lakh 0, more than 1 lakh 10%, no. SDV is adopted as the assessable value for the purpose of stamp duty, where date of agreement and date of registration are not the same. SDV should always be taken on the date of agreement, provided what? SDV, what will you take? Date of registration or date of agreement? Agreement. Provided account pay check. Amount of consideration has been received by way of account pay check or account pay after electronic clearing system. These are electronic modes. Then the other dialogue already seen, my auntie's case, 5 crore property, but according to her it's only 3 crore. Can I go to the assessing officer and find out valuation? Same thing will apply here, no change. Same provision, same copy paste. Remember this, we had done the same thing, right? If it shows 190, same table, reproduce the same table. Gift received by employee, we have seen. Anything by business or profession, we have seen. 56(2)(10) is not applicable when the gift received is stock in trade for the receiver. In other words, gift received should be in the nature of capital asset. We saw that Naresh Vishal case. So one more example. Just to clarify the entire, whatever doubts you have. Miss Sita sells her house property. Cost of acquisition 4 lakhs. Acquired in the year 2000 2000. Sells it to Mr. Kunal on 14/11/21. Kunal selling price is 40 lakhs. Sold it for 40 lakhs. SDV 45 lakhs. Let's leave the second part. Now tell me, what is the capital gain for Sita? FEOC that she should take is 45 lakhs or 40 lakhs? 45. Why? SDV is more than 110%. So 45 lakhs. So for Sita, 45 lakhs. Indexation 4 lakh into year of sale, 12 lakh 68, 32 lakh 32,000. Now next this guy, Kunal sells to Adi. But wait, Kunal, should he pay gift taxation? Kunal, should Kunal pay gift? Yes. Why? Difference between the two is more than 50,000 and SDV is greater than 110% of consideration. Hence, after 56(2)(10), Kunal has to pay 45 minus 40, 5 lakhs. So, no? Yes. Now, Kunal sells it to Adi in the year 12/3/22. What will be, a selling price 84 lakhs, FEOC 84 lakhs, less cost of acquisition 40 or 45? 45. 40 I paid Sita, 5 I paid Sita Raman. right? So what? 45 lakhs. 45 lakhs. Cost of acquisition 45 lakhs. So 84 minus 45, 39 lakhs. 39 lakhs. So that is what it is. Simple. Since Mr. Kunal has already paid taxes, now interesting thing will be Sita is not selling to Kunal. Sita is gifting to Kunal. Then what will happen? For Sita, no tax. Why? Gift is not a transfer. And say everything is the same. Instead of selling, it's gifting. Kunal will not pay gift taxation. How much he'll pay? No, I'm asking what is the amount he'll pay for? 5 lakhs or 45 lakhs? No consideration, no? That's what I'm asking. That difference and all will not come here. Without consideration, greater than 50,000. How much will you pay? Full amount. Yes. So, next example. Same. Sita is gifting to Kunal. Capital gain in the hands of Sita. Nothing. Kunal, it's amount received in for adequate or inadequate consideration. Inadequate or no consideration? No consideration, without consideration. So SDV will be adopted. If SDV is more than 50,000, full SDV, 45 lakhs, he has to pay tax on 45 lakhs. Next, Kunal is selling. Is there any change there? No change. Kunal is selling to Adi. 84 minus 45, 39 lakhs. Is there a way that Kunal can avoid paying that 45 lakhs tax? Yeah. So Kunal should marry Sita, and after that, gift. Chapter close. Right? That's the only way. Right? Yes. It should subsist. Relationship should subsist where? At the time of transaction, not later. Whatever. Yes, that is another way of looking at it. Yes. But marrying is easy, man. Adoption is a procedure. Adoption, full procedure it is. Adoption is not easy actually. Right. So, adoption is actually a procedure, right? It's not just you tie one Rakhi and say, from today you are my brother. No, it doesn't work that. So, it is an entire procedure that you need to look at. And adoption cannot be for adults. It is only for children, right? The stepfather, stepbrother relationship will come if the parents, respective parents marry. That automatically comes legally, but not otherwise. So yes, as an entire court procedure for that. So the only way, if they are relative, then yes. If Mrs. Sita, okay, then in that case, guys, let us say Sita and Kunal are relatives, and I am giving that entire 45 lakhs to Kunal, worth house. Now he is selling to Adi. What is the FVOC? 84 lakhs. What is the cost of acquisition? Cost to the previous owner. What was that? 40 lakhs, how much? 4 lakhs, no? 4 lakhs. Period of holding will be from 2001, 2000. Yes, previous holding will be 2000. That is given here. Everything is given here. So capital gains in the hands of Ms. Sita will not come. In the hands of Kunal, 84 lakhs minus 4 lakh into 317 by 100. 12.68 lakhs, 71.32 lakhs. Yes, correct. Right, 71.32 lakhs. That is what it is. Because again, you have to anyway pay that. So seeing all these things, you should decide your life partner. Right, calculation. Right, so that is what it is. Cool. So we'll take a break. After that, short break and then we will continue with this. We'll finish off this, guys. All hidden points, we'll finish it off. Yes. All right, guys. So, moving on. Last leg of the day, we'll finish off this IFOS. (43) CA, that is special section for determining FEOC of stock in trade, real estate sector. This is real estate sector. SDV greater than 110% is same. 50C, 43 CA, both are the same, land or building. SDV greater than 110% of consideration, then FEOC is equal to SDV of such immovable property. But in order to boost the demand, only if possible, I mean nowadays they won't ask, but during this, in case they want to ask, only after COVID, to boost the sector, they gave the threshold value little gap, because land rates had fallen miserably, consideration they were getting at lesser rate. So, from 12/11/2020 to 36/2021, only during those dates, any asset sold, etc., you will take 120% threshold, not 110%. Enhanced limit of 120% shall apply in respect of first allotment of residential units new. Value is up to 2 crores. Same like 54, that value should be only 2 crore. For all transactions only between 12/11/2020 and 36/21. After 1/7/21, everything is the same, 110%. Mind you, this is for land or building or both, especially for home buyers, to liquidate their unsold inventory. If land alone is being acquired, range should always be 110%. So if they give you these dates also and say only land, it is still 110%. Similar amendment was made for here also, this side. So, MGM Builders transferred a new residential unit to Mr. Shah Rukh Khan on 24/5/21 for 1.8 CR. SDV is 2.11 CR. 20% threshold on 1.8 crore. 20% threshold will be how much? 2.16 crore. Is it exceeding 2.16 crore? No. Is the SDV exceeding 2.16 crore? No. Hence, 1.8 only will be FEOC. Same way for Shah Rukh Khan also. This will be what? SDV minus consideration will be more than 50,000 and yeah, 120%. Same thing. There are many such examples like that. So, Amarnath Builders, Arvind Builders. Now, one more question here is, this 120% thing is for land and building or both? I mean, land plus building or only building? Only for land, not allowed. 43 CA is for what? It's for builders who are selling their land. Will this apply if a builder is selling to one more builder? In this Varun example, you remember Nehal and all example, both were stock in trade. For stock in trade, will 43 CA also apply? 43 CA will apply, but will 120% apply? During that time from one builder to other builder? No, it is only, so most important thing to note there is 120% benefit is for only 43 CA plus 56 210, which means builder stock in trade plus buyer capital asset. 120% is not applicable to 50C. 50C is what? Capital asset plus capital asset. Or just stock in trade, stock in trade. Transactions with 56 to 10 will not apply. Any immovable property being land or building or both, recipient is what? Member of unauthorized colony in the national capital. It's only in Delhi, guys. It's received by them. So their central government has given a thing where they will redevelop their slum dwellings and other dwellings, and then they will create a new house. For them, it's not apply. Quickly we can go. Any movable property being unquoted shares of a tribunal of a company and subsidiary and the subsidiary of such subsidiary. This is predominantly where you have gone for oppression and mismanagement. If you have gone for oppression and mismanagement, whereby then the tribunal will allot you certain shares for that free of cost. For oppression and mismanagement, you have applied under section 241 of Companies Act and they have suspended the board of directors, then whatever you receive will not be governed by 56, specific exemption. So in the exam, just look out for this Delhi thing, they will not give, but this they may give, if it's a oppression mismanagement case under section 241. Compromise arrangement, oppression mismanagement. Similarly, reconstructed bank also and a disinvestment program by the central government. Disinvestment program by the central government would be strategic disinvestment, like for example Air India. When Air India was dissolved, the Tatas bought it. So the thing is, in that case, whatever shares which are given to being shares of a public sector company, Air India was a public sector company, that was given to Tata. So in that case, whatever valuation difference, etc., everything will be ignored, is what they are trying to tell. Recipient will not get anything. Then during COVID also, any treatment. COVID, anyway, no one cares about COVID anymore. So this point also, you can just ignore, no problem. Now, quickly, we can brush through what is this 11 UA, determination of FMV. Everywhere we have told FMV of shares under 11 UA, FMV of assets under 11 UA and 50 CA also. So valuation, jewelry, open market valuation or invoice value, or you can hire a registered valuer. Archaeological collection also same thing. Quoted shares, this will be transaction value recorded in the recognized stock exchange. If it is not carried out to recognized stock exchange, FMV will be lowest price on recognized stock exchange on valuation date, lowest price on recognized stock exchange on the immediately preceding date if there is no transaction on the valuation date. So for 11 UA, rule number 11 UA, I should take what? The lowest price. The lowest price. This is for quoted shares. Quoted means listed in the stock exchange. Unquoted, it would be the fair market value of unquoted shares other than equity shares shall be the price it would fetch in the open market. You may obtain a report. This is for other. But if they ask you this one, unquoted, this is the only thing that they'll ask, guys. All other things, time pass. This is the only thing that they'll ask you. What is the FMV of unquoted equity shares? So if I do have to do the valuation, A will be book value of all the assets other than jewelry. We have seen this already. B will be FMV of jewelry and artistic work. C is what? Shares as determined in the above. D is property. L is all liabilities. So basically, this is nothing but the entire net worth sort of a thing. Shareholders funds, all assets minus outsiders liability. And then I should calculate what? This entire net worth is for the entire bunch of shares. But I only want a specific unquoted equity shares only, few shares. So cross multiply, that's all, into PV by P. What is PV? Total paid up value of such equity shares. Then total amount of paid up share is the full shares. Very simple. If I am issuing bonus shares, capitalization of reserve, do you think 56,210 will come? I am getting shares for free, no? Is it a capital receipt not taxable? We had discussed bonus issue. For bonus issue, will it be allowed? No. Expenses, will it be allowed for bonus? Allowed. Why? Your capital base is not increasing as such. So here, if I am getting some few free shares, 10 shares, market value of each of those 10 shares is 10,000 rupees, 1,000 rupees, whatever. Should I pay tax? Is it IFOS? Yes, receipt of share to shareholders. Issue of bonus share is a capitalization of reserve. There is no addition or alteration to the total funds available with the company on account of issue of bonus shares. Hence, provisions of 56,210 would not be attracted in the hands of the recipient shareholders on receipt of bonus shares. Yes, it will be taxed anyway in the sale of shares. So at the time of issuing bonus, no problem. One part of the entire section is whatever we have discussed till now, the IFOS. Other part which also they will obviously give is dividend. So it's the dividend, concept of deemed dividend. So if I were to talk about dividend, dividend is the return on investment to clause 35. Dividend is of two types: interim dividend, where you would recommend and declare under 123(3), and basically interim dividend is recommended and declared by the board of directors, whereas final dividend is recommended by the board of directors under 134(3)(k) but declared by the shareholders under 102. So final dividend is a dividend where recommendation and declaration will happen both by whom? Separate people. Whereas interim dividend, recommendation and declaration will happen by the board of directors. Income Tax Act earlier had something called 1150 corporate dividend tax and 1034 exemption. So they will pay tax, the company would have paid tax, but in your hands it is exempt. But now dividend is taxed in the hands of the shareholders, that is SSEs, it is taxed. So because of which, instead of paying dividend, what were people doing? Companies were trying to distribute the assets. So if the equity share capital is 2 lakh, asset is 2 lakh, free reserves and general reserve 1 lakh and 2 lakh. I can give this as dividend, but I don't want to give. What will I do? If I give dividend, you will have to pay tax. Instead, what will I give? I will start distributing, I will buy assets worth 3 lakh and start distributing these assets to the shareholders. Any asset for that matter. I was supposed to give you 2 lakhs dividend. I will give you the, iMac Pro. Just saying, I can buy assets and give it off to you. For any gift, is it a transfer? No, gift is not a transfer. And you are receiving what? An asset. The thing is, and you are receiving it in from whom? From the company. So anyway, you will pay tax or not, that is immaterial. Company was escaping the tax. So I want to charge the company also. You will anyway pay tax, 56 to 10. But I want to charge what? Here also. You. I could actually buy goods belonging to the company and I can distribute them as well. Anything for that matter. Stock also is an asset, no? I am into coffee manufacturing, tea manufacturing. So I can give you 1 lakh, 2 lakh worth of tea. I'm just saying because the thing is, it export quality tea, not the normal one. Tata was actually doing it. To their employees, they were doing it though. These are export quality tea. It's not some random tea that we drink. High quality, top notch. So can you do all those things? That's why they said, if you do all those things, I will tax you only. Who? Taxing the giver. Taxing the company. It is not exactly dividend to the, what do you say, shareholders, but it is deemed to be something like dividend. That's why they inserted 222 A, B, C, D, E to curtail this from happening. Right? Yes. Corporate tax earlier they would pay from your own pocket. It's not TDS. Now it is dividend. Now they have to deduct TDS and give. But the thing is now shareholders are like, I don't want to pay. Instead of this, you give me that. You only buy an asset and give me. So to plug that, 56 to 10 came. But then you are claiming expenses left, right, center on that and claiming tax deduction. Correct? So I'll buy something and I'll show it as an expense. Payment to employee, payment to shareholders. In the sense, I'll just say that expenses in relation to shareholders. But ultimately, I'm transferring asset, but I'm claiming expense also. Best part. It's not a fixed asset that I'm giving. I'm buying a laptop and expensing it off and claiming 30% deduction on that. So 222 AK. So let's read. Yes, tell me. To a? It used to be once upon a time. It used to be in partnership firm. What is the scene now? Who will pay the tax? Firm. And for the partner, what is it? Share of profit? Exempt. Here, dividend also used to be like that. Corporate dividend tax I'll pay, and for you, shareholder, exempt. Okay. Which one? Where? Huh? They are not collecting from them. It is double tax. 100% it is double tax. For sure. It is. That's why people didn't like the concept of dividend being taxed at the hands of the shareholders. Same question they also asked. You're already paying tax, why are we taking? They said, no, for dividend is extra tax. It's an extra thing that you're giving away. You keep it to the reserves and surplus, no problem. You reuse it for the business, no problem. But now you are parting it with from the company to the shareholder, so pay tax. So that's why separate corporate dividend tax used to be imposed before. But shareholders kept quiet because they don't have to pay anything, no. But now onwards, like 2-3 years ago, who has to pay? Arun Jaitley introduced that, dividend taxation. But then people were misusing, doing these things. So there is no breathing space only. Everywhere, they will do it. So 222. So what you asked was logical. I have no answer to that. Actually, there is no need why I should tax it. It's like a firm only. But anyway, taxing your profit, why again? It is 100% double tax, no doubt about it. So if any domestic company distributes all or any part of the assets of the company to its shareholders to the extent of accumulated profits, only to the extent of accumulated profits, whether capitalized or not, that also they added. Means capitalized or not means what? Accumulated profits can be in the nature of bonus shares also, no? That's why they said capitalized or not. shall be taxable as dividend in the hands of the shareholders. So, when I am distributing the assets, you will have to take it. On what rate will I take it? 222 ACD. Asset transferred will be market value as on the date of distribution. And for you, will that be a cost of acquisition in the future? Yes. Let's take an example, you'll understand. Asset distributed, book value is 6 lakh. FMV is how much? 12 lakh. Reserves and surplus is 11 lakh. Always remember it is only to the extent of what? Reserves and surplus. Because you are actually sharing the reserves and surplus. Next, asset distributed, book value 6 lakh. FMV 8 lakh. So in this case, tell me, what is the deemed dividend 222.8? Only to the extent of reserves and surplus. So 11 lakh. 6 lakh is the book value, 8 lakh is the FMV. How much? 8 lakh. 6 lakh is the book value, 14 lakh is the, is the FMV. How much should I take? 11 lakh. 6 lakh is the book value, 9 lakh is what I am giving for 9 lakh. Then 6 lakh and 4 lakh, 4 lakh. Now one more interesting thing here is, as a recipient, deemed dividend is taxed in whose hands? Company's hands. Recipient, you are the recipient. In the first case, you see, you are getting an asset valued at 12 lakh, but you are getting it for what? 11 lakh. Right? Nirmala madam doesn't leave anybody. Are you understanding? So 12 lakh, 11 lakh is fine. So second one, no problem. You see, second one, I am getting an asset worth 8 lakh. How much has the company paid tax? 8 lakh. Chapter close. Other 4 and 5 also no problem. Only 1 and 3 I have a problem. I am giving an asset worth 12 lakh. But actually it's being recorded that it's only been given to me at 11 lakh. But actually what's the value of the asset? FMB 12 lakh. First of all, movable asset. What's the dialogue? If the difference between the two is more than 50,000, then difference is taxable, not whole. Difference is taxable. What's the difference? 12 minus 11. So unfortunately, in the hands of the recipient, 1 lakh is taxable. Here 3 lakh is taxable. So crazy double taxation it is. So first of all, I am giving you the asset and you also have to pay tax under 56(2)(10). No mercy. Because you are receiving much more than, you are receiving less than actually the FMV. FMV is 12 lakhs, but you are receiving it at 11 lakhs. So you will have to pay tax on extra 1 lakh. Tomorrow when you are selling the asset, what will be your cost of acquisition? Because you have already paid, no? So 12 and 4. 12 and 4. Harmonious construction it's called. Same examples given here. So share capital 25 lakhs including bonus of 4 lakhs. So to avoid this from happening, what people were doing, let me pay less tax. So like that they were, instead of reserves and surplus, they were shifting some to bonus shares. Can I pay bonus in lieu of dividend? I want to pay less tax. So instead of 11 lakhs, I used to tell them, boss, I'll give you bonus now, 5 lakhs. Remaining 6 lakh, I'll distribute dividend through this deemed dividend concept. I'll pay tax on 6 lakh, close it. Extra 5 lakhs, it's free for you, take it. On this, no 56(2)(10). So they said nothing doing. You see, that is why whether capitalized or not, means 25 lakhs including bonus of 4 lakh. reserves and surplus 12 lakh. In this case, accumulated profit 12 lakh plus 4 lakh, overall 16 lakh. Includes capitalized profits in the form of bonus shares. I should still take what? 12 plus 4, 16 lakhs as accumulated profit. So 222A is distribution of the assets. (222B) distribution by a company to its shareholders by way of what? Debentures, debenture stock, deposit certificate in any form with or without interest, or to its preference shareholders by way of bonus shares. So here I am distributing to shareholders. Instead of paying back dividend, I am giving them debentures. I am issuing debentures to them, debenture stock to them, deposit certificate to them, maybe with or without interest. That will be deemed to be dividend. Secondly, preference shareholders will never get any bonus shares. It's always to the equity shareholders. So they created a new thing, giving bonus shares to preference shareholders. That also is taxed. What about bonus shares to equity shareholders? We still have to maintain that is not taxable. That's your note. It shall never be deemed to be dividend, but it will be included in the calculation of this dividend. That's for sure. So summary of 222B. The following shall be treated as deemed dividend in the hands of the shareholders: debentures, debenture stock, deposit certificate, any shareholder, equity or preference, or bonus shares, preference shareholder. Huh? But the thing is, they are issuing free of cost. No? They are not collecting any money. All these things are free only. Distribution of assets is what? Are they taking any money? No. This also they are just giving debentures like that. Except bonus shares. Bonus shares is allowed. Yeah. Correct. There is no concept of giving bonus shares to preference shareholders. These fellows were creating that also. Right? Bonus shares are always capitalization of reserves. That will always be taken by the owners. Who are the true owners? Equity shareholders. Next, 222C. Distribution in the case of liquidation. So guys, here this liquidation, it is made to whom? The shareholders of the company, and only equity shareholders. Distribution is always made to equity shareholders on liquidation. After all the shareholders are given their money, finally who will it be given to? Equity shareholders. So this section covers only equity shareholders, does not cover preference shareholders. Point number 1. Point number 2, this talks about any distribution. That will be cash, asset and cash plus asset. Reserves and surplus, whether capitalized or not, everything is covered. So, what does it mean? What do you mean by liquidation? Company may be liquidated on 14th October 22. It means that the procedure has begun. The entire proceedings is called as winding up proceedings. And finally, on the last day, when the name is struck off from the register, it is called as dissolution. Right? So, it's liquidated on 14th October 22. Winding up proceedings begin. And when is it dissolved? On 10th October 24. and on 10th October 24 it is deemed to be dissolved, means on that day it ends. Now the question is, I should check about distribution based on what? Reserves and surplus, whether capitalized or not. Question to you is, the reserves and surplus I should take on which date? Liquidation date or dissolution date? That was the exam question. They'll give you liquidation date reserves and surplus figure, dissolution date reserves and surplus figure. This section taxes what? Any payment made on liquidation. So you know your ending. You will start distributing. So you will take the end date or the beginning date. Yes, so Supreme Court judgment should always be taken on the date of commencement of liquidation. Act is silent, but logically it should be taken on the date of commencement of liquidation. Sorry? Yes, so here they are telling 40 lakhs is the beginning, sunset time 10 lakh. So I should take what? 40 or 10? 40. Because I am distributing only from now, right? That's why. Now interestingly, here we need to finish off one more small chapter which is along with this only. Chapter number O. Taxation of what? During liquidation. During liquidation. So as I told you, these are only the heavy duty stuff. Other things are all small areas. Anyway, this I'll just show you here only. That will also be covered anyway. So very simple, guys. Company you see here, now I'll come to that because it's regarding here. In all these things, I am distributing the dividend to you. Earlier I used to pay dividend tax. Now I am not paying. Who's paying? You are paying. Now you are escaping that thing and I am claiming the expenses, etc. Whatever I do, the crux of the matter here was I had to stop you, that is the shareholder, from forcing the company to pay other than dividend. Right? So in the concept paper initially they had discussed that we should tax whom? Shareholder or company? Company. When I come to liquidation, now you will understand this. So that's why ABC I came and now I am going back. So now whatever it is, I should discourage the people from doing so. So then when the law came, everyone was shocked. In the law now, deemed dividend is from your end or my end? Recipient end or giver? Recipient. And this entire IFOS, if you are doing 56 to 10, whatever it is it recipient or giver? Recipient. So they said, you do whatever you want, I don't care. When I am taxing the final recipient, he will only come and tell you, boss, I don't care anything, just directly give me dividend, because now you are giving me so many things. Right? So what they were doing was, anyway I have abolished the concept of corporate dividend taxation. So I have to give you what? That extra amount, whatever I would have given in the normal way, I am giving in an indirect way. So by taxing you in all indirect ways, what has happened? By taxing you in all indirect ways. So ultimately, what is the section saying? That ultimately the dividend will be in whose hands will it be taxed? See now you will understand. If any domestic company, because I will come to liquidation, there I will tell you the taxation. Any domestic company distributes all or any part of the assets of the company to its shareholders to the extent of accumulated profits, whether capitalized or not, shall be taxable as dividend. Where? In the hands of the shareholders. In the hands of the shareholders. So here in this also again, why I showed you here and stopped is, in liquidation alone, taxation will happen two places. One for the company and for the shareholders. Right? Yeah. So you see, in this example, how much deemed dividend will I pay tax on? 11 lakh. 56 to 10, how will I pay tax? 1 lakh. Ultimately, how much I am receiving? 12 lakh. 12 lakh I have to tax anyway, because that is something that I am receiving it for free. So that 12 lakh is split into two parts, 11 and 1. Here 222A deemed dividend, how much will I pay? 8 lakh. So when you are directly giving you dividend, you will, what do you say? When I am directly giving you dividend, you will do anything in your capacity to escape it by taking other payments. So when I am giving you in the form of direct expense, I am giving you as a dividend, you will anyway pay tax on it. But to avoid it, what are you doing? You are taking assets, etc. So now I am going to tax that also. So 8 lakh fully taxed. 14 lakh asset you bought. 11 lakh tax as deemed dividend. 3 lakh tax as what? 56 to 10. So if you see the wordings, 222A dividend in the hands of the shareholder. 222B, it is again in the hands of the shareholder. It is in 222C, where this is in the hands of the shareholder, but one more taxation comes, that is 46. That is in that chapter number O. That's what I am trying to tell. That is in chapter number O. Got it? So chapter number O and this put together, here. Company is going for liquidation, and then they will distribute assets to the shareholder. They will distribute assets to the shareholder. Will there be double taxation in this case, where shareholder also will pay, company also will pay on liquidation? Company is anyway dying. So section 46 says company, subsection 1, 46.1 says company will not pay tax. 46.2 says shareholder will pay tax. So for the company, guys, 46.1 no tax. 47, any transfer done during liquidation, we have already discussed, during liquidation, amalgamation, demerger, any transfer, not a transfer. And will there be capital gain in the hands of the in the hands of the company, guys? Will there be capital gain? No. On the other recipient, on liquidation, you are distributing assets to me. 222C is just a replacement of 222A. That's how you should understand. 222C is a replacement of 222A. What is 222A? Distribution of assets. What is 222C? Distribution of assets. Only change is here it's liquidation. There no liquidation. Then you saw this chart, no? That's why saw this chart. 222A replaced by 222C, liquidation. If I receive any asset of FMB 12 lakh rupees, but in liquidation, 11 lakh only will be charged. Under which section? 222C. Remaining 1 lakh also has to be charged, right? That is not under 56.210. That is not under 56.210. That will be under 46.2. That's the only difference. That will be under 46.2. 56.210 will not come for liquidation cases. 56.210 will not come for liquidation cases. What will override what? 46.2. 46.2 is a specific section for liquidation, which will override 56.210. That's all the differences. There is no double taxation as such. 46.1 no tax. So in liquidation, company during liquidation gives some assets or cash to the shareholder. 46.1 for the company side, no tax. 47, not a transfer, no capital gain. 46.1, no tax. 46.2 says shareholder has to pay tax. 222C replaces 222A for the distribution, 11 lakh in the example. 1 extra lakh, ideally I should pay under 56.210. Now I will pay under 46.2. That's all there is to it. So other thing, wordings are the same only. Yeah. Which one? Yeah, we'll see that. You see an example, we'll just brush through. Liquidation date 30/6/2020. Cash 3 lakh, asset 3 lakh 20. Equity share capital 4 lakh, reserves and surplus 2 lakh 20, 6 lakh 20, 6 lakh 20. 4 shareholders are there, 1 lakh each, their capital contribution. Distribution is happening on 14/2/21. Each shareholder will get cash of 75,000, assets, book value 50,000, market value 2 lakh. Each shareholder is getting so much. Taxability of that company exempt. Taxability of shareholders. Total amount of distribution I should take. How much? 2 lakh into 4 people, 75,000 into 4 people. Total distribution is 11 lakh. Step A will be taxed under 46.2 and 222C. 222C will be only till the extent of accumulated profits and balance will be 46.2. So 11 lakh, what is the accumulated profit? 2 lakh 20. So 2 lakh 20, to the extent of 2 lakh 20, it will be 222C. Additional amount 8 lakh 80, it will be under 46.2. So for each shareholder, deemed dividend 222C, 2 lakh 20,000 by 4, how much is it? 55,000. 55,000. Taxation under 46.2. FMB 2 lakh plus 75,000, overall 2 lakh 75,000. FMB of an asset I got, no, how much? 2 lakh. Cash I got how much? 75,000. Total I got 2 lakh 75,000. In this 2 lakh 75,000, 55,000 is already taxed as deemed dividend. So the balance FVOC is what I will have to, that is the full value of consideration. He asked a question, is it capital gain? Yes, it is capital gain. What is the full value of consideration? Whatever I am receiving minus deemed dividend already paid under IFOS. Balance will be full value of consideration under capital gain. But that is the full value of consideration. I have to subtract what? Most importantly, my capital, cost of acquisition. They would have given in the problem. In my example, 1 lakh indexation you do, balance will be LTCG, yes, LTCG or LTCL. Reserves and surplus should be taken on the date of commencement of liquidation, we already discussed. But FMB should be on the date of distribution. FMB should be on the date of distribution. Reserves and surplus different, taken on the date of commencement, but FMB should be on the date of listing. So if you see, one second. Question number 9, page number 52, guys, page number 52. Last question number 9. Aries Tubes Private Limited went into liquidation on 1/6/23. The company possessed the funds prior to distribution of assets. Share capital 5 lakh. Reserves prior to 1/6/23 3 lakh. When did it go for liquidation? 1/6/23. So reserves I should see on which date? 1/6/23. Excess realization in the course of liquidation 5 lakh, total 13 lakh. There are 5 shareholders, each of whom received 2,60,000 from the liquidator in full settlement. Shareholders desire to invest the resultant element of capital gain in 54 EC. Old study material, new study material, previous year paper. What is the accumulated profit? 3 lakhs. 5 shareholders, to the extent of accumulated profit, 3 lakh divided by 5, 60,000 is deemed dividend in hands of each person. How much does each person get? 2,60,000. In that 2,60,000, deemed dividend is 60. What is the balance? FEOC 2 lakh. 2 lakh is the FEOC. Everybody with me understood? 2 lakh. 2 lakh minus share capital 1 lakh after indexation. Shares are held for more than 24 months. Correct, no? So 3 lakh divided by 60 by 5, 60,000. What is the distribution? 2,60,000. In that 2,60,000, I will remove whatever is paid under IFOS. Balance will be 2 lakh. That is my capital FEOC minus the cost of acquisition. Each person had deposited 1 lakh. 1 lakh into, you will have to do the indexation. Balance will be my capital gain. Yeah? Correct. Assume. Implied, yes. Because it's always based on your share capital. Now, one interesting case, which I couldn't discuss that time because I had to do this. 54 EC available or not? Why? Are you selling anything? Yeah, are you transferring anything? No. No, 54 EC, what does it say? Asset transferred is land or building. Okay, then that's it. So here, okay, What did I even transfer here? Did I transfer anything? Let's say I got one house, I got some land or building only. I'm just assuming. In liquidation, I got building. Then, are they transferring? What is the transfer? Is it like actual transfer or deemed transfer? It's actually deemed. That's why otherwise this could have been in that same section, no? What is a transfer? What is not a transfer? Why is separate section given? Because this is a concept of deemed transfer. So, more than land and building logic, this is not even a transfer, it's a deemed transfer. So, by that logic, if I even received a land or building through this deal, liquidation deal, still 54 EC will not come. So, yeah, because you see, exemption under 54 EC is available only when there is an actual transfer of capital asset and not in case of deemed capital gain. This was a Rajasthan High Court decision. Huh? Are you relinquishing the right? What are you doing in liquidation? Closing down the company, but are you closing down your shares? Are you giving something? What are you doing? Right? So, in right shares, I am relinquishing my right. So, here what am I doing? Your shares are your right in the asset. Right? So, are you abandoning the right out of your own free will? No. Right? So, basically that's why the court also said, boss, look, those things are when you actually sell on your own. That's why I have given you compulsory acquisition also for two things. Otherwise, you don't sell on your own, normal transfer. But it will not. Otherwise, I would have put everything in section 47, 2 clause 47. Why have I given a separate section? I could have made a liquidation section there only, no? Correct? So, it all, everywhere it says any transfer as defined in so and so section. But this is not a transfer as defined in so and so section. It's a transfer as per 46, which is actually a deemed transfer. And furthermore, as I said, land and building. Now, suppose I got a land and building. Now, getting a land and building is not transferring land and building, no? Right? So, that's why they said not allowed. Yes. Few more points and we'll end for the day. Today was little heavy duty, I understand. Especially post-lunch session was heavy duty stuff. Right. But we have to do, no choice. Because all this is, if I don't do all these things, these questions only will come. Right. So, and it's actually like that. It's not inter and all is easy, guys. This is a different level capital gain. Assessment procedure also, anyway, inter is not there only. Little bit is there, but yeah, here it is a different level. They have to understand the procedure, and especially in the light of the fact that entire search, seizure, everything they have changed in Finance Act 24. They have brought back something which was there 20 years ago, which means we have to study what was there now, right? So, we need to study all that. Yes, 224C done. 224D, this is internal reconstruction, what we call as legal begging, correct? Legally when we beg, legal begging. So, we will go beg everybody, they will give you some money as alms, that alms you will keep it as capital reduction account. So, you will take off from the liability and from the assets and then add the liability capital reduction account, ultimately everything you will knock off, basically cleaning the balance sheet, capital reduction. So, in a capital reduction, what happens, guys? Any distribution by a domestic company as to shareholders on account of reduction of share capital, again to the extent of accumulated profit either capitalized or not, shall be taxable in the hands of the shareholders as deemed dividend. Same, whenever there is reduction of capital and they are distributing certain things, distribution attributable to accumulated profits, deemed dividend under 222D. Distribution attributable to capital, capital gains. Narasimhan, 1999 case law. So, any reduction by way of what? Any reduction by way of write-off of accumulated losses shall not be constituted as deemed dividend, as there is no distribution of assets. So, write-off and all if I do, it will not be covered. It is only what? Distribution of accumulated profits. So, here when they do a reduction as such, if it is attributable to capital, it will go to capital gains. If it is attributable to accumulated profits, it will be going to deemed dividend under 222D. So, this section is again not applicable to any preference shareholders, it is only for these people. Same guys, I should take the FMV of the asset on the date of distribution. So, what will they do? They will reduce the capital, no problem, that is a benefit for me. I will ask them, what will you give it to me in return? They will say, please sacrifice 5 lakhs of your share capital. I said, okay, no problem, I will do it. What is it that I will get in return? They will say 2 lakhs I am going to give you as what? The assets I will give you 2 lakhs. To the extent of 2 lakhs, it will be deemed dividend. But what about the loss of my capital 5 lakhs? That will be adjusted in capital gains. That will be adjusted in capital gains. So, if you see 222 A, B and D, accumulated profit shall include profits up to the date of distribution. 222 C, it will up to the date of liquidation again. Something lighter will do, no problem. Okay, so guys, we'll just finish this last section and then remaining we'll do tomorrow. That hardly any time, we'll take it, we'll do it tomorrow. No, 222E we'll do tomorrow. Come to this is the last time ever, November 24. Share premium in case of a closely held company, popularly called as angel tax. This is for angel investors, because I don't know who's that investor. So what? It was actually a mechanism to convert black money to white money, whereby I will invest lot of black money in the company and you will give me, or you also have lot of black money eventually you will get, and you need white money initially. So I will pump in lot of white money into the company and you will allot shares to me. Though the value of the company shares is 110 rupees, I will invest at 1000 rupees. At a premium of 900 rupees, I will invest. So immediately what you will pay? You will pay me cash. I am settled. Later when I exit, I will exit it at 110 rupees. Win-win for me, because first of all I invested my full white money 900 rupees, 10,000 rupees. Though the value of the share is only 100, 900 rupees worth of value gave me black money. For you, black money got over. For me, I needed black money, I got it. Next, you are saying, boss, exit the company. I am exiting. While exiting, what I will do? I will have a heavy capital loss, because I will sell it at 110, 120. What is the FVOC? What is the cost? 900. What is FVOC? 110. Huge loss. Can I carry forward the long-term capital loss? Yes. That's why they said now, if you are taking any share, any shares of the company at a premium, what is the premium you are actually? 900 rupees premium. And what is the fair market value? 100. Premium is 900. What is the amount that you are getting it for? 1000. What is the only way to tax to ensure that you will never take like this? Whatever money you take, it should be according to the valuation. That's why for venture capitalists, this valuation will do. But angel tax is random person investing money, predominantly used for conversion of black to white, white to black. So the government had told for this 900 rupees being the difference between consideration received and fair market value, 900 bucks, 1000 minus 100 in my example, will be chargeable to tax. Now this has been, yes, or any closely held company, which is private company or a public company which does not have share, public holding share, that is unlisted public company. Yes, this is tax in the hands of the company. This section which was there to protect unregulated deposits into the company has been removed from November 24, which means last time ever or attempt, November 24. So from Finance Act 24, I meant, from Finance Act 24 they have removed. So the concept of angel tax, now anybody can invest anything anywhere, no problem. Introduces for black money thing only. That's what. But madam said it is for ease of doing business. That was a dialogue actually. I'm not even joking. Yes, ease of doing business, right? So actually I'm not even joking. If you read the memorandum, they have mentioned the same thing. Many people should invest and it's a growing economy, ease of doing business, no angel tax, right? Yes, that is the logic, right? But anyway, last time ever in our attempt, they will give. So where a closely held company in any previous year from any person, that being a resident also is omitted from 1st April 24, which means in Finance Act 23, being a resident. Any consideration for issue of shares at a premium exceed, whenever I say with effect from 1/4/24, it means assessment year, which means Finance Act 23 only, exceeds face value. The difference between the consideration received and the fair market value shall be chargeable to tax. Which means in Finance Act 23, they said not just a resident, even non-resident also cannot, when if you, non-resident also money if you receive, ultimately it will be angel tax. Company has issued shares at 150 while the fair market value is 135 for 15 rupees. 135 rupees is chargeable in the hands of the company. FME will be method prescribed, any of the methods, or according to the satisfaction of the AO based on the date of issue. It can be substantiated by the company. You can show your own valuation, and if he agrees, it's okay, whichever is higher. This will not apply to venture capital undertaking, venture capital company, or by a company as may be notified by the central government and from a non-resident. So, or a specified fund also they have given here. So, specified fund will be your AIF funds and all those things. Now, they said this section will not apply to an eligible startup. So, for startups, angel tax will not come, which is good. There was no need to remove angel tax itself. To curb black money into white money, I will impose angel tax, but I will remove angel tax for startups. That made sense. So, ease of doing business. So, yes, so 56 to 7B. In case where eligible startup, so now we should understand what is a startup. Fulfills the following conditions. Any premium received will not be chargeable to angel tax. First of all, it will be recognized by your Department for Promotion of Industry and Internal Trade, DPIT. Then some of the figures you should just remember. Aggregate amount of paid up share capital and share premium after issue of proposed issue does not exceed 25 crore. What is the paid up share capital? 25 crores. But this 25 crores does not include amount received from non-resident, alternate investment funds or any listed company. So if listed company is pumping in money, no problem. So from normal people, you should not receive more than 25 crore, which is self-generated fund or from some other people. Next is what? Startup should not have utilized the proceeds for a period of 7 years from the latest financial year in which the shares are issued at the premium. So which means what? For 7 years before, they should not have bought a building or land or residential land. Should not have done. If it's stock in trade, it's okay. Basically, they are trying to tell boss, whatever money you got now, put it in business, not in acquiring some property. Then motor vehicle, aircraft, yacht, all these things, actual cost exceed 10 lakhs. I got funding from somebody, I bought one Mercedes Benz. No. Private yacht in Goa. No. It should be exceeding 10 lakhs, not allowed. No jewelry, none of the other asset. Painting I bought, all that not allowed. Investment in shares I cannot do. Capital contribution I cannot make to other entity. I cannot grant loan also with that money. So basically first condition, whatever paid up capital and share premium after issue or proposed issue will not exceed 25 crore. 7 years from the latest financial year in which the shares are issued should not have utilized the proceeds for all these things. But what is a startup? Startup means from the 10 years from the date of incorporation, that is called a startup. The date of incorporation, 10 years. Turnover is less than or equal to 100 crore. And main object should be what? Innovation, development, improvement. So this cannot, the problem with India is anybody who asks what are you doing, they'll tell startup. What is a startup? Pani Puri stop. Right? So startup will be what? Startup is not some shop that you have. It should be a scalable business model. That is a startup. Right? So you can't just randomly say this is how it is. It should be a scalable business model. So there was this guy, in Infosys shareholders meeting, true story. Everyone was just sitting and chilling and questions you can ask. No, Narayan Murthy was a true story. Narayan Murthy, everybody was there. One fellow came late. He sat and he raised his hand. He said, what happened? So he started asking such amazing questions that everybody started shivering, including Narayan Murthy. He couldn't answer any questions. So this guy came late because he likes eating. So he was going and eating all that samosa, all that extra they'll kept. No, he would have eaten and come. True story, not joking. So after eating, then again one break will be there. Again he went and started eating there properly. So Narayan Murthy is narrated by Narayan Murthy only. Narayan Murthy went and told, excuse me sir, shareholder, no. That guy turned, said, sir, excellent questions. See, when you cannot convince that person, what will you do? Ask him to join you. So he said, sir, will you join our company? This is how, Mohandas Pai. Have you seen Mohandas Pai? Mohandas Pai was what? CFO of Infosys for a long time, guys. TV Mohandas Pai, chartered accountant. Whenever budget comes, no, you should listen to this guy. So he will analyze the budget in half an hour and then he will, talk about it. So in Bangalore, they organized this session. So lakhs and lakhs of, actually thousands of people attend his session. And of course, now it's online. So yes, very unassuming guy. So this guy then joined this thing and did Infosys, and he left Infosys for Manipal Group after many years. When he actually left, the share price fell by thousands of crores that one day because he resigned from this company. So Mohandas Pai took over Manipal Group. And Manipal Group is in Udupi, Karnataka, so near Udupi. So he was heading all these things. One day I was doing his usual round. So actually huge auditorium, some 3,000 people were sitting and one guy was teaching. So this guy, Mohandas Pai, was like very shocked. What is this? Let me go see. So there he was teaching something and he didn't know that Mohandas Pai was sitting. So after he taught and all, he went away and Mohandas Pai came to him, said, hello, excellent, whatever you are teaching was top notch, amazing. This guy turned around and said, thank you, sir. So this guy, because of his vision, he said, I want to invest in you right now. Will you agree? Let's start a company, or if you already have a company, I'll invest. He said, okay, sir. What is your name? Baiju Ravindran. True story. So Baiju Ravindran was actually what? Given that impetus by TV Mohandas Pai of Manipal Group. That's the history of Baiju Ravindran. He started with some 4 students, 8 students. Then because he was so good in math, and that which is needed to crack that CAT exam and all, so he went to all these colleges. In Manipal, when he taught, 5,000 students were sitting. This guy also was shocked. Then they came with a scalable model. You don't teach here everywhere, you just release everything online. This is what I'm talking about 15 years ago, you know. They started giving, they had a tie-up with Samsung tablets. And they said the app was installed in Samsung tablet. 15 years ago, the concept of app and all was little different. Now everywhere, everyone has an app. I'm talking 15 years ago, everything was different. So they were the first company, people were shocked. You open this Samsung tablet and Baiju's app will come. So they said Baiju should not be a person, it should be a company, it should be an identity and a brand. That's how it started. So that is a scalable model where it can be scaled across the country. And then they went back. They said start 10th standard, start 6th standard, then IIT coaching. Then they bought White Hat Junior, coding at the age of 6. Right? When we were at 6 years, what were we doing? Lollipop, red lollipop or pink lollipop. Now these kids actually do what? Coding at age 6. Crazy it is, right? Not, 6th standard I meant. So ultimately what that is the scalable model. I just want to explain what is startup. So if your friends say I'm doing startup, what startup? Right? Having one shop, Xerox shop, I have a startup. That is not a startup. It should be a scalable business model. Yes, I respect you. You're having a business. Tell it's a business. It's not a startup. So that's the important thing. Main object is innovation and scalable business model. It should have great employment generation or wealth creation. Somewhere along the line, Baiju lost the plot. That's a different story. Because this guy also exited the investment. Then he went on some other tangent only, lost the plot. Today, IBC, insolvency, bankruptcy. That's a different story. But anyway, this is the beginning. And one of the, what do you say, unicorn was, the first unicorn was Baiju's. So at least for that, we should obviously say that, okay, they did something that time. That was, before all the startup thing came now, that was the thing. So that is the concept of startup. So makes sense. Now, if you don't fulfill all these conditions, no, what did they say? Penalty of how much? 200% at 270 capital A. You have to pay. So you have to follow all these conditions. That is what it is. That's about it, guys. So some stuff is left. We'll coolly do it tomorrow. And then we'll start off with either assessment of other entities, or we'll start off with assessment procedure, whatever it is. We'll start off with that. Thank you so much. All right, buddies, good morning. So let's begin. Yesterday, we'll just pick up the pace a little bit today so that we can finish this part and also the assessment procedure. Assessment procedure, wherever needed, I'll have to go slow, because there if I go fast, then gone. So we will see. But other areas we can go a little fast, no problem. Assessment procedure a little heavy, so that's the reason why. No wonder, no problem. So let's finish off the income from other sources. So yesterday we were discussing the concept of deemed dividend. Started off with 222A. Just 2 minutes, we'll quickly revise. So dividend means the sum which is generally paid. So 222A was what? Distribution of assets of the company. To the extent of what? To the extent of accumulated profits. So if my accumulated profits is 5 lakh and I am distributing the 5 lakh worth of assets in another way, not as dividend, then that will be taxed. Though we discussed the concept where generally it should be taxed for the company, but then eventually we saw ultimately it's the recipient. So because the recipients only used to have a problem to get dividend now, because dividend is now taxable in the hands of the recipient anyway. So even deemed dividend will be taxable in the hands of the recipient the day you get the distribution. And it is only to the extent of the FMV of the assets which are distributed. And if anything more is distributed, then we had seen it will come under 56 to 10. So both ultimately will be taxed for the full amount actually. Then we saw distribution, which is not entailing the release of assets of the company, but instead of that they will give you debentures, debenture stock, deposit certificate, and generally preference shareholders are getting bonus shares, which ideally will never be getting anywhere. So in this case also same, to the extent of accumulated profits, you will be getting the deemed dividend. Then on liquidation, whatever you do, liquidation we saw two things, 46(1) and 46(2), and 46(1) clearly says that it is not taxable in the hands of the company, but in the hands of the shareholders there are two things. Instead of 56(2)(10), we have 46(2). Basically that is what it is. Ultimately same provisions, but the thing is section number is varying, that's it. Then 222D is reduction of share capital. So any internal reconstruction, any extra benefit given to the shareholder also is taxable. So ultimately everything is taxable. Now we come to 222E. Loan or advance. This is the most famous one and very, off the lot. This is what everyone reads and everyone studies, and questions also definitely will come in these areas. Any payment to the extent of accumulated profits by a closely held company. So this is what, if in the Companies Act, if I give loan to directors, is it allowed or not allowed, especially to a public company in which general public is not involved, that is unlisted public company, or for a private company for that matter. Company giving loans to directors, sometimes it is prohibited, sometimes it is allowed, that is company law. This is reverse case, guys. This is loan given by whom? You see, any payment to the extent of accumulated profits by a closely held company. So it is given by an unlisted company or private company to whom? In the nature of loan or advance to a shareholder, correct? And loan or advance to any concern, member or partner holding substantial rights, and to the individual benefit of any such shareholder, will be deemed to be dividend in the hands of the shareholders. So loans to directors, under Companies Act, it is not allowed, prohibited, but in some cases it's allowed. So in those cases which are allowed, and if you happen to be a shareholder, then one more section will come, that is 222E, right? So that is the thing here. So what is this basically? See, public company, why is only unlisted company covered here, by the way? Because listed companies have regulations. They are governed by SEBI, they are governed by many strict regulations. So listed company you cannot play around anyway, and moreover Companies Act is also very strict for all public companies in which the shares are held by the general public. It's very, very clear and strict there. You cannot give any loan to directors. But on the other hand, if you are giving loan to shareholders, it should be as per the norms, etc. But here they are trying to tell that any loan or advance. So guys, what's the difference between loan or advance? Is it the same? Advancing a loan, is it the same as giving an advance? No. Advancing a loan is actually giving a loan. But an advance is what? For the supply of services or goods. Whereas loan is basically monetary benefit given. So advance, you have to see whether it's used as a noun or a verb. In this case, it doesn't say advanced a loan. It says what? Advance. So that is the thing. Who holds the beneficial ownership of equity shares carrying not less than 10% of the voting power. Anyway, so if you see here, public who are substantially, in which substantial interest is held by these people. So basically it has everything in this concern here. If you check, loan or advance to a shareholder who holds beneficial ownership of equity shares carrying not less than 10% of the voting power. So basically who holds the interest here, guys? Shareholder. Shareholder having how much? 10% voting power. If loan is given to him, any payment made to such shareholder, it will be deemed to be dividend in his hands, right? The thing is, you cannot give any money, any loan, any advance, not possible. And here they are talking about a shareholder, because again, instead of giving dividend, they were giving it as a loan. Very easy, I'll give a loan, then I'll write it off. So if I give a loan and write it off, for me, I'll debit it to my P&L account and close the books. And for you, you will take it as a loan, capital receipt not taxable, and later you will also, forget about it. That's it. There ends the matter. So that's why they are telling, by the time you are giving only, I will consider it to be deemed dividend in your hand, so that you will not take only at the end of the day. Yes, or loan or to any concern. Concern means HUF, firm, AOP, BOI, company. Concern can mean anything. In which such shareholder is a member or a partner holding substantial interest, 20% or more beneficial interest at any time during the previous year. Then, payment made to any person on behalf of or for the individual benefit of any shareholder. Right? So, basically, individual benefit of any such shareholder. Basically, they are making a payment solely. Ideally, if you make any payment, it should be for the benefit of all shareholders. Now, you will just single out one shareholder and give him the money. That also is taken into consideration. Everything is deemed to be dividend. See examples. Mr. A and B are shareholders of AB Limited holding equal share. Reserves and surplus is rupees 12 lakh. AB Limited gives loan of 11 lakh to Mr. A. This shall be taxable as deemed dividend in the hands of Mr. A. Why? Because I am giving loan to the extent of 11 lakh. If I give loan to the extent of 13 lakh, then only to the extent of what? So, is it only to the extent of accumulated profits? Accumulated profits. Mr. C and D are shareholders of CD holding equal share, 50-50%. Reserves and surplus 12 lakh. AB Limited gives loan to 17 lakh to Mr. C. In this case, 12 lakh rupees shall be taxable as deemed dividend in the hands of Mr. C to the extent of accumulated profits. Right. Next. Mr. M and Mr. N are shareholders of MN Limited holding equal share. Reserves and surplus of 12 lakhs. MN Limited gives a loan of 8 lakh to Mr. M on 14/7/21 and a loan of 6 lakh to Mr. N on 26/11/21. In this case, 8 lakhs shall be taxable as deemed dividend in the hands of Mr. M and 4 lakhs, the remaining amount. Why remaining amount, guys? 8 plus 16 will be 8 plus 6 will be 14. I can't charge 14. So, first is 8, remaining is what? 12 minus 8, only to the extent of accumulated profit. 4 lakh will be taxed in the hands of the other guy. In the above example, if loan was given on the same date, the previous example, first in, first out. Next example, both on the same date. How much loan was given? 8 lakh. What is the overall, what was the loan given? 12 lakh. 12 lakh overall loan, 8 plus 4. But the thing is, what is the accumulated profit? And it was given as 8 and 6. 8 and 6. And what is the accumulated profit? 12 lakhs. Reserves and surplus is 12 lakhs. Loan given was 14 lakhs, sorry. 8 plus 6 is 14. So, I should do proportionate. 8 by 14 into 12 lakhs, 6 by 14 into 12 lakhs. Because it was given to him on the same day. That is the logic. That we will discuss that. Is there anything that will repay? See, even in Companies Act, no, when you are giving a loan, by mistake also if you give and next day you repay, there is absolutely no, remedy for that. So, here we will see. Is there anything that shows that you have to repay? No. The moment you give, gone. Same. Next, Mr. M is a 15% shareholder. What is the substantial holding they are telling? 10%. So, 15% shareholder in M Limited. M Limited has given a loan of 1 lakh to firm LM in which M was a partner. 1 lakh is chargeable as deemed dividend in the hands of the firm. So, Mr. X, because it is given to the firm, right? That is why. Mr. K is a 15% shareholder in K Limited. K Limited has given a loan of 1 lakh to Mr. K. Mr. K has, see here, your doubt, returned the entire loan with interest at 7%, which is above the market rate also in 1 week. I don't care. Entire 1 lakh is taxable in the hands of Mr. K as deemed dividend. So, full thing will be taxed, guys. No mercy, absolutely no mercy. So, diagrammatic representation, any closely held company, Xerxes Private Limited. Mr. Kilol is a shareholder and Kilol owes payment, carrying 10% voting rights here. So, basically this Kilol is holding 10% voting rights. So, in case the Xerxes Private Limited pays to Kilol, then it is taxable in his hand. On the other hand, Kilol owes payment to Mr. Zatura and the closely held company pays here also, then also is the same. Then any other concern, Zavi and Sons, in which Mr. Kilol holds substantial interest and closely held company pays it to another concern, Zavi and Sons, then also deemed dividend. Everywhere it's the same. So it was made to cover everyone. What people were doing was, for example, it should be what, guys, on the date of the loan or what? When should I take this account into consideration? When should I take this account into consideration? This, what do you say, 10% share. When should I take it into consideration? Is it on the date of giving the loan? Like what used to happen was, I held 99%, 100% shares in the company, right? That if I wanted to take a loan, I would transfer 91% to my relative. I can gift it, no problem, 91%. And then again, after taking the loan, the next day, I used to take back that 99%. It used to happen. So they have plugged all the loopholes because everything they have included in this now because of the wordings of the section. Similarly, of course, reserves and surplus was nil, or rather they made reserves and surplus nil by transferring the entire, what do you say, reserves and surplus to equity share capital via bonus. Does the dialogue here say whether capitalized or not in this case? Interesting to note. Does it say capitalized or not? No. So can you do that scam here? Yes. Are you understanding? I can do that scam here. Why? Accumulated profits, whether capitalized or not, is missing. So in case I don't want to go through 222E, is it possible for me to transfer reserves and surplus as bonus? I can issue bonus shares. Yesterday only we saw for bonus shares, is there any tax liability? Nothing. Bonus share can be issued, we have seen, no problem. Bonus shares to equity shareholders allowed. Bonus shares to preference shareholder, deemed dividend. So yes, that is one of the problems here. So let us see. Loans and advance provided in the ordinary course of business of lending, no problem, guys. It's absolutely no problem. It is a Bombay High Court judgment. Lending, so basically in ordinary course of lending, it's okay. But substantial power, if I have, there's more than 10%, in other case more than 20%, then I need to see, I need to understand what do you mean by ordinary course of business? The substantial part of the business must be giving loans. Then it's fine. In order to determine 20% of the voting rights, interest held by shareholder in such firm, AOP, company, etc. only is relevant. So I cannot see anything else, only my shareholding I need to see, indirect interest. In order to determine 10% of the voting rights, interest owned by the SSE alone has to be considered, not all other put together. Yes, as we have discussed here, that is a scam, where a closely held company does not possess accumulated profits, or they have planned it in a way that they have converted it into bonus shares and then given. Then 222E shall not apply. 222E shall not apply. Accumulated profit for the purpose of 222E does not include capitalized profits. Even if the loan is repaid, still the loan is treated as deemed dividend in the hands of the person. Yeah. So now, she asked one question before the thing. Will there be any set off concept? So the thing is, it is not allowed, but lot of issues went to court saying that you will pay me 1 crore, and the thing is, you have already paid me 50 lakhs. So instead of paying 1 crore, just pay me the remaining 50 lakhs. Because ultimately dividend, deemed dividend are the same. So as per the law, it was not at all allowed. Because in law, that is different, that section is different, this section is different, right? But see point number 7, set off of deemed dividend. If loan given by the company is treated as deemed dividend under section 222A, which is set off against actual dividend paid by the company, then such set off shall not be again treated as dividend. Example, A Private Limited lends advance of 1 crore to Mr. A who holds 20% voting power. This shall be deemed as dividend 222E. Subsequently, A Limited declares dividend of 80 lakhs and sets off the same amount against the loan balance of 1 crore. Will the dividend be set off or your loan is getting set off? What do you think? I lent you a loan of 1 crore which is already taxed in your hands. Now I am again supposed to pay what? 80 lakhs to you. And that 80 lakhs, because I have already lent you 1 crore, I have to recover that money, no? So I am recovering that money by paying this 80 lakhs. So now the loan of 1 crore, I am setting it off against 80 lakhs. So ultimately 20 lakhs is still outstanding. So in this situation, 80 lakhs shall neither be considered as dividend in the hands of the shareholder nor in the hands of the company, as the amount of dividend has been set off against the loan balance. Right? Yes. So this is only if you set off. So there is no provision in the income tax law, handling all these things. But there was decided cases because of which later they inserted a proviso only saying that automatic set off not allowed. Only if the company sets off. For example, I have given you 1 CR. You have already taxed 1 CR. Now I need to recover this money somehow. Otherwise, auditors will raise queries. How will I recover this money? Next time when I am paying dividend, I will recover this money. If I do that, then fine, you can recover. But if I pay you 80 lakhs already, can you set off? 1 crore I have already received. That was her doubt. She asked that 1 crore I already received. Next time when I receive dividend, can I set this off against that? Saying that I have already paid in that 1 crore. So is that still possible? No. What is possible is when you pay me 1 crore, company pays 1 crore. Later, company also has to pay you 70-80 lakhs. Then they will look, that 1 crore anyway I have to give back. This is actually a company law provision. So 1 crore anyway I have to give back. So can I set off? I have to get back 1 crore anyway. Payable from my side is 80 lakh. Receivable is 1 crore. Can I set it off? Yes. So in company law, this is allowed. But if I pay you 1 crore, it will be taxed in your hands. If I pay you 80 lakhs, can you set it off? Telling that I received 1 crore, now 80 lakhs? No. Set off from shareholder side, not possible. So please understand that. But set off from company side possible. Company side possible as per Companies Act only. It is possible. Dividend you can easily set off against whatever is, provided you should take permission from the shareholder. All that rules are there, but you can do it. Right. So, yeah, tell me. Yes, correct. So first I have given you 80. Then I have to, loan I have given you 80. Then later dividend is 1 crore. So I can set off that loan given already 80 lakhs. Remaining 20 I will pay you. Simple. So from the shareholders point of view, no setting off. I have already paid this extra. First of all, you are not supposed to get dividend. On behalf of, in lieu of dividend, I have given you 1 crore. Now again 80 lakhs extra you are getting, pay tax on everything. On the other hand, if the company only feels, no boss, I have to receive anyway, so I will set it off and give. So it's better for the shareholder also this way. So he doesn't have to pay tax again. Otherwise 1 crore on 1 crore tax, on 80 lakhs tax, then he has to repay the loan also. So better if the company sets off, actually speaking. Right. In case of amalgamation, the accumulated profits including the loss, whether capitalized or not, shall be increased by the accumulated profits, whether capitalized or not, of the amalgamating company on the date of amalgamation. So yes, so when I say accumulated profits, I should add both and then take total 65 lakhs. Only that for amalgamated company, what would be the capitalized profits? Obviously, both the profits to be taken into account. So what do you mean by accumulated profit? For a concern means generally HUF, firm, AOP, BOI, company. Accumulated profit means what? Accumulated profits includes the credit balance of the statement of P&L account, general reserve, investment allowance, capital profit, profits up to the date of distribution, liquidation, everything. Provisions and reserves meant for specific liability, provision for taxation, all those things must be excluded. That is normal accumulated profits, everything. That is your P&L credit balance, general reserve, investment allowance, capital profit, even capital profit is there. Capital profit means what? Profit on sale of asset. That also I need to take. This capital profit is, revaluation reserve is not taken, but capital profit is taken. Generally tell me, is capital profit used to pay dividend in normal loss? Can you take capital profit to pay dividend as such? No. Dividend should only be paid by free reserves. So here on the other hand, in computing the deemed dividend, I will take everything, including the capital profit. Here if you see investment allowance, capital profit, profit up to date of distribution. What about share premium account? Is share premium account profit? No, it is a quasi capital. So share premium account is a quasi capital. So in the exam, if they ask you, if they have given you the figures, P&L credit balance, reserves and surplus, share premium account, to the extent of accumulated profit, should I take share premium account? No. So first one, because it's a quasi capital. Quasi means something like a capital. So building and machinery depreciation fund are not forming part of accumulated profits. So again, her doubt, point number 3. Dividend is not set off, but it is paid to the shareholder independently, leaving the loan balance outstanding. Can you take benefit of set off? Not, no scene. You'll have to pay tax on 1 crore also, on 80 lakhs also. So if you just give a trade advance, it says loan or advance. It is not a trade advance. So loan or advance, again advance is what? Advance for the supply of goods is general thing. But here this advance should be taken as in the nature of loan only. So if you give it in the nature of trade advance, where actually that other person has to supply goods, then not possible. So advancing a loan is giving a loan. Loan or advance. Advance generally means trade advance. Generally it means trade advance. But here when I say loan or advance, this advance also will be in the nature of loan. Trade advances, of course I have to give a trade advance, because only then you will give me the service or goods. Then see this, all the Supreme Court judgment. Alagasundaram Chettiar. The company advanced a large sum of money as a loan to a low paid employee, who in turn advanced it as a loan to managing director. Loan to managing director given by the employee shall be treated as deemed dividend, because it is directly or indirectly paid. So company gave it to low level employee. Low level employee gave it to the MD. Ultimately it's like company giving to the MD. So it was treated as, in 2001 case law, Supreme Court judgment, treated as deemed dividend. What about this, guys? I give you loan, you repay. Again I'll give you. Is it double time? Double taxation? I give you 1 crore. You already tax it. Immediately you will repay. Then whatever I receive, no, again I repay. Again I pay you, sorry. Is it taxed twice? That was one more doubt raised. Okay, dividend and loan separately taxed. What about this? I have given you a loan. Then you have already paid tax on it. Then again I am giving. So you see this one. When a loan is deemed to be dividend, the same amount when repaid and relent cannot again attract 222E. Subsequently, for further transaction, accumulated profit should be notionally reduced by the amount of all the loans which were earlier deemed as dividend. So this was G. Narasimhan, again an interesting case law. So initially there was accumulated profit 10 crore. I gave a loan of 5 crore, got repaid. Then again I am lending 1 crore. So when I am computing the accumulated profit, should I take 10 crore or 10 minus 5, 5 crore? 10 minus 5, 5 crore. That's what they are trying to tell. Yes. So these are all the various points. So very simple, guys. If it's a closely held company, if it is into Business of lending. Business of lending. Market rate. If I give it at a market rate, then it is not dividend as per CBDT. But if I give it at other rates, then 222E will come. Other rates means other than the market rate. Market rate is 10%. If I give 10, 12, 13, 14, no problem. If I give it at 6%, then deemed dividend. Normal. Trade advances, not dividend, CBDT circular already discussed. Other cases, 222E. This is the gist of the story. So, you need to see in the exam what they are asking. Online people, are you there? Good morning. Right. Yes. Huh? No, because that is anyway a benefit given to you which you are not supposed to get. Anyway, in company law, you will be, you are not allowed to do that. That will be a violation of Companies Act. Here, whatever interest you charge, that's it. Did we see anywhere in 36 that interest should be market rate, etc.? No. But the entire transaction is void under Companies Act, if you are a company, that is. Which one? Of course. Rate has got nothing to do with anything. Only for business of lending they are telling. If you are in the business of lending, if you give it at market rate, no problem. If you give it at other rate, less than the market rate, then it's an issue. But normal companies not in the business of lending, I don't care about interest. You give interest free also, I don't care. Company law violation will be there, but not income tax law. Income tax doesn't care about if you charge less interest, ultimately the other person also anyway will be taxed for the entire loan amount, right? So, Nirmala madam doesn't care about you are getting high interest, low interest, I don't care, right? So, if you are charging exorbitant interest, there is one act called Usurious Loans Act. Imagine, there is one separate act called Usurious Loans Act. Usurious means something which is exorbitant. It's a 1925 law, originated in Tamil Nadu, because in Tamil Nadu people were giving, these money lenders were giving loan at higher rates, like crazy rates, 3% per day and all they were giving, correct, which means almost 400%, 300, 400% per annum. That's why this law came, Usurious Loans Act, right? So, I was teaching it in paper 6D, which was there earlier. So, one of the students from Tamil Nadu only, she's now into law, she's a lawyer, Abhinaya. She actually did one full research on Usurious Loans Act, the history and all those things. I still remember that. So, yes, as part of her project or something. Yeah. So, yes, definitely it's there, Usurious Loans Act. So, all those acts will get attracted. Company law, company law also will get attracted. Income tax law, no one cares. That's why they say business of lending only other than market rate, problem. Business, if you are not into lending, any amount you give, interest free you give, I don't care for income tax purposes, right? Now this is done. Yeah, of course. That's why it's deemed dividend, no? It's not actual dividend. Deemed to be dividend and taxed in the hands of the shareholder. So, any repayment you are getting, that will not change. This is only in the hands for tax calculation purposes only. So, when I am getting money, Nirmala madam will stand here also, there also. So, your interest you are getting here, you pay tax. No mercy. So, guys, tax, now tell me, dividend, you remember first we did, one dividend we did, taxation when calculating the surcharge. Dividend 111A, 112A, 112. Surge, maximum surcharge is how much? First class, 15%. Maximum surcharge can be 15%, that's all. So, as far as taxation of dividend is concerned, if I have to understand the taxation of dividend, dividend will be declared, dividend can be distributed or paid. If it is distributed or paid in any other form, 222 ABCD, if dividend is declared, when will you tax it? Final dividend, previous year in which the dividend is declared, you will tax it then. Interim dividend, previous year in which it is actually paid. And once you declare dividend as per company law, within how many days should you pay it? Sir, company law out of syllabus. Yeah. The inter we have studied, no? Deemed to have studied. Yeah. What do you think? How many days? 30 days. 30 days. So the moment you have declared, then you need to pay within 30 days. So that is mandatory. Otherwise, there is a lot of interest, etc. for the company. Lot of penalty in the Companies Act. So basically, guys, previous year in which it is declared. So when will you declare dividend, by the way? AGM. So AGM will generally happen in September. So for example, for the year 23-24, AGM will happen in 30 September 24, which means the dividend will be taxed in 23-24 or 24-25. 24-25, because in which it is declared. On the other hand, interim dividend is paid in between two AGMs. So interim dividend is directly declared and paid then and there. So that whenever you receive, you can claim that. Dividend, one more thing, interim dividend could be of any other year, I don't care. But it is taxable in which year? Not for the year which it received. It is taxable in the year in which it is received. Because as per company law, even on 10th April 2024, I can declare the dividend for 23-24. I am talking about interim dividend. So on 5th May 2024, I can declare the interim dividend for 23-24. But that doesn't mean my taxability will change. Taxability will be as per the previous year I receive it. So if I receive it in 24-25, it will be for 24-25. Yeah. Yes, that's why. So that's why I've written this. Final dividend, date of declaration. This is given in the law only. So your 56 clearly says final dividend whenever it is declared. Because once you declare, you have to pay. For sure. The only reason where you will not pay, where you will withdraw, would be tsunami happens, earthquake happens. So very extremely rare cases. Force majeure, extremely rare. It is never happening. In India, it has never happened. Right? But interim dividend is only when you pay it, because declaration payment happens on the same day by the board anyway. But I'm just saying, when you receive it, basically, when you receive it. What final dividend? When you declare. So even if I declare interim dividend in March, as he said, I pay sometime in April end, it should be taxed the next year. That is whatever next year. Right. So I'm just giving the full chart of the dividend. Next, dividend will be taxed in which head? IFOS, obviously. Income from other sources. So if I am holding the shares as a capital asset, then IFOS. If I am holding the shares as stock in trade, then what do you think? So there is a case law, Western States Trading Company Limited. Which says taxable as IFOS. Set off carry forward allowed under PGBP. Right? So it is taxable as IFOS, set off carry forward if any loss, that is allowed under PGBP. Very interesting. My shares are held as stock in trade. Dividend that I receive is not taxable as PGBP. It is still IFOS. But while doing the business of trading shares, there will be a loss, etc. That will be set off and carry forward as PGBP. That is obvious. When I am doing business, I will have to pay salary, all that to my staff. Then I don't get that much money this year. Correct? Dividend is not your income. What is your income in share trading? Profit, buying, selling. In capital gain is replaced by PGBP, not dividend. So it's a very interesting observation, interesting case. Right? Anything, all small adjustments. See, in a regular batch, we'll open the bare act, we'll analyze, we'll digest, we'll absorb everything. But in a fast track batch, you should only know what is required for the exam. As much as possible, I'll giving you the logic, but we are not here to understand the logic of everything, what Arun Jaitley told, who cares? right? Ultimately, I have to pass the exam. So that's the logic. The mindset only shifts in fast track batch, right? So Western States Trading Company, taxable as IFOS, set off and carry forward, PGBP. That's how it is. So I've seen the trend now that people just want to clear the exam. But I want to insert these things here because I want people to also understand little bit of logic whenever needed. Otherwise, just passing the exam, dangerous situation. After you clear, horrible it will be, right? But in regular, no mercy. We'll go through the grind, entire Bare Act analysis. Because if as CS, if you don't know how to read the Bare Act, it is a shameful situation. Because you need to, I'm not saying that you should know how to read the law, that's all. Any book you give, you should be able to read. That is how actually it should be, otherwise it's a problem. Taxable as IFOS, set off and carry forward, PGBP. So it's interesting. Next, proviso to section 57 talks about the expenses, guys. So it is based on accrual, and how much we will discuss that. How much expenses can you claim? Can you claim everything? If I have taken a loan to buy shares, can I set off the interest expense against the dividend? Yes, 20%. Up to 20% of dividend only I can do. Earlier they used to allow full. So what I used to do, take loan left, right, center, interest only was huge. Interest I used to set off fully against dividend received. Now they are telling only to the extent of 20% of dividend, which means 80% anyway you have to pay. So, but can I take a loan to buy shares? Of course I can. Interest portion is also allowed to be set off to the extent of 20% of the dividend amount. Then we have deduction under ATM, which we will discuss. A chapter 6 deduction for dividend ATM. Non-resident taxation 115A and 195. Little bit we will discuss, not now, but yeah, we will definitely touch upon international taxation, no worry. Like residential status and the active business outside India, then the place of effective management. These are all very important concepts. I will definitely do it, right? And then I'm doing it now only, in the sense during the course of the classes we will touch upon it for sure. So 115A non-resident taxation, and 195 also it comes. We have to deduct TDS there. Then 194 is the TDS for payment of, when they are paying you dividend, 194 comes. So that we will see in TDS chapter. 195 is non-resident taxation. Charging section of non-resident taxation for dividend is 115A. TDS section is 195. Here the chargeability is under 56 for residents and TDS is 194, right? So TDS, there are some 7-8 sections which rates have changed in Finance Act 24. So we need to do those sections because the last time ever those rates can come, the old rates will be November 24 exam. So she has changed some 5-6 sections completely. Rates have changed, but which means old rates will come in the November 24 exam, whatever existing rates are there. Yeah, we will see that. We'll see that. I'll discuss here. Come to this notes here. That only we'll discuss right now. Chargeable to tax, deemed dividend, final dividend, declared, interim dividend, received, already discussed. Dividend does not include ordinary course of business, money lending, substantial part, all that we have seen. Any distribution made in accordance with 222C and 222D to preference shareholders, already discussed. Set off against a loan, discussed. Buyback and demerger, it will not apply. So if you come to the intercorporate dividend, I'll come to that expense part because other expense also we have to see. Will 57, can it be claimed? IFOS is a section where all other things are covered. Will I get expenses for that? That is what we need to check in 56, 57 later. That's why I will finish everything and then stick to that. ATM, where the gross total income of a domestic company includes dividend from another domestic company, foreign company, business trust. So Infosys has invested in one foreign company 2, business trust, mutual fund units, other domestic company, and they are getting dividends. Everyone is giving dividends. Like Infosys has invested 30% in foreign company 1, and it has invested 20% in foreign company 2 and in business trust, and it has invested in mutual fund units and other companies. So if you see, it is only another company, foreign company, business trust. Deduction of an amount equal to dividend distributed by the domestic company on or before the due date, that is 1 month prior to the due date of filing the furnishing return, shall be allowed from the gross total income. Example we'll see. Deduction is available only to domestic company. Deduction shall be allowed only if the dividends are distributed and not just declared. Deduction under ATM shall not exceed gross total income. Deduction under ATM shall be allowed for the dividend income taxable under section 115 BBD also. That's another taxation norm. Dividend under 222A to E is also considered for taking benefit under ATM. I will see an example, you will understand. So, domestic company Chulbul Limited received dividends of 50 lakhs from another domestic company, Bulbul Limited, for the year 31/3/23. So, Chulbul Limited had incurred interest expense of 13 lakhs towards borrowed funds for the purpose of investing in shares of Bulbul Limited. Chulbul Limited declares and distributes a dividend of 45 lakhs to its shareholders on or before 30/9/23. So, dividend income, how much I am getting? 50 lakh. First expenses I have to reduce, how much? 10 lakh. 20% of dividend income. Actual taxable gross total income is how much? 40 lakhs. What is the deduction I will get? I distributed how much? I got how much, guys? 45 lakhs. 45 lakhs I got, no? But can I take the full 45 lakhs? No. How much? To the extent of gross total income. To the extent of gross total income. One interesting thing is what? In this case, no, dividend shall be allowed only if the dividends are distributed and not just declared. Correct? When I am doing the dividend concept, it should just be declared. And for the shareholder, basically, when is it taxed? It should be just declared. But if I want to take a deduction under ATM, what should happen? It should not just be declared, it should be paid also. Otherwise, not possible. So, dividend should not just be declared, it should be paid as well. When should it be paid, guys? 1 month before the due date of furnishing the return. For a company, when is the due date of furnishing return? For company, October. 1 month before means 30th September. When is the last date of holding AGM? 30th September. So, if the AGM is held on 30th September and they declare dividend, can you claim ATM deduction? No. Why? It should be declared as well as paid. That's why if you see, all these companies never hold AGM in September end. They will hold in the beginning only. They will hold it off sometime in August, June, July only, because they don't want it to drag it till here. So, September 30th as per company law, you can hold AGM, but you cannot claim ATM deduction because it should be declared and paid, same thing. Sorry, no. Because you mean to say what? It's clear, no? 1 month prior to the due date of filing the return shall be allowed. Otherwise, no. You should declare when? On or before. Distributed, it should happen 1 month before. If it happens afterwards, can you claim? No. me see. All this is fine. Yeah, that is regarding this. Then I'll come to the expense portion now. Then we will come back to these things quickly. So we finish all these things. Last part, the deductions. In respect of certain incomes, specific deductions have been provided. For example, dividend. How much? 20%. In respect of those incomes for which there are no specific deduction, an assessee may claim an expenditure which is not a capital expenditure and incurred exclusively for the purpose of earning such income. Case of dividends or interest on securities, deduction on account of interest expense allowed subject to a maximum of 20% of the dividend income before such deduction. No expense except this shall be allowed. For two things, only 20% is taken. If you have taken a loan, no, 20%. One is dividend, one more is interest on security. What is interest on security? I will take a loan and invest in the securities, and securities I will get money, interest like debentures, etc. I am not talking about capital gain, talking about debenture interest. If I sell it, it will be capital gain. Talking about interest that I receive. So what people used to do, since this 20% rule was not there, they used to hire simply an accountant to maintain those accounts and pay him exorbitant salary on paper and then claim full as expenses. All other things it is allowed, you see, incurred exclusively for the purpose of earning such income. So say I am appointing an accountant exclusively to handle this income. So basically he was not paying any money on any income that is earned through debentures and other securities. So to stop that from happening, for dividend and interest on securities, what is the maximum? 20%. That to 20% if you have taken a loan, other expenses not allowed. Which means if I hire an employee to handle all my investments, disallowed. That salary will be disallowed. So that is a important change which came 2-3 years ago. That's why it's important. Other things it's allowed. Only two things. Dividend income and interest on security, 20%. So you see this case, Rampur Timber and Turnary Limited, 1981, this was overturned. Here that's what, no, expenses as salary, admin expenses, staff, office maintenance, everything was claimed. They allowed also. Then they changed the law, 20%. Amounts which are not allowed, personal expense, interest and salary payable outside India, income tax, wealth tax paid or payable, expenses in the nature of 40A1A, what is that? TDS to residents, 30% disallowance. 40 capital A is what? 10,000 or 35,000 as the case may be. 10,000 normal, 35,000 flying, that is your goods transport agency, flying of goods. Any expenditure relating to any casual income, winning from lottery, crossword puzzle, all this not at all covered. There is one amendment in business trust which we will discuss in business trust itself. Finance Act 23. Some other quick stuff and we'll close this chapter. Winnings from lotteries, 115 BB, winning from lottery. So, is lottery legal or illegal? Depends on that. Kerala, it is one of the largest sources of income for the government. So if you go to any place in Kerala, every third or fourth shop will be a lottery shop. It's very interesting. So where the total income of the SSC includes any income by way of winnings from lottery, crossword puzzle, race including horse race, card game and other game of any sort, gambling or betting or any form or nature. Race including horse race. Does it include any other race? Yes. Does it include chicken race, rat race? Rat race you are all living, sir. Yeah, but other actual rat race, they actually do that in various places. Is it allowed? Yes, everything is covered, guys. Even what about bike race? Everything, where you are betting on it, who will win, all those things I am saying. Yes, everything is covered. Lottery, crossword puzzle, etc. will be chargeable to tax under the head other sources. Such income should be levy of flat rate of 30% plus applicable surcharge and cess. Taxability of winnings from lottery, etc. are subject to the following. No expenditure or allowance can be allowed under this income. Nothing. Any expenses to buy the lottery ticket or anything for that matter, nothing. No deduction under chapter 6A. No carry forward set off. You cannot set off winnings from lottery against some other loss or unabsorbed depreciation against this, nothing. Even basic exemption limit is removed. And income is paid after deducting, tax grossing of principal is applied. So it's basically grossing of principal means what? They'll pay you after tax, so they will gross up the amount and they will give you. If they say your after all expense is 1 lakh, they will gross up the tax portion and they'll give you. Now, for winnings from any online game, Finance Act 23, when I say 1424, it is from Finance Act 23, which is 1423 to onwards, 1423 onwards. So, a separate section is introduced, 115 BBJ, which we will see in TDS. Understand what is this winnings from online games. You have online rummy, poker and your Dream 11. So, to curb, not to curb, rather you do whatever you want, but I need to charge to tax that also. So, that is a separate section. In TDS section we will see. These are all amendments in Finance Act 23. Horse race, all these things. Wagering. Now, one question they asked in the exam, that agent sold all the lottery tickets, some 5 tickets he was left with. Lottery was announced. In that unused tickets, this fellow won. Agent, he won 10 crore. What do you think? He is redeemed, of course he redeemed it. But that is out of stock that he had. Taxed under IFOS or PGBP. So this in tax now there is one thing. There are 4 steps. Step number 1, take a deep breath in. Step number 2, breath out. Step number 3 is from the pit of your stomach. That's called a gut feeling. Answer will come out. Correct? It's like you feel that this is the correct answer. Step number 4, reverse the gut feel. That will be the answer. So if you see, your gut feeling said what? Yes, but of course you are partly right. I would agree you are partly right. You see, 2 cases are there, guys. You can write anything, no need of writing the case law name and all, but yes. Any winnings from unclaimed or unsold lottery ticket in possession of an agent or trader of lottery shall be in the nature of business and does not constitute any lottery winning. But Kerala High Court said, boss, we are the experts here. You shut up and said that to some Guwahati and all. You don't know anything. Right? Lottery tickets, we are the kings. So Kerala High Court ulta decision. It's correct. So gut feeling is actually right in this. Contrary that any winning from unsold lottery tickets held by distributor as stock in trade shall be considered as winnings from lottery, as the winnings by distributor are not in his capacity as lottery distributor, but as the holder of lottery tickets. So they said that makes sense. So yes, you are right. So you can write any of the case law name not needed. You can just write if they ask you. You can, whatever you write your answer, write the note with the logic. That's all. then it will definitely, you will get the thing. In these cases, whatever answer you write is correct, because that is the stand that you have taken. That's what. If you write the note, then they will not ask. Good question. If you write a note, they will not. If there are any contrary views, right, in the examiner's comment also they would have given. If student has written this, give the answer. If written this, give the answer, because these are contrary views. You can take any view. Like yesterday when we solved a problem where we didn't know whether it was quoted shares, unquoted shares, right? So we took the assumption, right? That's how you should take the assumption. So the examiner doesn't care about the answer actually. He cares about the logic that you have written. That's why I said notes are more important. You need to write those working notes there only. That is actually more important. He will understand how you have arrived at this answer. That is what he wants to know. Not the answer as such. How you arrived at it is what he has to check. Anyway, instead of TDS, now only we'll do, guys. 115 BBJ, tax on winnings from online games. I thought I'll link it with TDS, but it's okay. This is again Finance Act 23, guys, amended section. Not amended, new section. 115 BBJ, brand new section. I think it's not there, but it's okay. I will just tell you here only. Notwithstanding anything contained in any other provisions of this act, the total income of an SC includes any income by winnings from any online game. This is similar to this lottery only, but for online games separately they have given. The amount of income tax calculated on net winnings from such online games during the previous year at the rate of 30%. Net winnings. Because in Dream 11, various matches, some matches you will win, some matches you will lose. So I should take only the net winning, not per game. So entire year, how much you have won net? Because in some games you win the match, you win money. In some games you lose money, right? Amount of income tax with which the SC has been chargeable. Yes, online game means it is offered on the internet and accessible by user through a computer resource, including any telecommunication device, all through apps. Internet means computer resource, fine. So basically, the amount of income tax with which the SC would have been chargeable at its total income been reduced by the net winnings. So what they have to do is very simple. First, amount of income tax should be calculated on net winnings. So every time they will compute the tax, but at the end of the year they will square up everything. And the final balance amount you need to pay. That's all. So net winnings. Every year, every time ka winnings, you will take the tax. In once you will win, once you will lose, whatever it is. So ultimately, you will aggregate everything and you will have to pay tax on that net winnings. This was not there in lottery, because in lottery it can be a one-time affair. But online game can change every minute, every day. So this, so many people have lost so much money. There was an app called Mahadev app also. That was a betting app. Correct? So much money they have lost because of these things. And again, it's blaming. Yesterday I was reading, blame has come on the celebrities also for, play, win, Dream 11, they'll tell all this. No, they'll get money and they'll go. But then these people will see that, okay, my, cricket player who I like is, endorsing this, let me play. So, a lot of money is being lost. One of my friends who's a CA, her brother got addicted. He used to swipe his dad's credit card and almost 26 lakhs he has blown up. Imagine. Slowly, doing it, 26 lakhs. Later, the father came to know. Crazy. Yeah. Correct. Nil. Correct. All that, again, there is, curbing mechanism, all those things. Mahadev app also, same thing happened. That's why they are now tightening the thing. So this was introduced by Nirmala because in 2020, because of COVID, everyone started playing everything online. Ludo, we all lived off Ludo, remember? Yes. So how many times we have played? That's the reason. But anyway, there is no winning as such, or maybe it is there betting, I'm not sure. We played always normally, it's friendly matches. But here, definitely, that is what it is. Online, Ludo, all those things. So that's why she realized the impact, and then though it came late, 23, but yes, because now everybody, makes a lot of money. It's like a side hustle. If you are good enough in analyzing, and it's not just pure luck, by the way. It requires your skill also in all these things. By the way, if it requires your skill, is it still gambling? In a way it is, yes. In that case, by that logic, is Kaun Banega Crorepati gambling? No, that it requires your, of course, your skill there. But in these things, you are betting on a person to score. Like you have high hopes that RCB will win as an RCB fan, right? That is what happens. So you will always get disappointed, right? That is what. Right. Every year we will get excited. Yes. Interest on securities. Yeah. Cup only. Yeah. So interest on securities. At least, the thing, that's why all states, have a team. Kerala, though, they're like, oh, bro, I don't want only. So they exited. So they had one team, no? Kochi Tuskers. Yeah, that they went. They're like, we are happy with lottery, you play. That is only, at least in lottery we will win. RCB will not win. Right? Yes. So interest on security 56.2. This is same thing, guys. All the interest income on bonds, foreign currency, all the same thing. We'll just quickly go. Post office savings is, I don't know, you will remember all these things. But yeah, ultimately, guys, basically, how much money is taken into account here? Is there any expenditure allowed? Same, 20% of that income is allowed. If you have taken a loan, etc., interest on such will not be deductible at any cost. Any other expenditure other than capital expenditure, but exclusively for the purpose of earning interest, can be claimed as a deduction. But then that also was removed, saying that for these two things, that is for interest on securities and dividend income, whatever you earn, whatever loan you take, maximum 20% of that only is allowed. No other expenditure is allowed. So all these things were there. Now, what are 2-3 small points? Income from letting out of machinery, plant or furniture. So if you are not in the business of letting out, but yes, if you let out some machinery, plant, furniture, etc., then if you are doing such business, then it will be PGBP. Otherwise, it would be your IFOS. For example, if this room I have taken it on hire with all the equipment which I need, so then obviously that will be IFOS. If the business is not letting out only. If building is also let out for letting out machinery, etc., and I receive a composite rent, same shall be chargeable under the head other sources. Like I am getting the building and all the equipment along with it. Just this building with chairs will not serve the purpose. Similarly, just a studio setup will not serve the purpose. It should go hand in hand. And if the business is not of lending like this or hiring it out, then obviously it will be income from other sources. That's fine. Family pension, yes, that also whatever you receive, regular monthly payment by employee, former employer, that also will come. If employee receives the pension, guys, it will be charged on their head salaries. But a family pension will be charged here where other people receive, but it is not chargeable to tax for very rightfully so member of the armed forces, family of the member of the armed forces. After they are martyred, when the pension reaches the family, it is not taxed at all. And family pension is exempt to the extent of 1/3 of the family pension or 15,000, whichever is less. So family pension received was 75,000. This is not for army people, others. So family pension received was 75,000. In this case, 1/3 of family pension, 25,000 or 15,000, whichever is less. So 15,000 is exempt. Interest on enhanced compensation already discussed. How much? 50% standard deduction. Correct? 50% standard deduction. Forfeiture of advance received already discussed in capital gain. Advance received, forfeiture after 1/4/2014, right? All those things. Business trust will be covered in business trust chapter. Taxability of insurance policies already discussed in capital gain. That's about it. So that is the end of this chapter. Alright guys, appeals and revision. Again, we'll do the important areas in this. So what is the procedure? Very simple. If you are going through an appeal under section 250, that is if you want to appeal against the order of the, or rather appeal towards Commissioner of Income Tax Appeals, what is the procedure? To file an appeal with the Commissioner of Income Tax Appeals. Procedure is in section 249. Income Tax Appellate Tribunal under 254, if you want to prefer an appeal, procedure is given in 253. High Court is given in 260A, and what do you say, 262 for Supreme Court, it is in 261. Let's see. The assessing officer, when he passes an order, assessee within 30 days can go to Commissioner of Income Tax Appeals. And whenever the Commissioner of Income Tax Appeals passes an order, then I can go to what? The assessee, or the assessee also can go if he doesn't like the order, or department also go if they don't like the order. Within how many days? 60 days. ITAT order has been passed, assessee doesn't like the order, department doesn't like the order, they can go to High Court in 120 days. And High Court basically will go to the Supreme Court as per Supreme Court rules. Same, assessee or department can go Supreme Court. So ultimately, that is what it is. For example, one interesting example is A, B, C, D, all four are there. All four expenses are disallowed by assessing officer. Commissioner of Income Tax Appeals allows A and B, disallows C and D. For the same order, can two appeals go? Yes. Department can go to ITAT for A and B. They can say it has to be disallowed. SSE can go to ITAT for C and D. They can say it has to be allowed. So for the same expense, the beauty is you can go to what? Multiple forums, I mean same forum ITAT but different appeals. That is one from the department, one for the SSE. These are some of the hidden points. Right. So I'll just open the appeals and revision chapter. So take it out. So as I told you, one extra section has been added in Finance Act 23, that is Joint Commissioner of Income Tax Appeals. So that you can just add on there. That one more it's not there. You can just add saying that JCIT appeals, Joint Commissioner of Income Tax Appeals, has come now into the picture. Section 246 JCIT. Similar to other sections only, but this JCIT has come into the picture. Anyway, so now one interesting point, Biocon India is taking some research and consulting from a Swiss company, and Biocon India has made payment to that Swiss company. Agreement is 50 lakhs. So I have to pay tax under section 195, TDS I have to deduct. It depends on what type of agreement it is. If Swiss company says I want 50 lakhs net of taxes, then the liability of tax is on whom? Biocon or Swiss company? Yeah, Biocon. Because I am saying I want net of taxes. I want overall payment 50 lakhs. I don't care about the tax. So liability of tax is on Biocon. Correct? On the other hand, Biocon would pay Swiss after taxes, which means 50 lakh minus 5, 45 lakh. So return of income, who has to file? Biocon has to file return of income, and TDS refund of 5 lakh they have to claim. Because if I am providing services in India, there is no permanent establishment in India, nothing. So it is not deemed to occur as in India, not taxable. But unfortunately, since I have deducted TDS in my name, I need to claim the refund. So the beauty here is here you see. Where under any agreement, tax deductible on any income under section 195 is to be borne by the person by whom the income is payable, and such person having paid to the credit of the CG, claims no tax was required to be deducted, he may appeal to the Commissioner of Income Tax Appeals for a declaration that no tax was deductible on such income. But if the Indian company has to bear the taxes as per the agreement, right? So we'll see. You see the example, you'll understand. So ultimately, what I am trying to tell is, for this one, where I have to pay net of taxes and liability of taxes on Biocon, order under 195 is passed and I can appeal under section 248. On the other hand, if this is the case where Biocon would pay after taxes, if any, and the Swiss company wants to appeal, they can go under 246A. So 248 is by Biocon, 246A is by Swiss company. Read this example, guys. PJC India Private Limited is establishing its online classes branch in USA. For incorporating this branch in USA, it took service of CPA from USA for a professional fee of 25 lakhs. SSE feels that services are rendered in USA and no income is accrued in India, and therefore the fee is not taxable in India. Accordingly, the SSE files an application requesting him to pass an order under 195 that no TDS should be deducted. The AO, however, passes an order that it is taxable. Now, what can the SSE do? It depends. If Indian company has to bear the taxes, then SSE can final appeal under 31(3). By 31(3), if CIT appeal decides in favor of the SSE, refund shall be granted. But if USA CPA firm has to bear the expenses, then I have to prefer an appeal to whom? Again, to the Commissioner of Income Tax Appeals. So, what I am trying to tell is, it depends on who is preferring the appeal and who is paying. So, coming back to this question that I was telling here, if Biocon wants to prefer an appeal, then it is under 248. But if the Swiss company, then it is under 246 capital A. That's all you need to understand. So, the entire procedure goes like this. AO passes the order. It is appealed under Commissioner of Income Tax Appeals. Within 30 days, you have to appeal. After 30 days, can I accept or not accept? Yes, after 30 days, Commissioner of Income Tax Appeals can either accept or they can reject. They can accept when they have sufficient cause of the delay, maybe death or whatever it is. Can SSE appeal the rejection to ITAT? No. When they reject, can they appeal to the ITAT? No. But I can apply to the Commissioner for revision under 264. So, in case you reject the petition, Commissioner of Income Tax rejects the petition, can I appeal the rejection to the Income Tax Appellate Tribunal? No. But I can apply, and one more section is there, 264, where I can do so. This is for what rejection? This is for the delay. After 30 days also, Commissioner of Income Tax Appeals accepts sufficient cause, then okay. If he rejects that there is no sufficient cause, I cannot apply to ITAT for the delay. I am not saying if the case is lost, then you can go to ITAT. I am not talking about that at all. I am talking about the other area. Now, application to Commissioner for entire thing, order under section 264 will have to be passed. Appeal to Commissioner of Income Tax Appeals will be admitted only if, in which case, if return of income is furnished and you have to pay the tax, only then it is admitted. If return of income is not furnished, that is a 144 case, for example, then advance tax is determined and you need to pay the tax under 249(4), and only then they will admit it. If there is genuine hardship, it can be condoned by the Commissioner of Income Tax Appeals. So, my question is this, if I say that okay, no problem, you are genuinely facing the issue, I will pardon it, does it mean it is like a stay of demand? No. Demand is 156 notice of demand. It can be stayed if the High Court says so. But here I make an application to the Commissioner of Income Tax Appeals. He has determined the advance tax, and I genuinely am going and telling there is a death or whatever it is. So, please condone this, please reduce the money, or I'll pay later, whatever it is. Is this notice of, is this stay of demand? No, because notice stay of demand is governed under 220 subsection 6. This section is not stay of demand. These are some of the hidden points, that's all. Right. All this is fine. Yeah. The procedure of appeal, we will see. What is the procedure of appeal? In this chart, guys, you need to make one change. What change you have to make? Wherever there is commissioner, please add JCIT. Please add JCIT. Go through this chart, then I'll explain. Just go through once. Please add JCIT. Wherever there is green, no, add JCIT. Green, JCIT, What's your number, man? 76. By that. How much? 80%. They want, friend wants 3. Whatever name, if it comes that time. They want it for. People are leaving, I guess. They'll see and they'll leave off. Huh? What? Okay, so process is very simple. CIT appeals, JCIT shall fix a day and place for hearing. You may have done this, no? Hearing? Yes. Full-time job, yes. For hearing and shall give notice of the same to the appellant and AO against whose order his appeal is filed. Following have the right to be heard at the hearing, appellant as well as the AO. Both will have the right to be heard by this guy. So they have a right to be heard at all the meetings there. Apart from that, appellant or then in person or authorized representative, both. So you will be the authorized representative, or the AO means in person or authorized representative, whatever the case may be. Third point, CIT appeals or JCIT appeals may make further inquiry or direct the AO to make further inquiry and report the results to CIT appeals or JCIT appeals. CIT, JCIT appeals may allow appellant to go into any ground of appeal not specified in the grounds of. What do you mean by ground of appeal? Basis. So basically, it's not, you cannot just say what all you are having a problem with, just that the main points. The summary 36(1) should have been allowed as per this section, not allowed by the AO. That's it. And then you will have to give the reasons for that, grounds. That the ground is, I am telling it is allowed. Why it should be allowed, later I can substantiate. The order of CIT appeals, JCIT shall be in writing and shall state the points for determination of the decision. So it should be like a speaking order. CIT appeals may hear and decide within 1 year from the end of the financial year in which such appeal is filed. Here they have used the word may. Is it may or, is it shall or is it may only? May. So may eliminate interference between Commissioner of Income Tax appeals, JCIT, and appellant through technology. We already have faceless appeals. On disposal of appeal, you have handled the meetings also, Zoom meetings, senior. So those also happen. If you want to talk to them, and first is everything is documentation, documents you will send, but you still want to talk, video conferencing. So there is no meeting, physical meeting gone. Yeah. Yes, correct. So their face will not be seen, because otherwise you will say, sir, come later, tell me your Insta handle. Give me your Insta handle, Paytm, QR code you please give, right? All those things will happen. So all that is not. Yes. On appeal, best is the assessing officer should, do what? In his DP only, he should put QR code. Best. Very easy. Right? On disposal of appeal, Commissioner of Income Tax or JCIT shall communicate order passed to the SSE and CIT. Done. So now, as far as stay of demand is concerned, guys, can I stay the demand? That is another chart which I will show you. Stay of demand by AO and Commissioner of Income Tax appeals. By AO and Commissioner of Income Tax appeals. Stay of demand. AO's order appeal to Commissioner of Income Tax appeals. SSE may apply to the assessing officer. Assessing officer will give certain conditions for the stay of demand. Right, he will give conditions. Now basically when they have given a demand under 156, I can, assessing officer, appeal to that person's order to CIT appeals. Now I am going to assessing officer and say, sir, I have already put an appeal, right? You are asking me for the demand of like 20 lakhs, sir. In that appeal, 10 lakhs is not payable only according to me. 10 lakhs I will pay. Remaining 10 lakhs, please grant a stay of demand under 226, sorry. AO will have to give certain conditions and then stay of demand will happen. The thing is, you can either grant the demand or you can reject. If you have granted the demand, stay of demand, then SSE is not treated as SSE in default. Otherwise, it will be treated as SSE in default. Can AO reject it? Yes. If I reject, can I appeal to CIT appeals against rejection? Rejection of stay of demand. IT Act is silent. And case law, Debashish Maulik says CIT appeals has inherent power and they can grant stay. This is one case where they say, CIT, if you have a problem with the AO, can you go to CIT appeals? Yes. Can you request him to stay the demand? Yes. He has inherent power to do what? To stay the demand. He has inherent power to stay the demand is what they say. Yes, not possible. So earlier they used to go and give some additional, under the table and get everything stay of demand. Now it's not possible. High Court and Supreme Court, guys, can I, okay, ITAT, 254 proviso, stay will be granted immediately. Stay will be granted immediately, Finance Act 2020. So it will be granted immediately. So how many days? Stay will be granted for 180 days. And further 185 days. So total how many days? 365 days you can grant the stay. But they are saying that at least pay 20% of the demand. So this was changed in 2020, was at least pay 20% of the demand. That's what I am asking. 20% you pay, that's all. If more than 365 days are over and stay has been vacated, I gave you time for 180 days plus 185 days. I gave you time for 365 days. 20% of the demand I am asking you to pay, you are not paying. More than 365 days over, stay will be vacated. Full demand has to be paid. Otherwise, you are assessee in default. This is with respect to ITAT. High Court and Supreme Court, no stay of demand. These are again the hidden points. So rather than going like full blown, I am just doing the gist of the everything, so it will be very easy for you to follow. Next. This was done. The aggregate period of stay originally allowed an extended period shall not exceed 365 days. Finance Act 2020 should not go 365 days. Not possible. Now an interesting thing in High Court. High Court will decide whether it is a substantial question of law. They will not discuss whether it's a question of fact. For example, everybody knew that Ajmal Kasab killed everyone. But what is the substantial question of law? Whether it involves the death penalty or should I give life imprisonment? That was the question of law. It was never a question of fact. Did people die or not? That was not the question. Question was, he is guilty, but under what? Is it like the mind is so depraved that I should give him the death penalty, or should I give some leeway and give him something else? So that was a question of law. Similarly, in Income Tax Act, I should always see the question of law. How? Appeal is admitted. Appeal is admitted. Formulate the question of law. Should I formulate the question of law? Yes, when the appeal is admitted. Can I, what do you say, decide against it or decide for it when I appeal admitted for the question of law? Basically, when I prefer an appeal to High Court, I will say, sir, according to me, this subsidy is a capital receipt which is not taxable. That's the question of law here. It's not about the fact. The fact is, according to me, it's not taxable only. You have to go to the law aspect whether it's taxable or not. So then I'll go to the thing that on one particular point they will accept the appeal. Once I accept the appeal, my question is, should you formulate one more question or only that one question is allowed? So basically, if that for that one question, if you have decided, then there ends the matter. If you have decided against, then I can go to whom? Supreme Court. I can go to Supreme Court. Can I formulate one more question? Yes, it is possible, but reason should be recorded in writing. If it is not a substantial question of law itself, so High Court says, according to me, it is not at all a substantial question of law. And the only option is what? Special leave petition. I can directly go to the Supreme Court. This is not admitting the appeal, rejecting the appeal. Seeing the grounds of the appeal, they will first say that, look, I will now admit it or I will not admit it. Yes, there is question of law, there is no question of law. If there is no question of law, then they will say, I will not even admit it. When you reject it like that, by not even admitting the appeal. See, if you admit it and lose the case, Supreme Court anyway you can go. The High Court is not even admitting the case. What is the option? Constitutional remedy, special leave petition. So in the exam, if they ask you, the High Court never admitted the petition. If they admitted the appeal and decided against the petition, Supreme Court. But if they did not admit the appeal itself, then SLP, special leave petition to the Supreme Court. They will tell whether it is question of law or not a question of law and stuff like that. And one more question. A question of law which is raised, not raised in the tribunal only. See, it was raised before, you can bring it up. If it was never raised in the tribunal, can you admit it in the High Court? No. Can you raise it in the High Court? No. But if it is raised in the tribunal and wrongly determined by the tribunal, then I can go to High Court. Raised in the tribunal, not determined in the tribunal, High Court I can. So additional, here I told you, additional question of law. That additional question of law should have been raised in the tribunal. Most important. In the tribunal I did not raise. Can I raise a new issue in the High Court? Not possible. New issue in the High Court, not possible. So these are some of the hidden points. This was decided in Tata Chemicals, one of the cases. Now, for example, in the return of income, A and B was allowed. Assessing officer allowed A, disallowed B. Commissioner of Income Tax allowed B. ITAT allowed B. Can the High Court disallow A and B? What do you think? Can the High Court disallow A and B? Yes. Only B can be disallowed. A was not raised in the tribunal. So obviously, no. Can HC disallow A and B? No. Whatever was raised before me, that only I should do. So for example, in the return of income, I claimed A, B, C, D, E. Assessing officer disallowed all 5. Commissioner of Income Tax appeals allowed the 3 items, disallowed the 3 items, but allowed the 2 items. ITAT disallowed these 2, and on C there was no order which was passed. Only on item number A, can I go to High Court? Yes. So High Court, for example, can formulate the question for A. What question? Question of law. Can formulate the question. They can accept B and formulate a question also. Why? Because B was also raised, right? They can accept B also, because it was already raised in the tribunal. Most important word, it should be raised in the tribunal. Can formulate on C because it was raised in the tribunal but no order was passed. Are you understanding? It was raised in the tribunal but no order was passed. D and D, can it formulate? No, because it was never raised in the tribunal. D and D cannot formulate if they are not raised in the tribunal. Guys, did you understand this? They can ask this in the MCQ. So again I repeat. A, B, C, D, E. Return of income allowed everywhere. Assessing officer disallowed all 5 items. Commissioner of Income Tax appeals disallowed the first 3 items but allowed the last 2 items. I preferred an appeal only on the first 3 items with the ITAT. ITAT disallowed A. ITAT disallowed B. but ITAT did not form any opinion on C. High Court I am going. It can formulate a question of law for A. It can also accept B later because it was already raised in the tribunal. C also it can formulate because it was raised but not determined. Yeah, if you are not appealing only against it, then fine. It's about what you appeal. D and D can never be admitted. D and D not allowed, cannot formulate. Then you see here. Deduction claimed in return of income, no. Right? Allowed by AO, no. Then you are claimed before the Commissioner of Income Tax Appeals. Right? You have claimed it before the Commissioner of Income Tax, that also you have not claimed. Have you claimed the deduction in the return of income? Never. Like when deduction has come, you have not claimed in reduction in the return of income also. Obviously, since you have not claimed, will you allow it? No. Then you have not claimed before Commissioner of Income Tax Appeals also. The question is, a deduction which was never claimed before, can you claim directly in the ITAT? What do you think? There was one case law, NTPC, which said it is possible. Can you do it in High Court? Definitely not applicable. Why? High Court, we have already, it should already be raised, and High Court only decides question of law. Till ITAT, it's the final fact finding authority is ITAT. Second one, deduction claimed in return of income, no. Allowed by AO, no. Can you claim before CIT appeals? Forget about ITAT. Can you claim in the CIT appeals? So there was one case law, Gurjar Gravers. They said it is not allowed. So once it is not allowed in Commissioner of Income Tax Appeals, the further process will not even come into the picture. Basically, NTPC, they said until the Commissioner of Income Tax Appeals, if you have never claimed, then you can claim in ITAT. Deduction claim not claimed in the return of income, not allowed by AO also, but is it claimed before Commissioner of Income Tax Appeals? That can be allowed if there is a change in the law. So only if there is a change in law, Commissioner of Income Tax Appeals can allow, which means there was some decided case law that has come, or they have changed the law itself, where they said that particular transaction is allowed. In that case, you can do so. Claim before ITAT, not applicable. High Court, not applicable. Deduction claimed in return of income in all the other cases, no. If you have not claimed anywhere, you can't claim in the High Court for sure. For sure, you cannot claim. So guys, if you see a couple of other points, you see this Gurjar Gravers. Page 6.5, please read the first case and Jute Corporation, both the cases you read, important. It's in page number 5 for you, same, 6.5, read. Is the queue moving? No? Stuck, which means all sold out. Seats are increasing. New stadium, huh? Right. They'll sing one song here, one song there. Can the first appellate authority allow the deduction which was not claimed by the assessee in the return of income and was not allowed by the assessing officer? Gurjar Gravers. Assessee did not claim deduction in ITR. Even the AO did not allow the deduction. Assessee claims deduction before Commissioner of Income Tax Appeals. The Supreme Court held that Commissioner of Income Tax Appeals could not have entertained the ground of appeal relating to deduction. SSE has not claimed the deduction in the income tax return, and the AO also did not allow the deduction. Therefore, CIT appeals cannot admit such a ground of appeal. Jute Corporation of India. The SC held that the first appellate authority can permit the SSE to raise an additional ground of appeal if such ground raised is bona fide and same could not have been raised earlier due to good reasons. So, ultimately, the key point from above judgments, no claim for deduction can be admitted by the first appellate authority if no claim was ever made in the ITR and not allowed by the assessing officer. A claim for deduction can be admitted by first appellate authority, that is Commissioner of Income Tax Appeals, even if no claim for such deduction was made in ITR, if appellate authority is satisfied that such a claim could not have been raised at the time of filing the return of income or the time of assessment proceedings. Can first appellate authority enhance the assessment by adding some more income? Can you add more income, etc.? Yes, the CIT appeals has power to add more income to it, no problem. All this is allowed. Then some more hidden points you will see. So guys, if you see there, if you remember a quick revision of the timelines, section 147, normal less than 3 years, more than 3 years, how much? 50 lakhs. And section 150, it says you can give the notice any time. We saw some peculiar cases. 154, normal rectification, Supreme Court rectification, retrospective amendment, 4 years. Section 263, yeah. So, yes, as per section 263, that is revision by whom? Commissioner. 263 is revision by Commissioner. This is what the timeline is. So, I am just writing the timeline to make you understand. 147, the timeline is 3 years and more than 3 years. 154 was 4 years. 4 years from which date? Four years from the end of assessment year. No. Month of the order. Year of the month of the order. Yeah. You can go through. 4 years from where? End of the year. End of the financial year in which the order sought to be amended is passed. Sought to be amended is passed, correct? Order sought to be amended is passed. So, that is what it is. Here, under section 263, guys, under section 263, normal cases 2 years, means in normal you can only revise 2 years. 263, that is your Supreme Court judgment, you can revise anytime. And any retrospective amendment, you can revise only 2 years. That is the change. You see section 263. Revision of orders prejudicial to revenue. The order under this section, page number 10, shall not be made after the expiry of 2 years from the end of the financial year in which the order sought to be revised was passed. Original order date. So, guys, this section is all orders prejudicial to revenue. Interest of the revenue means the AO now is passing order taking bribe for the benefit of the SSE, right? Or reverse cases where the thing is some of the AOs only are not corrupt, but the higher authority in cahoots with the assessee is doing this. So, can I approach the final guide under 263, Commissioner of Income Tax? Yes. The Commissioner of Income Tax under this section can revise the order if he wants. Maximum time 2 years, but the 2 years has some exception. This is the exception. Normal case 2 years. Supreme Court judgment anytime. The Supreme Court judgment has been passed, so that I can revise. Then retrospective amendment 2 years means 2 years from which year? Again, if order has been done retrospectively and that obviously covers my year also, then from the day it is passed within 2 years. We will see examples later. So check this. On 2016, P expense was allowed. On 30/6/2021, Supreme Court deduction P was disallowed. AO 147 was silent on this. Supreme Court has disallowed the deduction. I have to add it, right? So under Commissioner of Income Tax 263, because he has disallowed it and assessing officer has not done it, it is a order prejudicial to revenue. If I add that expense, I will get more tax. Hence, Commissioner of Income Tax under section 263 can allow this any time. Commissioner of Income Tax can allow this any time. Pass the order any time. Disallow. When I say you can pass the order disallowing the expense anytime. Let me rephrase. You can pass the order disallowing the expense anytime. One more example. 143(3) assessment year 2021, 31/1/21. So the valuation report whereby some of the expenses had to be disallowed, etc., and the expense claimed is extra, that valuation report came out in 5/2/22. Commissioner of Income Tax Appeals can revise. It's a normal case. Within 2 years from the end of the financial year in which the order sought to be amended was passed. What is the order sought to be amended? 31/12/21. End of the year 31/3/22 plus 2 years. 31/3/24. One more, CIT versus ICICI Bank, important case. These are all, whatever I am discussing are all MCQs. 143(3) was passed on 30/1/2017. Item number A, item number B, item number C is what is covered in that. 147, they did a reassessment 31/12/2019. They added item number D and E to the income or the disallowed, whatever the case may be. Section 263 can be passed within how many years? 2 years from the end of the financial year in which the order sought to be amended. Now the question here is that 2 years will come from 2017 or 2019. Is it last will override the earlier one? How is it? Sorry? How? Yeah, for all, like A, B, C, D, E, at 2 years will come where? Like what I am saying is, will even A, B, C, will it be merged into 147 order? And overall it is A, B, C, D, and from there only 2 years. Yes. So basically guys, very simple. They are telling it was decided in, because this was a valid doubt. In one assessment order, 3 items were there. In the reassessment order, 2 items are added. If I have to revise it now, when will I revise? That 2 years will be from where? Can for the same SSE and similar same assessment year, can I pass the revision order twice? Was the question in ICICI Bank Limited. Answer is yes. For ABC, 2 years will be from 31/2017. End of the year 31/3/2017 plus 2 years, 31/3/2019. For D and E, 2 years from 31/12/19. End of the year 31/3/20 plus 2 years, 31/3/22. So standing in 31/3/21, what would be time barred? ABC will be time barred. This was another case. ABC will definitely be time barred. Any doubts? I already discussed yesterday about partial merger, total merger. What is partial merger? In 154, rectification of mistake, the merger concept is what? I'll revise that because here we need to know something different. So if you remember yesterday, doctrine of merger. Assessing officer allowed A, B, C, D disallowed, E, F allowed. Commissioner of Income Tax appeals disallowed C and D. So Supreme Court now allows B, C and D. So should the Commissioner of Income Tax only allow everything, or the entire order is merged, or only C and D will be merged? Only the portion C and D will be merged with Commissioner of Income Tax appeals. Other things will remain the same. So in 154, is it partial merger or total merger? Partial merger, which means if I want to rectify this, Commissioner of Income Tax has to allow C and D, and assessing officer should allow B and then disallow E because he had passed the order. What will merge is only the two items, C and D. This was regarding 154 only. Come to this now. Here 154 was partial merger. 263 will see AO disallowed A and B, disallowed C, allowed D and D. Commissioner of Income Tax appeals allowed A and B. Right. Now, Commissioner of Income Tax appeals, who should do this now? Is it full merger or partial merger? Partial or full? Yeah. So guys, 154 and 263 will be partial merger. 154 and 263 again will be partial merger, because 154 is also rectification, 263 is also rectification. But 263 is what kind of revision? Orders prejudicial to revenue. Orders prejudicial to revenue. So if you see here very clearly, 263 and 154, doctrine of partial merger is affirmed. Partial merger. What is 264, guys? What is 264? Revision of other orders. Page number 6.11. Revision of other orders. In case of any order other than which 263 applies, passed by an authority subordinate to Commissioner, he may either on his own motion or an application call for the revision. So other than 263 will come under 264. Other than 263 will come under 264. So see this example. A will allow assessing officer will allow A and B, will not allow C and D. Under 263, A and B will be disallowed. A and B will be disallowed. Then it will go to Commissioner of Income Tax again under 264. I told you whatever was not done in A and B can be done in 264. So 264 they will allow C and D. They will allow C and D. So can a 264 of a 263 be done or not done? check this now. Now come to this. Yes, correct. Both are completely different. Order of AO which has been revised under 263 cannot be revised under 264. Therefore, after revision under 263, 264 is not possible. But if you pass a direct order of 264, that can be revised under 263. Right? Because that's a completely different order. 264 says for other items than 263. Yes, so it's beneficial for revenue. That is why you can do a 263 of a 264 order. 263 is a very good order. It's only for which is orders prejudicial to revenue. That's why. Which one? Yeah. Yes. So you see now difference I've given here. 263 revision of orders prejudicial to revenue. 264 revision of order prejudicial to SSE. That's why 263 of 264 possible. 264 of 263 not possible. Yes or no? Right. An appeal can be filed to ITAT against the order passed under 263. No appeal can be filed against order passed under 264. Yes. So, revision is possible of the issues which have not been considered and decided. It is only on the issue and appeal has been filed to CIT appeals. Revision under section 263 is possible after revision under 264. Revision under 264 is not possible if the revision has been made under 263. Revision is suo moto or when the error is brought to the notice by the AO. Here revision is suo moto or an application made by the SSE. So that is what they are trying to tell. 264 of 263 not possible. Done. Then some other points. Coming to 264 here. Commissioner of Income Tax under 264. Commissioner of Income Tax under 264, what can you do, guys? Suo moto, 1 year from the date in which the order is made. Or apply 1 year from the date on which order is communicated to him. Two things. Suo moto you can do 1 year from the date where the order is made. Here 1 year from the date on which order is communicated to him. Greater than 1 year is also allowed with sufficient cause. So 264 order is made within. So when can I apply? 1 year from the date on which order is communicated to him. 264 order also should be made within 1 year from the end of the financial year in which the application is made by the SSE. So let's say you receive the order on, assume 1st October 23. When can you make an application for 264? From the end of the year they are telling, or 1 year from the date on which order is communicated. So 1/10/24 you can make the thing, and that order should be passed when? 1 year from the end of the financial year in which the application is made. Let's say application is made sometime on 25th September 24. What is the end of the financial year? 31st March 25. For that 1 year. 31st March 26. 31st March 26. Now this is prejudicial to the SSE. They can ask you one question. The order should have been passed by 31st March 26, right? 31st March 26. Commissioner of Income Tax did not pass the order. Time barred. What happens? The SSE claims that it is prejudicial to him. He has required for allowance of 3-4 items. He has applied to 264. Same dates they'll give. He should have done it by 31st March 26. what to do? It has not been passed. What is the remedy? Remedy, you leave. What happens? With SSC, you have to go somewhere else. Appeal. Deadly point in MCQ. They'll ask, all benefits are deemed to be allowed. See the pressure on commissioner now. He has to pass the order. All the benefits are deemed to be allowed. Deadly point, guys. That's about it. Those are some of the hidden points. Other things you can go through, nothing much. Cool. We'll take a break. After the break, we will do other areas. What is there now?